The next chapter for discussion is bills of exchange, sir. Bills of exchange. So we are going to learn the accounting for bills of exchange. See, in different situations relating to bills of exchange, what is the accounting treatment? That is what we are going to cover in this chapter. First of all, straight away, see, bills of exchange basically divided into two types. One is trade bills, another one is accommodation bills. Trade bills, accommodation bills. Now, to facilitate business transactions, these trade bills will be drawn. And to facilitate the financial needs of individuals, of persons, generally accommodation bills will be drawn. Now, let us discuss first the trade bills. See, suppose for example, imagine a situation. Suppose there is a seller, Mr. X. Now he is selling goods to the buyer, Mr. A, and the sale value is 10 lakh rupees. Now the credit period is 2 months. Now that means Mr. A has to make the payment after 2 months to Mr. X. Now what Mr. X can do is, he knows that he has sold goods worth of 10 lakhs to Mr. A and sale completed, and he knows that Mr. A due to him 10 lakh rupees. So what Mr. X can do is, he can execute one document, one instrument. In that instrument, he can clearly mention that after 2 months, Mr. X will give a direction to Mr. A that after 2 months, you pay this amount to that person, any other person to whom I specify. Or you make the payment to the bearer of the instrument. That means whoever this document is there, the holder, you make the payment to him. Or you make the payment to me, either to me or to the person to whom I directs, or to the bearer of the instrument. Now that means this direction, this order is written in a paper, instrument. Now that will be drawn by the seller, Mr. X in this case, on the customer, Mr. A, because Mr. A due to him 10 lakh rupees. Anyway, he has to pay 10 lakh rupees after 2 months. So therefore, Mr. X will draw this bill on him and he will accept it. He will, after drawing the bill, the maker of the instrument, that is the drawer, the person who executes, draw the bill is called drawer. The person on whom the bill is drawn is called drawee. Now, drawee will make the sign that he accepted. Now, once drawee accepted the bill, it becomes bills receivable to Mr. X. So, the drawer point of view, bills receivable is asset, because this is an order which is signed by the Mr. X, other person, that he is going to pay me 10 lakh rupees or to any person to whomsoever I directs, or to the bearer of the instrument. Now this becomes an order, this becomes my asset. So bills receivable is an asset for the person who draws the bill. The person who accepted, in this case Mr. A, from his point of view, it becomes bills payable. So bills receivable, bills payable. Now once the drawer receives the bills receivable, he has certain options. Either he can retain the bill till maturity, or he can endorse the bill to some other person. Like for example, Mr. X may have some creditors. Now in favor of the creditors, this bill may be endorsed, because he has to make the payment to creditors now. So instead, he can directly endorse this bill in favor of his creditors, or he may send the bills for collection. Like that, some options are there. I think you understood the concept of bills. Very simple concept. When somebody due some amount to me, I will execute one document. In the document, I will clearly specify that you make the payment, so to me or to any other person I directs, or to the bearer of the instrument. And I will sign, and I will give a amount, date, everything, and I will give it to the other person. Other person will accept along with his signature. Then it becomes my bills receivable. So this is the thing. See, in examination, they are not going to ask what is bills of exchange, explain. So no need to, have an idea about what is bills of exchange. So what is bill of exchange? It is a negotiable instrument. See, there is a negotiable instrument act. See, this bills is negotiable instrument. That means which we can easily transfer from one person to another person. For example, Mr. X draw a bill on Mr. A. Now Mr. X has bills receivable. This he can endorse in favor of his creditor, or he can transfer to, he can discount it with the bank. So it's a negotiable instrument which easily can be transferred from one person to another person. But the most important thing is it is in writing, containing an unconditional order. It contains an unconditional order, not conditional order. Unconditional order. I am giving an order signed by the maker. Maker means the drawer, the person who draws the bill. Seller, nothing but. In case of trade bills, directing a certain person to pay certain amount to him or to the order of to whomsoever I give the order, or a certain person or bearer of the instrument. Bearer means the person who is holding the bill. And it is a negotiable instrument which he can easily transfer from one person to another person. See, in bills of exchange, there are, three parties. Basically, there are two parties, drawer, drawee. Drawer also known as maker. So the drawer is the person who can say in business transaction, it is a seller. Seller will sell the goods and buyer has to make the payment. So he draw the bill on the buyer. Now the buyer is called what? The drawee. And there is a payee, ultimately the person who receives the payment. Okay. So the drawer, the drawee, the payee. So the drawer is the party that issues bills of exchange. Maybe a creditor, lender, seller. He is the maker of the bill and his signature is necessary. He will actually prepare this bills of exchange. He will make the sign. Drawee is the person to whom the order to pay is sent. He may be a debtor, sale, purchase. Next, lendee or purchaser. So drawee becomes the acceptor of the bill, and payee or the beneficiary is the party to which bills of exchange is payable. Maybe he may be a drawer or he may be any other person. For example, drawer draw the bill. Now he endorses that bill to his creditor. Now the payee is his creditor. Okay. Now I told you there are two important types of bills: trade bills, accommodation bills. Trade bills to facilitate the business transactions, trade transactions like sale and purchase of goods. These bills will be drawn. See, this is also one of the outdated concept, bills of exchange. Olden days it will be more relevant. Nowadays it is not. Okay, anyways, it is there in the syllabus. Now accommodation bills. See, to accommodate each other. For example, there are two friends. One friend is in need of funds. So what he can do is, he says to other friend that I will draw a bill on you. You accept it. So I will discount it with bank and I will get the required amount. Now on the due date, I will make the payment. So we can accommodate each other like that. That is accommodation bills. So that means there is no commercial transaction in accommodation bills, but still one party, in order to accommodate other party, a bill can be drawn and accepted. Okay. Now see, next concept is maturity or due date of the bills of exchange and days of grace. See, in case of a bills, the due date, the maturity date is very, very important, right? So here you see due date, maturity date in case of a demand bill or at sight bill or on presentation bill. For example, when I demand, you have to make the payment. At sight, the moment you see, you have to make the payment. On presentation, when I present the bill, you have to make the payment. That is the maturity date actually. Now in such a situation, what is the due date? Simple. The bill at sight becomes due for payment as soon as it is presented for payment. The soon it is presented for payment, so that will be the due date. In case bill at sight, so you see, and that is the maturity due date. In case of instrument payable on demand, see, suppose for example, there is a bills of exchange. You have to make the payment whenever I demand. There is no time limit, in fact. So no time for payment is mentioned. So the moment I demand, that will be the due date, because there is no time limit now. Generally bills of exchange is drawn for a particular period of time. Suppose you have to make the payment after 2 months, 3 months, 4 months, like that. But if there is no, time limit, then generally demand bills. In case of demand bills, there is no time limit. Whenever I demand, that will be the due date. Next, presentation of bill. On presentation of bills, see, such bills are not entitled to the days of grace. See, generally these kind of bills are not presented, days of grace will not be allowed. See, there is a 3 days grace period will be allowed from the due date. Now in case of these bills, it is not allowed. Okay, at site, on presentation, demand bills. Next, see, maturity date in case of after date bill. After date means, see, I draw the bill on you, so I will mention the time period. After that, you have to make the payment. Now, in case of after date bill, the time payment is mentioned, clearly mentioned. 3 days grace period will be allowed. For example, if 5th May is the due time period and expires, we will add 3 more days. That means 6, 7, 8. 8th May is the due date. Next, maturity date in case of after site bill. So, for example, I have drawn a bill. Now, the bill is payable after site. Now, after site means once the other party, so making the, after site, whatever the period is there, expires, whatever the time limit at that time. So, for that, you need to add 3 more days. See here. In case of bill after site, payable at a fixed period after site. Okay, the period begins from the date of accepting the bill. So once you accept the bill, the period will start, and 3 days grace period will be allowed in such a case. Okay. Next, grace period. When the period of the bill is given in the months, so suppose in case the maturity date is calculated according to calendar month. For example, see here, the bill dated 4th May 2022, which is payable. Suppose if the bill dated 4th May 2022, suppose payable 3 months after date set. So in this case, the maturity date will be, see, 4th May, right? June 4th, July 4th, August 4th. So August 4th, the maturity date plus 3 days grace period will be added. So 7th August 2022 will be there. Suppose, and that means when there is a specific time limit is mentioned, and that too if it is in number of months, you have to calculate like this. Suppose when the period of the bill is given in days, for example, bill dated on 5th June 2022, which is payable after 65 days. Then the maturity date will be, suppose June month 25 days, July 31 days, August 9 days. See, 25 days of June, 31 days of July, 9 days of August, and 3 days grace period. So 12th August 2022 will be the maturity date. 3 days grace period is added. When maturity date falls on a national holiday, suppose for example, the due date, the maturity date is national holiday. For example, 26th January, which is the Republic Day. Then we have to take the 25th January because we know the national holidays. So before. So therefore, if the due date of the bill is on a national holiday, then the maturity date of the bill shall be the preceding business day. Next, when the maturity date has been declared as emergency holiday, sudden holidays came. For example, 25th July is the due date, but it is declared as a national holiday, emergency holiday. Then next day, 26th July, you have to consider. So this is the concept. Now see, bills receivable. See, from whose point of view bills receivable? Drawer point of view. And to him it is asset. Whose point of view bills payable? Drawee point of view. And his point of view it is his liability. Okay. So the drawer of the bill will show bills receivable on the asset side of the balance sheet. And the drawee of the bill shows bills payable on the liability side of the balance sheet. So the seller point of view, when he draws the bill and other party accepts it, it is his asset. And the buyer point of view, it is his liability. Okay. Now I will come back to dishonor of the bills, renewal of the bill, retirement of the bills. Now the most important part is accounting treatment. The journal entries for trade bills. Okay. Sir, carefully think, sir. This is the important part of this chapter. Once you know the entries very well, this chapter is over, sir. So in the books of the drawer, in the books of drawee, for example, X and Y. X is the seller, Y is the buyer. So X draw a bill on Y. So X is the drawer, Y is the drawee. What entries will come in different situations? See, first, entry number 1. See, when first bill is drawn by X on Y. So X point of view, when bill is drawn and accepted by the drawee, what is the entry? Bills receivable account debtor to drawee account. Because bills receivable, debit what comes in? Asset. Bills receivable is his asset. So therefore, he debit bills receivable account and he will give credit to drawee account. Like for example, drawee, when we make credit sales, what is the entry? Debtor to sales, right? When he makes the payment, cash or bank account debtor to debtors, na? So similarly here, I sold goods to you. When I sold goods to you, what is the entry? Creditor account, debtor account, debtor to sales. Now I draw the bill, you accept it. So I consider this as the payment you have done. Therefore, in my account, in my books, I will close your account by creating it. Already I might have debited at the time of sale. Now you have accepted the bills. That means you have made the payment to me. Therefore, in my books, I will close your account as if you have made the payment. Since you have accepted the bill, na? So therefore, bill receivable account debtor to drawee account. In this case, Y. Okay. Now think from the drawee point of view. Drawee first purchased goods from drawer. When he purchased the goods, what is the entry he has written? So he knows that he has to pay the bills. So therefore, bills payable will be created. Right? Bills payable is his liability. So liability is created. And he knows that he already purchased the goods. And since he accepted the bill, he discharged the amount due to creditor. Like that, he debited creditor account. That means drawer X account in his books. Like when we make the payment to creditor, what entry we will write? Creditor to cash or bank. Na? Here in the form of cash or bank, we will accept bills. So therefore, creditor account debtor to bills payable. So this is the entries in the books of the drawer and drawee. So whenever a bill is drawn and accepted by the drawee, drawer point of view, bills receivable account debtor to drawee account. Drawee point of view, whenever he make the payment, he accepted the bill. So drawer account debtor to bills payable. Now, see, now the bill receivable is there with whom? Drawer. Now see, the drawer is the holder of the bill. He has four options. What are the four possibilities are there? First possibility is he may retain the bill till maturity. One thing, one situation. Second thing is he may discount the bill with the bank. If he is in need of funds, he may discount it with bank. Third, he may endorse the bill in favor of any other person. Fourth, he may send the bill for collection. See here, he may send the bill for collection. So there are four situations now. You see, if you learn in the order what I am teaching now, then this chapter will be very easy. First, I sold the goods. So drawer, I sold the goods to you. Second, I draw a bill. You accepted. Now bills receivable is there with me. Now that bills receivable, what I will do with? I have four options. First option, I will retain the bill till due date. I will not endorse, I will not discount. The bill is there with me till the due date. Now retaining the bill till due date, drawer point of view, any entry will come? No entry. Drawee point of view also no entry. See, I draw the bill, you accept it, I received it, I keep it till maturity date. On maturity date, you will come and you will make the payment, or you may dishonor the bill. That's the second aspect. See, stepwise. First I sold the goods, then I draw the bill. Now the bill is there with me. Suppose this bill I kept till maturity. For keeping the bill till maturity, is there any entry will come? No entry. Drawer no entry, drawee also no entry. Okay. Sir, this is one possibility, sir. Suppose, sir, the drawer of the bill, what he can do is, before maturity date, he can discount the bill with the bank. Suppose he is in need of funds. For example, Mr. A sell goods to suppose Mr. X sold goods to Mr. Y 10 lakh rupees. The bill maturity date is 3 months. Meanwhile, he is in requirement of funds. So what he can do is, he can discount this bill with the bank. He can approach the bank and say to the bank that, sir, Mr. Y has to make the payment to me 10 lakh rupees after 3 months. So this is the bill he accepted. Look at this. So he will make the payment to the person, to the bearer of this instrument, or to the person whomsoever I directs. So therefore, by keeping these bills with you, bills receivable with you, please give me the amount. Now what bank will do is, bank after charging some discount amount will give the amount. Next, on the due date, the drawee will make the payment to bank. So transaction will be completed. So if the bill is discounted with the bank, as a drawer, think from drawer point of view, when bill is discounted with the bank. Now bills receivable is no more there with me. So therefore I have to credit. When I receive the bills, I will recognize as an asset, bills receivable account debit. Now I have discounted it. So bills receivable is created. Now cash or bank account will be debited because I receive the amount from bank. Na? So cash or bank account debtor. bills receivable will be created, and discount account will be debited, because this discount is what? My loss. For example, 10 lakh rupees, bank paid 9.5 lakhs, remaining 0.5 lakhs. So that means 50,000 bank has kept. Okay. So 10 lakhs bill. Okay. So because this discount is my loss, that's why I debited. So drawer point of, whenever he discounts the bill, close the bills receivable account from his books, because the bill is now there with the bank, not with the drawer, and drawer receives cash or bank, and discount also he will recognize as his asset, as his loss. Debit all expenses and losses, nominal account. Now come to drawee point of view. No entry. Sir, why no entry, sir? See, what drawee will do? Either you retain the bill till maturity, or you discount with the bank, or you endorse, or you send the bill for correction. What way it is affect me? At the end of the maturity date, I have to make the payment either to you, or to the bearer, or the person to whom you directs. So therefore, my point of view, during the maturity, during the period, whatever you done, in my books, no entry. In my books, no entry. Why no entry? Because what way I am concerned, what way I will affect. Either you keep the bill till maturity, or you discount with the bank. Suppose you discount the bill with bank. Is there anything, any liability, any asset, any loss, expenses will come to me? No. Instead of you, I will make the payment to bank. Suppose if you endorse the bill in favor of your creditor, instead of you, I will make the payment to creditor, your creditor. So therefore, my position is very clear. Drawee position is very clear. When the drawer till the maturity, if he retains the bill, or he discounts it, or he endorse it, or he send the bill for collection, doesn't make any difference from his point of view. That's why no entry in his books. Now, this is second possibility. Third possibility is, what drawer can do is, once he receives the bill, he can endorse it to his creditor. For example, his creditor is Mr. Z. So X creditor is Z. So X has to make the payment to Z. What X can do is, he can endorse this bill to Z, so that the Mr. Y, who is the debtor of Mr. X, will make the payment to the creditor of Mr. X, that is Z. Okay. So when I endorse the bill, think from drawer point of view. When drawer endorse the bill to his creditor, so it is like payment made to creditor now. So creditor account debit, that means Mr. Z account debit to bills receivable, because the bills receivable is no more there with me. So bills receivable will be closed. See, if I discount, my bills receivable account will be closed. If I endorse, bills receivable account will be created, and creditor account will be debited. And this discount receivable, what is this discount receivable? Whenever I will make the payment to creditor may give some discount. If he given discount, now discount will be created. It is like when I discount it with bank has charged some discount amount. Now that discount is my loss. When I make the payment to creditor, if he gives any discount, that will be my gain. So that's why it is created. So this is third situation. Tell me, when drawer endorse the bill to Mr. Creditor, his creditor, what is the entry? Creditor account debtor to bills receivable to discount receivable. And drawee point of view, no entry. Next, fourth situation, if the bill is sent to the bank for collection. Suppose sometimes the drawee may send the bill for collection to the bank. Now in such a situation, what is the entry? Bill sent for collection account debtor to bills receivable. So what is the common point, sir? When bill is discounted, when bill is endorsed, or when bill sent to the bank for collection, in all these three cases, bills receivable account is closed. And if the bill is discounted, cash or bank account is debited, discount account is debited. When bill is endorsed, creditor account is debited. When bill is sent for collection, bill sent for collection account is debited. Okay. Next. So these are the, so step by step. First I make the payment. I will sell the goods. Then I draw the bill. Then that bill I will retain till maturity, no entry. That bill I may discount it with bank. That bill I may endorse it to creditor. That bill I send the bill for collection. Now the maturity date comes. Sixth entry I will come back later. Now see, stepwise you follow the manner in which I am teaching, so that it will be very easy for you. Okay. Now the maturity date comes. On the maturity date, the two possibilities are there. What are the two possibilities? Either drawee honor the bill or dishonor the bill. Honor the bill means he will make the payment. Dishonor means he is unable to make the payment. Okay. First we will see the honor. See here. if the bill is honored, paid on the due date previously retained by X. Now see the drawee Y in this case make the payment to X. That means bill is honored. And the bill is retained till maturity by drawer himself. That's why he make the payment to him. Y makes the payment to X. Now you tell me, on the due date, the drawer has received the payment from drawee. What is the entry? So when I received the bill, what entry I have written in my books? Bills receivable account debtor to, so the drawee account. Now whenever I receive the payment, cash or bank account debtor to, bills receivable account will be closed. Bills receivable account will be closed. This is when I retain the bill till maturity date. Because when I retain the bill till maturity date, I have not passed any entry. Just I sold the goods, I have drawn a bill, you accepted, I have recorded in my books that bills receivable account debtor to drawee account. Then on the due date you came and you make the payment. Therefore cash or bank account debtor to bills receivable will be closed. Now think from drawee point of view. Drawee, he has made the payment to his bills, he has discharged the bills. Therefore bills payable will be closed. Liability will be closed in his books. Bills payable account debtor to cash or bank. Okay, sir. Drawer books, drawee account to drawee books, drawer account already closed, sir, at the time of receiving the bills itself. Now the payment is received. So when the payment is received, drawer books bills receivable account asset will be cancelled because this asset has realized the amount. Drawee books bills payable paid. So therefore this bills payable result into payment. So bills payable to cash or bank. This is one possibility, sir. Suppose, what is the second possibility, sir? As a holder of the bill, I may discount it with bank na. Now the bill is previously discounted with bank. Now that bill is honored on the due date. That means drawee makes the payment to bank. Tell me, as a drawer, any entry will come in my books? No. Because at the time of discounting of the bill, what entry I have passed? Cash or bank account debtor, discount account debtor to bills receivable. Bills receivable already closed. So therefore no entry in my books. When the bill is honored on the due date, if it is already discounted with the bank, no entry will come in drawer books at the time of maturity honoring of the bill. Why no entry on the date of honoring of the bill? What you are going to close in the books of drawer? Already bills receivable closed at the time of discounting. Already when the bill is received, drawee account is also closed. Now what is there to close in his books? Everything is gone. So no entry. Now drawee point of view, now he has to make the payment. He made the payment to bank. So his point of view, bills payable liability is cancelled. Therefore bills payable account debtor to cash or bank. So see, look at the position. Whatever be the situation, to whomsoever he is paying, his entry will be common. Bills payable account debtor to cash or bank. Because from his point of view, bills payable liability is over now. Now cash or bank is going out. That's why whatever be the situation, his entry will be same. Now come to the third situation. What is the third situation? He may endorse the bill in favor of anybody, right? Mr. X endorsed the bill in favor of Mr. Z. Now on the due date, drawee has make the payment to Mr. Z. Now what is the entry will come in the books of this person, drawer? No entry. Because the moment I endorsed, what entry I have written? Recollect it. Creditor account debtor to bills receivable. So bills receivable already gone. Already cancelled. So therefore, when on the due date, on the maturity date, when the payment is made by the drawee to the endorser, so no entry will be in his books. In his books, drawee books, same, bills payable to cash or bank. Suppose the bill is sent for collection. Now important, listen. When the bill is sent for collection, what is the entry we have written in the drawer books? Bill sent for collection account debtor to bills receivable. Now when the amount is received on the due date, bank account debtor to bills for collection. This is the only situation on the due date. If the payment is received, I will record entry in the books of drawer. In all other situations, so when the bill is sent to, and one more thing is, bill is retained till maturity date. When the bill is discounted with bank, or when the bill is endorsed previously, now on the due date the bill is honored, no entry will come in the books of drawer. Because already at the time of endorsing, at the time of discounting, the bills receivable is cancelled. Okay. So when the bill is sent for collection, bill sent for collection account debtor to bills receivable. Now if the bill is honored on the due date, bank account debtor to bills for collection. Okay. Now see, this is the situation, sir. So tell me, sir, first drawer makes the sales to drawee. First thing. Second, drawer draw the bill on drawee. Next, third, sir, as a holder of the bill, either he can retain the bill till maturity, or he can discount it with bank, or he can endorse it to his creditor, or he may send the bill for collection. 4 situations are possible. Now the next thing is what, sir? On the maturity date, the bill is honored. Now any one of these 4 situations, sir, suppose the bill is retained till maturity and that bill is honored. What entry you will write? So cash or bank to bills receivable. Drawer books, drawee books, same entry, bills payable to cash or bank. Because drawee point of view, irrespective of the to whom he is making the payment, his point of view, his liability, bills payable is now over. So therefore bills payable account he will debit, and cash or bank he will credit. Now suppose if the bill is already discounted with bank, now on the due date the drawee honor the bill, no entry. And similarly if the bill is endorsed and it is honored on the due date, no entry. But because drawer already closed bills receivable account in his books. Now only situation the entry will come is 7 and 8. Till the date, due date, the maturity date, the bill is retained, and second day is when the bill is sent for collection. Okay. Sir, you said okay. So first sale, then bills drawn, next maturity date, next on the maturity date honor, next suppose if the bill is dishonored, sir, that is also possible, na? See here, if the bill is dishonored, same 4 situations, sir, same four situations. What are the 4 situations? Simple. See, bill is dishonored and it is retained by the drawer till maturity date. Drawer retain the bill till the maturity date, and on the maturity date drawee is unable to make the payment. Sir, listen, when the drawee is unable to make the payment, that means the bill is dishonored. See, actually dishonor of the bill happens because of 2 reasons, either non-acceptance or non-payment. Non-acceptance means once when the drawer draw the bill, drawee doesn't accept it. There itself the bill is dishonored. But therefore, see, when the beginning stage itself the bill is dishonored, so there is no problem. But once he accepts the bill, but on the maturity date he has not make the payment, that is called dishonor by non-payment. Now that is very, very important, dishonor by non-payment. When the drawee doesn't make the payment on the due date, so the bill is said to be dishonored. Now what law says is, whenever a bills of exchange is dishonored, the holder of the bill, what he has to do is, he will go to the notary public. So, and he has to record the fact that this bill is dishonored. For that, the notary will charge some noting charges. Now, very, very important. See, what is noting of a bill? Noting of a bill means recording the fact of dishonor on the bill. Okay. By whom? By the notary public. And this is compulsory as per the law. And for that, some charges also we need to pay. See, the recording of the fact of dishonor of bill by a notary public is referred as noting of a bill. For this purpose, a fee called noting fee or noting charge is required to be paid. It is an expense for the holder of the bill. See, who has to, done the noting? The holder of the bill. For example, if the bill is there with the drawer, if the drawer retain the bill till maturity date, so he will go to the notary and he make the noting of the fact that there is a dishonor. So he will make the payment. Later on, he will recollect the same from the drawee and is recovered from the party who is responsible for such dishonor. Who is responsible? Drawee is responsible. Therefore, the holder of the bill will incur these noting charges, but later on these noting charges will be collected from the drawee because he is the person who is responsible. So therefore, now think, on the due date, bill is dishonored and the bill is there with the drawer. He retains the bill. Now think from drawer point of view, what entry you will write? See, the moment there is a dishonor, the bills receivable asset will be closed. And the drawer original position is, he is my debtor. He has to make the payment. Again, he will be debited because he will be reinstated to the original position. See, when I make the sales, what entry I have written? Drawee account debtor to, so sales, right? Now that position, that debtor position will come to drawee because he has not honored the payment. Again, he has to make the payment to me. So therefore, drawee or Y account debit to bills receivable account. And this cash or bank, what is this cash or bank? As a drawer, if I make any noting, for that I have to incur some expenses. So cash or bank is going out from me. Now think from drawee point of view. See, drawee point of view, he knows that he has not honored the bill. That means he has to make the payment to drawer again. So therefore, in his books, drawer account again will be created, because from his point of view, he is creditor. He has to make the payment to him. So drawer account will be reinstated, bills payable account will be cancelled, and he knows these noting sundry charges he has to incur. So he will debit in his books, debit all expenses and losses. So important, sir. Whenever there is a dishonor of the bill and the drawer retain the bill till maturity date, what entry will come? Drawer books first. Drawer point of view, drawee account again will be debited. And 2, bills receivable gone. So bills receivable account will be closed. Next, 2, cash or bank, noting charges, because he has to incur the noting charges to recording the note, fact of dishonor, the holder. So 2, cash or bank. Now drawee point of view. Drawee point of view what? Drawee point of view, he knows he has to make the payment. Now bills payable is cancelled now. So bills payable account debit. So noting charges account debit to drawer account. Again I have to make the payment. Next, suppose the bill is already discounted with bank. Now the bill is dishonored. What happens? Tell me. Think, different situation. Now the bill is already discounted by the drawer to the bank. Now on the due date, the bill is dishonored. If it is honored, no entry in the books of drawer. If it is dishonored, what drawer has to do? He has to reinstate the position of drawee, and again he is the person who makes the payment to the bank. He discounted with bank, so he has to make the payment to bank na. So therefore, what he will do is, again he will debit the drawee account, bank account he will credit, noting charges account also he will record. See here, drawee account, because drawee dishonored the bill, again he has to make the payment. So drawee account will be debited in my books. To bank account I will credit. What is this bank account? So drawee account debtor to drawee bank account. So because see, I have taken discounted with the bank now. So if the drawee doesn't honor the bill, I have to make the payment. Since the bill is dishonored, I have to make the payment to bank. So therefore, bank account I will credit in my books. I have to make the payment to it. And then noting charges, cash or bank. Now drawee point of view, same position na. So bills payable will be cancelled, noting charges will be debited, and he knows that again he has to make the payment to drawer. So drawer account will be created, bills payable account will be cancelled, noting charges will be recorded. Now think Nana, if you carefully analyze the situation, these are all very easy. Okay. So on the due date, the bill is already, the bill is dishonored and the bill is already discounted with bank. This is the situation. If the bill is discounted with bank already, and on the due date if it is dishonored, drawer what he will do? He will reinstate the original position. That means he will debit drawee account, he will credit bank account. He has to make the payment. And noting charges to cash or bank he will write. Why to cash or bank? Because from him the cash is going out to incurring this noting charges. Now if you think from drawee point of view, same position, bills payable will be cancelled, noting something charges account debtor to drawer account. Now see, suppose the bill is dishonored on the due date, no doubt, and the bill is already sent for collection. So see, the drawer sent the bill for collection. Now that bill is dishonored. What entry drawer will write? So when he sent the bill for collection, what entry has written? Bill sent for collection account debtor to bills receivable account na. Now bills receivable already anyway it is cancelled. Now bill sent for collection will be cancelled and drawee account will be reinstated. To cash or bank account I will write for noting charges. So therefore, what is a common thing in drawer books? Whenever there is a dishonor, drawee account will be debited. What is a common thing in drawee books? Whenever there is a dishonor, drawer account will be created. Okay. So therefore, drawee account debtor, bill sent for collection to cash or bank. Now his point of view, same, bills payable, noting charges to drawer. Now suppose on the bill is already endorsed. Now that bill is dishonored on the due date. Now you tell me as a drawer what you do. Again, I will debit drawee account. This time I will credit my endorsee account. My endorser, Z, my creator. Drawee to creator. And with what amount? Bill value plus noting charges. Sir, why you have not written cash or bank here? Tell me. Why drawer books cash or bank? Noting charges. Why he has not written? Because he is not incurring now in this case. Because in this case the bill is already endorsed in favor of Z. For example, the creator of Mr. X. Now who will make the noting? Generally the holder of the bill. That means the creator has incurred. So therefore we are writing in the books of drawer. So drawer books no entry regarding noting charges. So therefore, that's why bill value plus noting charges, including this amount, we have to credit Z account and drawee account. Important, sir, this is. So situations, if you think like this, first, I am the drawer, or I am the seller, I sold goods to you. Now I draw the bill. I am the drawer, you are the drawee. You accepted it. Now after that, possibilities. I will retain the bill till maturity, or I may discount it with bank, or I may send the bill for collection, or I may endorse. Over. Now on the maturity date, you make the payment to me because I retain the bill, or you make the payment to bank when I discount it already, or you make the payment to my endorser if I already endorsed in his favor. You make the payment, bill sent for collection, you paid it, no problem. Now if it is dishonored also same. I hold the bill till maturity. Now the bill is dishonored. I will reinstate your original position. That is drawee account debtor to bills receivable account, cash or bank account. Now suppose bill is already discounted with bank. Now that bill is dishonored. Now I need to debit drawee account, credit bank account. And I am the person who has to incur the noting charges to cash or bank. Now suppose for example bill already endorsed. If the bill is already endorsed, so I will debit drawee account. I will credit the creditor, the endorser account. Endorsee, to whom in favor I have endorsed the bill. Now drawee point of view, same entry na. Whenever there is a dishonor, bills payable account debtor, noting charges account debtor to drawer account. So I think Nana, this is the sequence. This is the way you have to learn Nana. Situations you see. So first sale, then bills receivable, then I will retain till due date, or I may already discounts with bank. Okay, or I may send bill for collection, or I may endorse the bill. Now the next thing is due date. On due date, bill may be honored, dishonored. That's it. Over na. This is bills of exchange major part. Now this is drawer point of view. Drawee point of view. First he will purchase the goods, bills payable. Next, retain till due date, discount with bank, bills for collection, endorse. When you do, he is not bothered. But on the due date, either he may honor the bill or he may dishonor the bill. That's it. Okay. Now, remaining topics of this chapter. So, what are the remaining topics, sir? See, there are small concepts now. For example, renewal of a bill, and then retirement of a bill, and one more renewal, retirement. What is this renewal of a bill? See, listen. Suppose if the drawee is not in a position to make the payment on the due date, so what drawee will do is he will go to the drawer and says to him that please extend some time. For example, the bill period is 3 months. Give me another 3 months because I am not in a position to make the payment. Suppose if the drawer accepts, okay, another 3 months I will give. What happens is the old bill will automatically cancels. Now a fresh bill with the new terms of payment is drawn and duly accepted and delivered. See, important. Whenever you ask for extension, if the drawer accepts it, what happens is the old bill will be cancelled and a new will be drawn with the new terms of payment. This is called renewal of a bill. And the new bill drawn for extended time period and such interest is charged for the extended period. Interest will also be charged. The specialty here is interest will be charged. Because who will allow you to make the payment 3 months time? You make the payment in another 3 months. I am giving extension of 3 months. Definitely the business people will charge interest. See, when the holder of the bill is not in a position to meet the bill on due date, that means the drawee. The drawee approaches the drawer with the request of extension of time for payment. If the drawer accepts, the old bill will be cancelled and a fresh bill with the new terms of payment is drawn and duly accepted and delivered. This is called renewal of the bill. And the new bill is drawn for extended time period and such interest is charged for the extended period. So this is the concept of what's a renewal of a bill. What happens in renewal of bill? See here. If the bill is renewed on the due date for the old bill cancelled. For example, we have extended the time period. Therefore, the old bill will be cancelled and a new bill will be drawn. So what is the entry in the books of drawer? Tell me. So when the old bill is cancelled, obviously in my books, so the bills receivable account will be cancelled, and drawee position I will again reinstate because he has to make the payment to me. So drawee account debtor to bills receivable account. Drawee account debtor to bills receivable account. It is like when he dishonor the bill till I retain the maturity. If on the due date, if he dishonor the bill, what entry I will write? Again I will reinstate his position na drawee account debtor to bills receivable. Same entry. Next, if the bill is renewed on the due date for the interest charged for the delayed payment. Suppose we thought that we will charge interest also now. So for that, again drawee account debtor to interest, because interest is my income now. Because I am giving extended time now. For that extended time I am charging interest. So interest will be created, drawee account will be debited. So next, this is the renewal of the bill. Next, so whenever there is a renewal of the bill, what happens? Old bill will be cancelled. So therefore, drawee account debtor to bills receivable, cancel bills receivable old. Then if any interest is charged, to drawee account debtor to interest. Now see, if the bill is renewed on the due date for part payment made in cash, suppose sometimes what happens, suppose the bill amount is 1 lakh, he makes 50,000 payment. For remaining 50,000, he may ask for extension. Now in such a situation, for the bill, whatever the amount you received, cash or bank to drawee account, you will credit. Cash or bank account debtor to drawee. Okay, now you have received the amount, that's why. If the bill is renewed on the due date for the new bill drawn and accepted, whatever the amount, balance amount, for that he accepted the new bill. So drawer point of view, same entry. When he draws the bill, bills receivable to drawee. Bills receivable to drawee. Now think from drawee point of view. Whenever the old bill cancelled in his books, bills payable to drawer account. Because bills payable, old bill cancelled, bills payable account will be debited, and drawer again he need to make the payment to him. So drawer account will be created. Next, for interest is expenses. So interest to drawer. He has to make the payment to drawer. Now see, next one, if the bill is renewed on the due date for part payment made in cash. So if the bill is renewed on the due date for part payment made in cash, suppose if he makes any part payment, so drawer account debtor to cash or bank, drawee point of view. And whenever he accepted the new bill for the balance amount, so generally when he accept the bill, what entry he will write? Drawer account debtor to bills payable. Same entry will come. So nothing great here, very simple concept. So remember, renewal of the bill means we will extend the existing time period. Whenever we extend, the old bill will be cancelled and a new bill will be drawn for the new terms, and some interest will also be charged. For that entries we have written. Now one more concept is retirement of a bill. See, sometimes what happens now, drawee may makes the payment before here. When the drawee pays the bill before its due date, so it is called as retirement of a bill. For example, due date 3 months, he make the payment within 2 months. Now it happens with mutual understanding, obviously, between the drawer and drawee. Now one important thing is, in case of such retirement, interest is payable for the unexpired period of the bill. So that is the time period between the date of payment of the bill and the date of maturity by the holder of the bill to the payee at an agreed rate of interest. That means this drawee has to make the payment. So since he is making the payment early, so he has to make some payment. And this amount of interest is referred to as rebate on bill. This rebate happens to be income for the drawee and expense for the payee. See, this is this rebate for early payment. Now see the entry here given. See, if the bill is retired before maturity. Now think from drawer point of view, he is receiving the payment early now. So therefore he will give some rebate to the other party, to the drawee, since he makes the payment early. So therefore his point of view, cash or bank account debtor, rebate allowed. Rebate allowed is expenses now to bills receivable. Suppose if the bill is already sent for collection, that will be cancelled. Because the bill is retired before maturity. cash or bank account debtor, rebate allowed, debit, 2 bills receivable, 2 bills sent for collection. Now drawee point of view, you think he makes the payment to drawer. So bills payable will be cancelled, bills payable account debtor to cash or bank, rebate received, that means kind of interest discount received for early payment. See, whenever you make early payment, sir, I think you will get some kind of credit, sir. That is what he said. When the drawee pays the bill before its due date, it is termed as retirement of bill. It happens with mutual understanding. In case of such retirement, the interest is payable for the unexpired period of the bill by the holder of the bill, drawer, to the payee to an agreed rate of interest. This amount of interest is referred as rebate, and the rebate happens to be an income for the drawee and expense for the payee. Okay, because I am making the payment early. So that's it, sir. This is the concept of bills of exchange. What you will do is, sir, I think there are 18 entries. The order is important. So according to the order, whatever I told you, in that order you will try to remember these entries. Once you are perfect these entries, sir, then only solve the questions. Otherwise it is very difficult, sir. And the accommodation bills treatment is same as this bill, sir. There is no difference. So once please read this theory, entire concept with entries, then solve the questions. Suppose without understanding these entries, if you try to solve, I think you are in danger. Okay, that's it. Now the next chapter for discussion is consignment, sir. Consignment accounting. Now, what is this consignment accounting, sir? Very simple, sir. See, for example, there is a manufacturer or trader. Now he sends goods to the agent who sells goods on his behalf to the customers. So first goods are sent by one person, principal, to his agent, and agent sell the goods to customers, and the agent will collect the payment from customers, and this amount he will give it back to the principal. Actually, these are the 4 steps involved in consignment. So who is sending the goods? The principal. We call him as consignor, the seller. And to whom goods are sent? Agent. We call him as consignee, the person who receives the goods. And see, this agent is not a buyer. Please understand. He is not making any purchases. He is receiving the goods. On behalf of principal, he will try to make the sales. And from customers, he will collect the amount. And after keeping his commission, he will give it back the amount to the seller. Now see, for the services which is rendered by the agent, the manufacturer or the seller, the consignor, will pay him certain consideration. That consideration we call it as commission. So the agent, for his services, he will get consideration in the form of commission. Okay. Now it is like instead of me, on my behalf, some other person I have appointed, and that person will make an effort to sell the goods. Now, one more important thing, sir. When consignor sending the goods to consignee, he will send one document called pro forma invoice, because he cannot issue normal commercial invoice. It is not a sale, direct sale. So he will issue pro forma invoice. What is this pro forma invoice? This pro forma invoice is like a document invoice which contains the details of the goods sent, like value of the goods, the quantity of the goods sent, the price at which the goods will be sold. All these details will be there. Next, see, the agent will send periodically one statement to the consignor, that is called account sales. Now this account sales is a statement in which the agent will clearly mention, the consignee will mention how much worth of goods he sold, what is the amount due to him, how much is the commission still receivable by him, so what amount he already sent to the consignor. All these details will be there in the account sales. So remember, this is very, very important. Which document will be sent by consignor? Account sales. Which document will be sent by consignee? Which document sent by consignor? Pro forma invoice. Which document sent by consignee? Account sales. So this is the basics of consignment, sir. Now in this chapter, actually what we are going to learn is accounting in the books of the principal as well as the agent. That means whenever any goods are sent on consignment basis, so accounting in the books of the consignor, accounting in the books of consignee, that is what we are going to learn in this chapter. So consignor books, consignee books. Now see, so the most important part of this chapter is certain important transactions. First of all, I will explain you what are the transactions there in the consignment. Then we'll try to learn the accounting entries for consignment in the books of consignor as well as consignee. Okay. Now before going to the important things, first of all, you should understand the concept of commission. One of the special issues in consignment is commission. See, as I told you, so consignor will pay to the consignee the commission for his services. Consignor will pay commission to consignee. This commission basically is of three types. One is ordinary commission, second one is declaratory commission, third one is overriding commission. First of all, what is ordinary commission? See, for the normal services of the consignee, so like for example, receiving the goods on behalf of consignor, making publicity advertisement on behalf of consignor, and making an effort to sell the goods on behalf of consignor, and collecting the amount from the customers and sending the amount back to the consignor. So for all these normal services, consignor will pay some commission. That will be ordinary commission. Generally, this ordinary commission will be paid on gross sales made by the consignee. Next, declaratory commission. This is very, very important. Sir, what is this declaratory commission? See, for the risk of bad debts. So, what consignor will do is, he will give some commission in the form of declaratory commission, in the name of declaratory commission to the consignee. So, whenever there is a declaratory commission given by consignor to consignee, the risk of bad debts now lies with consignee, not consignor. So consignee has to take care the collection aspect from customers. If customers has not make the payment, so the risk of bad debts has to be borne by consignee. That means the moment the declaratory commission is paid by consignor to consignee, consignee has to make the payment to consignor, irrespective whether amount will be collected from the customer or not. Now that commission is called declaratory commission. Therefore, the accounting treatment will be drastically changed when there is a declaratory commission. So remember, most of the students are unable to understand. Here, for example, Mr. A send goods to Mr. B, consignee. Now he is selling the goods to customer. Now if customer makes the payment, he will make the payment to consignor, right? Suppose for example, if customer doesn't make the payment, he will not make the payment to consignor because he is just an agent who is collecting the amount on behalf of consignor. So therefore, if customer doesn't make the payment to him, he will not make the payment to him. Suppose if there is a declaratory commission, what happens is, even though customer could not pay the amount to consignee, it is the consignee who has to make the payment to consignor. Therefore, the consignor point of view, whenever he allows, he paid some declaratory commission, he always will not take, he will see consignee as the person who has to make good him the amount. Consignee has to make the payment to him. Whether the amount will be collected from the customer or not, he will not bother. Now I think you understood declaratory commission. So declaratory commission is more to do with what? More to do with what? Bad debts. So whenever declaratory commission is paid, so who will bear the risk of bad debts? Consignee. Actually, you see, there is one more commission called overriding commission. Sir, what is this overriding commission? See, generally, I told you, when consignor send goods to consignee, he will issue one document called pro forma invoice. This is not a normal commercial invoice. See, whenever we make any regular sales, we will issue commercial invoice now. Here, consignor is not selling the goods to consignee. So, therefore, it is not a normal commercial invoice. It is like a pro forma invoice where all the details of consignment is consists there. Now, in that pro forma invoice, consignor will mention the minimum selling price at which the goods are to be sold. Now suppose if the consignee makes an extra effort and he sometimes sells the goods above the price which is prescribed, then in such a situation, in order to encourage the consignor will pay him some extra amount as the consideration. Some extra amount as the consideration. So we call him as delcatory commission. Sorry, overriding commission. See here. So three types of commissions will be there. Ordinary commission. So for the regular activities of the consignee, and it is calculated on what? Gross sales, unless otherwise prescribes. Delcatory commission. See here. This is a commission that is payable for taking the risk associated with the credit sale of the goods, namely risk of bad debts and collection responsibility. It is generally calculated on gross sales unless otherwise agreed. And overriding commission, this is an extra commission which is paid over and above the ordinary commission. It is referred as special commission. So this commission is paid when the consignee manages to sell the goods above a predetermined selling price. So above a predetermined selling price or exceeds the sales target, he will pay some extra commission. Okay, so commission point also I explained. Now the most important part is accounting treatment. Now see, I think consignor books are very important, of course, but consignee books are very easy. Now listen, consignor books, that means the principal, okay, whenever he sends any goods in respect of consignment, generally what accounts he will maintain in respect of the consignment. See, first he will maintain one account relating to consignment. This is very important, sir. Consignment account he will maintain. For each consignment separately he has to maintain one consignment account. See, this consignment is like a mini P&L account. The main purpose of this preparation of this account is to ascertain the profit or loss. So generally whenever we send the opening stock, whenever we send the goods, or whenever any expenses incurred, all these will be debited. And whenever we make the sales, closing stock, we will credit. Then generally the difference is profit or loss. So see, every consignor wants to know what is the ultimate profit or loss I got. So from this consignment. So for that he will prepare consignment account. So consignment account is the first account which is maintained by consignor, and this account is a mini P&L account. Of course, for the overall business, he has to ascertain the profit or loss. For that he will prepare P&L account. But from these consignments, individual consignment accounts, he will take the profits or losses and aggregate them. Then he will get the total profit or loss of the organization. So that's why this is a mini P&L account. And what is the object of preparation of consignment account? To ascertain the profit or loss. Next, he will maintain one more account called goods sent on consignment. Third account, consignee account, is agent account, nothing but. Next, consignment stock account, because he is maintaining stock relating to consignment, so consignment stock account. Next, consignment debtors account, because when he sends the goods, agent makes the sales to the persons, right? So outside customers. So debtors, nothing but consignment debtors. So tell me, what are the 5 accounts which will be maintained in the books of consignor? Consignment account, goods sent on consignment account, consignee account, consignment stock account, consignment debtors account. Now consignee books, come to consignee books, what accounts he will maintain? He will maintain consignor account, he will maintain one commission account, because commission is his main income. Next, one more account is consignment debtors account. Why he is prepared debtors account? See, because whenever he takes delcatory commission, he has the responsibility of bad debts and collection from debtors. So therefore, when he takes a delcatory commission, definitely he will prepare debtors account in his books. So there are 3 accounts in his books, and there are 5 accounts in his books. So total 8 accounts will be there in the consignment chapter. So 5 plus 3. Okay, this point also I told. Now the most important aspect, I will tell you the entries, the most important part, one by one I will explain. Listen to me carefully. Like bills of exchange, this chapter is also, if you understand the sequence, this will be very easy. See, first of all, sir, consignor sending goods to consignee. This is obvious. Consignor sends goods to consignee. Now, next, whenever goods sent by consignor, the goods may be returned by consignee to consignor. Possible? So first we send the goods and those goods may be returned. Next, sir, sometimes what happens is advance is given by consignee to consignor. Advance, some kind of advance will be collected from consignee, like security deposits. Advance collected by consignor from consignee. If any advance paid by consignee to consignor, that is the entry we will write. And then whenever, consignor sending goods to consignee and consignee selling goods to customers, right? Now whenever there is a sales, what is the entry? So sales, either it can be cash sales or it can be credit sales. Very, very important. And in respect of credit sales, if there is a del creditory commission or if there is no del creditory commission, what is the entry? And then one more important thing, sir, I forgot. Expenses, consignor, consignee, expenses, sir. Sir, in respect of consignment, what expenses incurred by consignor, what expenses incurred by consignee, the accounting entry in respect of those expenses. And now see, consignor sending goods to consignee, right? Now suppose those goods may be subject to loss. So those goods may be lost in transit, loss in transit, or loss in consignee premises. Possible? Suppose consignor send the goods to consignee, sir. Goods may lost in transit or goods may lost in consignee premises once they reached the consignee premises. Now when there is a loss, what is the accounting treatment? And now one more thing is, suppose consignor send goods to consignee. Now at the end of the year, how to make the valuation of stock? Because unsold stock, any unsold stock with consignee, consignor stock is there with consignee. Now how to value it? And similarly, consignor sending goods to consignee, some of the stock may be in transit, stock in transit. How to value this stock in transit? And also commission. See, for the services of consignee, consignor is making the payment of commission. How to do the accounting? Now see, different entries what they will come in consignment. So first, see, there is no hard and fast rule. You can remember very easily, common sense. First, consignor sending goods to consignee. Okay, those goods may be returned by consignee. Okay, consignee gives some advance. Okay, consignor may incur some expenses. Consignee may incur some expenses. And the goods sent by consignor to consignee will be sold, either cash sales or credit sales. If there is a del creditory commission, no del creditory commission. And suppose the goods sent by consignor to consignee may lost in transit or in consignee premises. Suppose the goods sent by consignor to consignee, some of the unsold stock is there with consignee. Suppose the goods transferred by consignor to consignee, for the services of consignee, consignor has paid a commission. What is the entry? Now these are the things you have to learn in the consignor and consignee books. Now see, different situations I explained. Now we'll try to see the entries, because the entries they will see in this chapter. What is the question they will ask? They will give you, there is a consignor, he sent goods to consignee and these are the expenses incurred. Still at the end of the year, this many worth of goods are there, this many worth of goods are lost. Now this is the commission we have paid, consignor is paying to consignee. So prepare consignment account, prepare consignee account, or in the books of consignee prepare consignor account, like that they will ask. Now in order to prepare those ledger accounts, first you should know the entries. For knowing the entries, first of all you should have the background knowledge, so that I have given. Now see, you have to learn the entries in the books of consignor and consignee. For that, what transactions will come? So see here, if goods are sent at cost price. Now very important, opening stock first. You take consignor books. Now see, I told you consignor will prepare consignment account. It is like a P&L account, right? So opening stock will be debited to that. Consignment to consignment stock, like trading and P&L account. To ascertainment of profit, there are two stages, na? Trading, P&L. Now generally we'll debit to trading account. Na? Similarly, in respect of consignment, each consignment, whatever with the opening stock is there with the consignee, we will debit to consignment account. So consignment account debtor to consignment stock account. So opening stock, consignment to consignment stock. And in the books of consignee, generally no entry will be recorded. Why no entry will be recorded? Because what way he bothered, sir? He is just an agent, na, sir. The stock of the principal is there with him. He is not the owner, na. So that's why only in the books of consignor. So consignment account debtor to consignment stock account. Next, sir, I told you consignor may send goods to consignee. Whenever any goods sent by consignor to consignee, he will debit to consignment account. So consignment account debtor to goods sent on consignment. And consignee books, no entry. He is not purchasing the goods. He is just receiving the goods on behalf of consignor. See, consignee role will come only when he has taken any creditory commission for sales, credit sales. Then in his books entries will come. Commission, whenever he receives, any entry will come. Similarly, any advance given by him, entry will come. So consignee role or consignee books will be affected only in case of few entries only. Okay. So goods sent by consignor to consignee, over. Now same goods returned, same entry will be reversed. Goods sent on consignment to consignment account. No entry in the books of consignee. So therefore, see here, we completed this one. Goods sent by consignor to consignee, goods returned by consignee to consignor. Okay. Next. Sometimes I told you, na, advance received from consignee by consignor, security purpose. Any advance received? So what is the entry? Bank or bills receivable to consignee. Bank or bills receivable account debtor to consignee. So suppose the advance is received in the form of cash or bank. So bank account debit. Suppose consignor draw the bill, consignee accepted, bills receivable. To consignee account, we will credit. Because we received advance from him, right? His account will be created in our books. Now, consignee point of view, you think consignor account debtor to cash or bank account, or bank, if he accept the bill, bills paid. So advance received from consignee by consignor. Okay. So advance is also done. Very simple, na? Consignor books, whenever he receives advance, bank account debtor. If he receives bills receivable account debtor to consignee. Consignee books, consignor account debtor to bank or bills payable. Okay. Now see expenses. Expenses incurred by consignor. See, consignor will incur some expenses now. What is the expenses consignor will incur? See, consignor need to send the goods to consignee. For that, packing charges, loading charges, transportation charges, freight charges, insurance charges. All these expenses he will incur na consignor. These are all called non-recurring expenses, one-time expenses relating to these goods which are sent. So these expenses incurred by consignor. Whenever any expenses are incurred, consignment account is debited, cash or bank account will be created. So consignment account debtor to cash or bank, because these are the expenses relating to consignment. So consignment account debit to cash or bank. Now consignee point of view, when consignor incurs any expenses, consignee books no entry. So therefore, these are the expenses which is incurred by consignor. So expenses incurred by consignor is completed. Now coming to expenses incurred by consignee. Sir, I am telling in one systematic order, sir. You remember this way. So first, consignor sending goods to consignee. Same goods returned. Next, consignee pays some advance. Consignor receives the advance. Next, consignor incurs some expenses. Consignment to cash or bank. Consignee incurs some expenses. See, if consignee incurs any expenses, we know he is only an agent. Now, whenever any expenses incurred by consignee, again we have to reimburse him. We need to pay the amount to him. So therefore, we know that these are the expenses belongs to us, but incurred by consignee. So therefore, on behalf of consignment, he incurred. So therefore, consignment account debit to consignee account we will credit, because we need to make the payment of these expenses to him. Similarly, consignee point of view, he knows he is not the person who has to incur the expenses, but he incur. And these expenses are going to be reimbursed by consignor. So he will debit consignor account, cash or bank account he will credit, because from him the cash or bank going out, because he is incurring expenses, right? So therefore, the entry here is, see, consignor to cash or bank in the books of consignee. Now consignor books, consignment to consignee important, because whoever incurs, whether consignor or consignee, doesn't matter. Is it expenses of consignment? Yes, debit to consignment. If you incur directly, if the consignor incurs directly, consignment to cash or bank. If consignee incur, you have to reimburse him, na? So therefore consignment to consignee. So these are the expenses which is incurred by consignor as well as consignee. Okay, done, sir. So next, sir, sales, which is very, very important, sir. I think out of this, sales will play a major role, sir. Whatever I left in between, sir, I will come back it. Wait, next come to the sales, which is very, 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 very important. Sales, later collection, then bad debts. Because see, whenever we make the sales can be cash or credit. Cash sales we will write the entry, credit sales we will write the entry. Now in credit sales we have to see if there is a del credit commission is there or not. Now once we make the sales, we may receive the amount. So whenever payment is received, if there is a del credit commission, without del credit commission, in respect of credit sales, what is the entries? Now after that, for example, suppose if the customer has not made the payment, if there is a del credit commission, if there is no del credit commission. So because see, the del credit commission will changing the direction here. Because whenever there is a del credit commission, the consignor is not taking the risk of bad debts. Consignee is taking the risk of bad debts. That's why. So that's why you have to be very careful when you are reading the question. Is there any del credit commission is there in the question or not? Okay. Now see here one by one. First, sale of goods by consignee. See, consignee, we know we send the goods to consignee, he will make the sales. Suppose he sold the goods on cash basis for cash. Now you think you are the consignor, you send goods to your consignee, consignee made the sales, cash sales. Now who receives the amount? Consignee. Now actually I know as a consignor that it is my amount, it is there with now consignee, and the amount is collected from customers. So therefore, whenever cash sales is made, so what is the entry general will write? Cash or bank account data to sales. Here sales will be created to P&L account. Now similarly sales will be created to consignment account. So consignment account will be created. Because sales na, consignment account will be created, income. Now debit, consignee account. Because he is the person from whom we need to receive the amount. Because on behalf of us, he collected the amount. Now he has to give it back that amount. So my point of view is my debtor now, from whom I need to receive this amount which he collected from the customer when he made cash sales. Now consignee point of view, he knows that he has to give back this amount to consignor. So consignor account will be created, cash or bank account will be debited. So bank account data to consignor. So tell me, whenever cash sales is happened, consignor books what entry? Consignor knows that this amount is there with consignee. So consignee account debit to consignment account, because these are the sales which we have to credit to consignment account, because consignment account is like a mini P&L account where all incomes will be credited to it. So income, this is cash sales. Similarly, consignee books, you think consignee, he collected the amount on behalf of consignor and he has to make the payment to the consignor. Therefore, consignor account will be created. Whenever we need to make the payment to anybody now, we will credit their account. He is like our creditors. We have to make the payment to him, and bank account will be debited. Okay, done. Next, now the most important, credit sales. Listen to me carefully. Sir, I am the consignor, sir. You are the consignee. You made some sales and the sales are credit sales. Now, you have to see, is there any del credit commission or not? Suppose del credit commission is provided. So, consignor, consignee made credit sales and I am paying del credit commission. Now, you think from the point of view of consignor. Whenever he makes the sales, I have given del credit commission. Therefore, I know that irrespective whether the amount is collected from the customer or not, consignee has to take the risk of bad debts. Therefore, whenever the sales happen, what I will do is I will debit consignee account and I will credit consignment account because it is my income. So consignee to consignment account, consignee to consignment account, consignee to consignment account. And see, when the amount is received, actually credit sales made, del credit commission provided, and amount is received from the customers, will I make any entry? No, because I already debited consignee account now, because I am providing del credit commission. So why I am bothered whether customer makes the payment to consignee or not? He will take care now. So as a consignor, whenever you make the credit sales, I will debit your account in my books because I have given you del credit commission. So you are responsible. Consignee to consignment account. That's it. My point of view, thing is over. Now when customer makes the payment to you, so no entry in my books. No entry in my books, because you have to make the payment to me. You have to make the payment. So when you receive the payment from customer, I am not bothered. That's why no entry. No entry. Sir, suppose for example, when amount is received from the customer by the consignee, you said no entry in the books of consignor when declaratory commission is provided. Suppose when the customer not made the payment, then also no entry. So irrespective whether customer makes the payment or not, as a consignor, my books no entry. Because I given declaratory commission to you, you are responsible for bad debts. You are responsible for collection of debtors. So I am the consignor. I have given declaratory commission to you. So the moment you make any credit sales in my books, I will debit you. Consignee account debit to consignment. That's it. When you make the payment, I will receive cash or bank to consignee. That's it. Okay. So see, this is the sequence. First, consignee makes the credit sales, and you have to see, is there any declaratory commission? Yes. Then consignee to consignment. Over. Next, when customer makes the payment to consignee, no entry in my books. When customer does not make the payment, no entry in my books, because I have given declaratory commission to you. Irrespective of that, you have to make the payment. Now, same thing you think from point of consignee. Consignee make credit sales and he has taken declaratory commission, right? Now he knows what he knows. He knows that irrespective whether amount is collected from customer, he has to make the payment to consignor. So therefore, whenever he makes any credit sales, what he will do is he will debit customer account and he will credit consignor account. That's why see, consignment debtors to consignor account, because he knows that he is responsible to make the payment to consignor. So consignor account is created and the customer to whom he sell the goods, he will debit. Now next, when the customer makes the payment, what entry he will write? See here. When amount is received, bank to consignment debtor. And when customer doesn't make the payment, he will treat them as bad debts in his book. See, bad debts to consignment debtor. And this bad debts he may set off with commission, because he is receiving commission. So important. So if you are a consignee, if you are receiving declaratory commission, whenever you make a credit sales, you will treat them as your sales, debtors to consignor. And when the payment is received from the customer, bank account debtor to debtors. When payment is not received, bad debts to debtors. And whenever you make the payment to consignor, you have to make the payment to consignor because you have taken declaratory commission. Consignor account debtor to cash or bank. And this bad debts you may adjust with commission. Now this is when declaratory commission is provided. See, are you understanding the sequence? When declaratory commission is given, consignor, consignee. When consignee make the credit sales, what entry consignor will write? Consignee to consignment. When amount is collected from customer by the consignee, no entry in my books, because I have given you declaratory commission. I am not bothered whether customer make the payment to you or not. Now when the customer doesn't make the payment, no entry. Now come to consignee point of view. Whenever he makes any credit sales by taking declaratory commission, he knows that he has to make the payment to consignor, irrespective whether amount is collected from consignee customers or not. So therefore, when he makes the sales, he will write consignment debtors to consignor. Next, when the payment is received from customer, bank account debtor to consignment debtor. And when there is a bad debts, amount is not collected, bad debts to consignment debtors. And this bad debts he will adjust with commission. Now suppose consignee make the credit sales, but declaratory commission not provided. Now you tell me, when declaratory commission is not paid, the risk of bad debts lies with whom? Consignor. Now whenever any sales made by, credit sales made by consignee, as a consignor, I knows that I have to take the responsibility of bad debts. Therefore, whenever he makes the sales, as if I made the sales, I will write the entry. Therefore, customer account debtor to consignment account. When there is a declaratory commission, consignee account I debited. But when there is no declaratory commission, I will directly debit customer account. So consignment debtors to consignment. Suppose when the amount is received from customer, who will receive? Consignee will receive. Then from consignee, consignor will receive. So as a consignor, if the amount is collected from the customer by the consignee, what I will do? From consignee, I need to receive the amount. Therefore, consignee account will be debited. Consignment debtors account I will close. Because when I made the sales, so consignment debtors to Consignment I have written now. Now when the customer makes the payment, consignee received the payment, so from whom I need to receive the amount. So consignee to consignment debtor. Now suppose customer doesn't make the payment, it is my bad debt. So what I will do is consignment account I will debit. These are my bad debts. I have to take the bad debt. So consignment account, debit all expenses and losses. Consignment debtors account will be created. I think you understood the sequence. So as a consignor, if I have not given any delicate commission, you made credit sales. So consignment debtors account debtor to consignment account. Sales will be credited to consignment account. Income. Consignment debtors account will be debited. Later on when customer makes the payment, you received the payment. So from whom I need to receive the amount. So consignee to consignment debtors. Suppose customer not make the payment, bad debts, consignment account debtor to consignment debtors. Now think from consignee point of view. Very, very interesting, sir. Consignee point of view, if he has not received delicate commission, sir, as a consignee, I am not at all writing any entry when I make the sales, because I made sales on your behalf and I am not receiving any delicate commission now. So I am not bothered. Only when the customer makes the payment, I will make the payment. I will collect and make the payment. I will act as an agent to you. To no entry. When customer makes the payment to me, I know I have received the payment, I need to give it back. So therefore, whenever delicate commission is not there, when payment is received from the customer, bank account debtor to consignor. And if bad debts came, no entry. Because I will collect the amount, I will give it to you. If there is no delicate commission. If there is a delicate commission, I have to take the responsibility. But if there is no delicate commission, whenever I make the sales, I know that I am not responsible. Therefore, in my entry, no entry will come in the books of consignee. Later on, when I receive the payment on your behalf, so generally bank to consignor, and when I give it back, consignor to bank, reverse entry will be written. Suppose bad debts, amount is not collected, I am not bothered. So that's it. So this is the concept of sales. This is very, very important. See it once carefully. Very easy only. So therefore, we have completed this sales also. Now, next what happens? See, sometimes in another important topic in consignment is loss of goods. See, the goods which is sent by consignor to consignee may be lost. So the loss is two types: normal loss, abnormal loss. The normal loss, sir, ignore. What is normal loss? See, because of the natural characteristics of the product may lose its value because of evaporation, because of any other reason. So the perishable items. So any reason, see here, the loss basically is of two types: normal loss, abnormal loss. If there is a normal loss, ignore. Abnormal loss, recognize separately. Okay. Now, as far as the loss is concerned, sir, you said abnormal loss will be recognized separately. So what is the value of the abnormal loss? See here, suppose consignor send goods to consignee, right? Now, there are two possibilities. These goods may lost in transit, or these goods may lost after reaching the consignee premises. Suppose if the goods lost in transit, what is the value of the loss? Loss is equal to cost of the goods plus consignor expenses plus consignee non-recurring expenses. So consignor send goods to consignee. Now consignee premises. So when consignor send goods to consignee, see here, the goods may lost in transit. So what is the value of the goods? Value of the loss. Suppose if it is an abnormal loss because of accident. See, what is abnormal loss? Because of the negligence, wrong handling of the goods. So avoidable losses. Unavoidable loss is normal loss. We can't do anything. Therefore, ignore it. Don't recognize it separately. But for abnormal loss, you have to recognize. Now, important thing is, in case of abnormal loss, you have to recognize the loss. What is the loss? The cost of the goods plus consignor expenses plus consignee non-recurring expenses. Actually, the expenses incurred by consignor always non-recurring. The expenses incurred by consignee can be recurring or non-recurring. What is this recurring and non-recurring, sir? See, very simple, sir. What is recurring and non-recurring means? Suppose if you are incurring expenses regularly, more than one occasion, that is called recurring. Suppose if you are incurring only one-time expenses, non-recurring in nature. See, for example, very simple, when consignor send goods to consignee, First, suppose he send the goods to one place. From here, consignee has to take the goods to his premises. For example, goods are coming from Mumbai. Suppose the goods came from Mumbai to Vizag port, for example. From Vizag port, suppose the goods has to be taken to some other place, for example, Vijayawada. This has to be taken to Vijayawada. Now see, consignee premises is in Vijayawada. Now see, first the goods will be sent from Mumbai to Vizag port, right? Now, to send these goods till here, the expenses incurred by whom? Consignor. Consignor non-recurring expenses like loading, transportation, insurance, he will incur. Now, from Vizag port to the goods must be taken to consignee premises. For that, consignee has to incur some expenses. Now, consignee also incur freight expenses, insurance expenses. So, what is that? Loading charges. Okay, or taxes. He may pay some taxes. So, clearance charges from the port, or he may pay customs duty. Whenever he imports something from the foreign countries, he has to pay customs duty. All these expenses he will incur at the time of clearing the goods, or at the time of taking these goods from this place to his premises. Those are called generally non-recurring in nature, because they will be incurred one time in respect of these goods. Will you clear the goods 10 times? No. You cleared all the goods and you paid some clearing charges. Suppose you transported these goods to vehicles, so transportation charges, insurance charges, transit insurance, like that. Now, once goods reach to the consignee premises, whatever the expenses you incurred, those are called recurring expenses. Like, for example, godown rent, security of the godown, or you may pay some, you appointed some sales personnel. For them, you are paying some sales commission, or you are paying some sales salaries. And for example, you are incurring some publicity expenses to sell the goods. All these expenses you incur when the goods are reached the consignee premises. Now, whatever the expenses incurred once the goods reached the consignee premises, they are called recurring expenses. Like, for example, once the goods are reached, these goods must be stored in a godown. So, for that, expenses, the maintenance of the godown, the maintenance of the establishment. Now, you are paying salaries to the staff. So, for example, this godown rent you have to pay. For example, you appointed a sales personnel, for that sales promotion expenses, sales commission expenses, all these things you have to incur. So, these things will be recurring expenses. Now, always remember, when you are calculating the loss, don't consider the recurring expenses of consignee. Only non-recurring expenses which is incurred by consignee will be considered. When goods are lost in consignee premises. When goods are lost in consignee premises, see, I have given here, see. Loss of goods, normal loss, ignore. Abnormal loss. See where goods are lost, in transit or in consignee premises. Suppose goods lost in transit, then what is the loss? Cost plus consignor expenses. Don't take consignee expenses because goods are not reached the consignee premises. The goods are lost in transit. Now, suppose the goods are lost in consignee premises, then what is the loss? Cost plus consignor expenses plus consignee non-recurring expenses. That what is non-recurring expenses? Before reaching the consignee premises, whatever the expenses he incurred for transportation of the goods, freight of the goods, unloading charges, loading charges, taxes he paid, import duty he paid, all these things. All these things he will record. Right? Okay. Now, this is the loss, sir. See, whenever there is any abnormal loss, I said you have to recognize separately, na sir. How to recognize abnormal loss? In transit or in consignee premises, whatever. I told you how to calculate the loss. Suppose in transit, cost plus consignor expenses. In consignee premises, cost plus consignor expenses plus consignee non-recurring expenses. Recurring expenses, repeated expenses like godown rent, salaries to staff, sales commission, publicity expenses, maintenance expenses of the establishment. These things you should not include, please. Non-recurring, one-time expenses like loading charges, transportation expenses, insurance expenses to bring these goods to his factory, his place. So, whenever there is an abnormal loss, sir, what entry consignor will write, sir? Because he knows he has sent the goods. So, goods and consignment to goods and non-consignment. Out of that goods, some goods lost. So, therefore, he will credit consignment account. When he send the goods, consignment account is debited. Consignment to goods and non-consignment. Now, consignment account is created because the stock has been reduced and it will be debited to abnormal loss. The abnormal loss to consignment. Now, Suppose if there is insurance, we receive insurance premium. Suppose for example, in respect of these goods, if there is insurance, we'll receive insurance premium. When we receive bank account debit to abnormal loss. Sometimes insurance company will admit the claim, but amount is not received. Then insurance claim account debtor to abnormal loss. Okay. Next. Suppose sometimes what happens, if the loss is happened in consignee premises, insurance claim is received by consignee. So from consignee, we need to receive the amount. So consignee account will be debited. And the balance loss will be debited to P&L to abnormal loss. See, you understood? I will tell once again. See, suppose your abnormal loss is 10 lakhs here. You will write abnormal loss to consignment, right? You value the abnormal loss. How to arrive this 10 lakhs? I told you. Okay. Now after that, suppose this 10 lakhs given by insurance company. Simple 10 lakhs bank to abnormal loss. Over. Suppose for example, this is not given by insurance company. Admitted, just not realized. Therefore, insurance claim to abnormal loss. Suppose for example, insurance company admitted or the amount is received by consignee to abnormal loss. Suppose sometimes what happened, insurance company may not admit total amount. For example, you received only 8 lakhs out of 10 lakhs abnormal loss. Now remaining 2 lakhs you debit to P&L account. And what is the entry for abnormal loss in the books of consignee? No entry. And when abnormal loss, there is an insurance, and if that insurance premium is received by consignee on behalf of consignor, then consignee will write bank to consignor because he has to give it back to the consignor. So tell me, loss can be two types: normal, abnormal. Loss, when consignor send the goods to consignee, the loss may happen in transit or in consignee premises. In transit, if it happens, cost plus consignor expenses. If happened in consignee premises, cost plus consignor expenses plus consignee non-recurring expenses. And whenever there is an abnormal loss, what is the entry? Abnormal loss to consignment account will be created. Consignor. Now see, in respect of this abnormal loss, if there is an insurance claim, insurance is there, and you receive the payment, bank to abnormal loss. If there is an insurance claim to abnormal loss. Suppose consignee to abnormal loss. If the amount is received by consignee on behalf of consignor. And whatever the amount is not lost, amount not admitted by the insurance company, that is transferred to P&L. So this is one concept, sir. Over. Now, one more important concept in consignment is, see, so I have told you this transit. This is also I completed. Okay. Now, valuation. See, this is also very, very important, sir. At the end of the year, the consignor send goods to consignee. Out of that stock, some of the stock may be unsold. Now we have to treat that stock as the consignor stock and we will credit to consignment account. Now first of all, for that we need to make the valuation, right? So how to value the unsold stock laying with consignee? Same manner how we have valued abnormal stock, same manner. You see, value of stock. Suppose sometimes the stock is in transit at the end of the year, some of the stock is there with consignee. Suppose if the goods is in transit, same. What is the cost of the goods? Plus consignor expenses you take. Don't take consignee expenses because the goods not reached the consignee premises. Suppose if the goods are there with consignee, take the cost, consignor expenses, consignee non-recurring expenses you take. Non-recurring, one-time expenses. Some students are confusing. Sir, what is this non-recurring? One-time expenses, non-recurring. Sir, what is one-time expenses? When consignor send the goods, on that goods, you incur only one-time expenses. Like for example, you load them into the trucks, you pay insurance, freight, customs duty, clearing charges, any local taxes. These are one-time expenses in respect of that goods. Now, once reach the premises, you have to again and again incur some expenses like go down rent. Every month you have to pay in respect of these goods. Suppose if you store them, you appointed a security personnel for them you are paying some salaries. You appointed a salesperson to sell these goods. You need to pay commission, sales, wages, salaries. All these are again and again we are non-recurring. So don't consider non-recurring, only recurring expenses. Non-recurring expenses you consider. So same manner how you have valued the goods, loss, same manner stock will be valued in respect of consignment. Now suppose closing stock. Suppose the goods are there with consignee. So what is the entry will write? So we will credit to consignment. So consignment stock to consignment. That's it. And closing of goods sent on consignment account. Now the most of the entries are over. So major thing is over, sir. See here, valuation also we completed. Now the remaining entries. So what are the entries we have left? See, for example, at the end of the year, when we send the goods, what is the entry? Consignment to goods sent on consignment. Now, how to close this goods sent on consignment? By transferring to purchases or trading. No entry in the books of consignment. Now, finally, we get the profit on consignment. The profit will be transferred to P&L account. Because I told you consignment is a mini P&L account. No entry. And final remittance received by consignor from consignee. Final amount, any balance to be received from consignee. So bank or bills receivable account debtor to consignee. Consignee point of view, consignor account debtor to banks or bills payable. Anything we left out, sir? Commission. Whenever commission is payable by consignor to consignee, consignment to consignee. Consignee point of view, commission is his income. So therefore consignor account debtor to commission. Because from consignor we need to receive the commission. So consignor account is debited, commission account is his income. So nominal account credited. Now sometimes the goods in transit at the end of the year, stock of goods. So consignment account is created. Goods in transit to consignment. Sir, if you understand logically, sequence, I will tell you once again how to master consignment. Very simple. First of all, consignor, consignee, two parties. Consignor books, what accounts will maintain? Consignment, goods sent on consignment, consignment, consignee account, debtors, consignment stock, 5. Consignee books, consignor account, commission account, and then what is that? One more account we will maintain, sir, in respect of consignee. Consignment debtors account. Now, think sequentially. First, opening stock will debit to consignment account. No entry in consignee books. Now, first goods sent by consignor to consignee. Next, goods returned by consignee to consignor. Next, advance received from consignee. Next, expenses incurred by consignor. Expenses incurred by consignee. Sequentially. Next, goods sold by consignee. Cash sales. Credit sales sold with the delcreditory commission. Then payment received. Payment not received. Now, credit sales. Delcreditory commission is not there. And payment received. Payment not received from the customers. Now next, goods sent by consignor to consignee and those goods lost. Normal, abnormal. Normal ignore, abnormal recognize separately. How to value? Goods may lost in transit, goods may lost in consignee premises. If it is lost in transit, cost plus consignor expenses. If it's lost in consignee premises, cost plus consignor expenses plus consignee non-recurring expenses. Okay. Next, any valuation of stock. At the end of the year, any stock is consignor stock is there with consignee, we have to make the valuation. That stock may be in the transit or in the consignee premises. If it is in transit, like how we have made valuation of abnormal loss, same manner, cost plus consignor expenses. If it is there with consignee, cost plus consignor expenses plus consignee non-recurring expenses will add. Now commission. Then finally closing stock entries, close it, P&L account, consignment account, you close it, transfer the balance to P&L account. I think that's it, sir. So what you need to do is, you have to listen to this entire concept, 50 minutes came, you listen to it 2 or 3 times. Then solve the questions. Consignor books, consignee books, take the study material, 2 or 3 questions you take and solve it. That's it, more than sufficient. So without understanding the concept, don't try to solve the questions because no use. So spend some time on the concept. At least a question came in exams, you can able to attempt it. Suppose if you don't know the concept and you have solved 1 or 2 questions and even without understanding any logic, so in examinations, you are not, whatever you do, you will not get any marks. Suppose you read all these entries, some entries you remember, and if you at least try to certain extent, I think you will get marks. So this is the way to prepare the subject. Now you listen to it quickly and then solving the questions on your own. Okay, that's it. This is consignment. Now the next chapter for discussion is joint venture, accounting for joint ventures. So in this chapter we are going to learn the accounting treatment in case of a joint venture. First of all, what is a joint venture? See, for a particular venture. Venture means a project. To do a particular project or to execute a particular project, two or more parties together, combinedly join together to execute this particular project. That is called joint venture. For example, there is a project and A, B. Now these two persons came together to execute this project. Now see, they temporarily for execution of this project join together. Once this venture is over, this project is over, their business will be, individually they will do their businesses and this venture, this project will be completed. Now see, when the amount involved is huge, and when you require technology, when you require any kind of skills, multiple skills required to execute a project, and you don't have that skills, or you don't have that much money, or you don't have the technology, then what you do generally, you will collaborate with the persons who have the technology, who have that skill sets, or who can contribute the amount. Now it is very obvious these days people will do multiple projects, so with the different people or the different business entities together. So ultimately these two people be here together, they are doing this venture. Now whatever the profit or loss they have generated, they will share. It's like partnership firm only, but the basic difference between the partnership firm and joint venture is, see, in case of a partnership firm, so this partnership firm, so it will do business in the name of the partnership firm, and it is like a going concern entity. But it is not so in case of a joint venture, because they join together only for the particular venture or for the particular time period. Once this venture or project is completed, their business will be dissolved. Then there is no more joint venture. So suppose, for example, project may be for 6 months or maybe for 1 year. So it will get completed and this will be over. Now see, we are not bothered about what is joint venture. Anybody can understood what is joint venture. Two or more people together, they are doing one project, is called joint venture, simply. Now see, what is the accounting treatment in case of joint venture? See, in case of a partnership firm, there are partners, but in case of joint venture, we call them as co-venturers or joint venturers, whatever, co-venturers or joint venturers. Now these are the persons who contribute the amount, who purchases the goods, who try to make the sales on behalf of joint venture. Now we have to learn the accounting treatment in the books of co-venturers, or we have to learn the accounting treatment for joint venture. See, in case of consignment, we have prepared consignment account. Na? Why we prepared consignment account? The ultimate object behind consignment account is to ascertain the profit or loss. Similarly, in case of joint venture also, we need to ascertain the profit or loss, because that profit or loss we must share to the co-venturers, joint venturers. So how to make the accounting? See, first of all, what is joint venture? I told you joint venture is a short-term business, short-term, jointly by two or more persons who share profits and losses in agreed ratio with a temporary form of business organization. So where the project involves high risks, higher investments, and even they demand multiple skills, generally joint ventures will be formed. So when two or more people having requisite skills sets come together to form a temporary partnership, that's where we call them as joint venture. And the person who agreed to join together are called co-venturers or joint venture. So these characteristics, difference between joint venture and consignment. So all these things, theory, very easy. Now, the most important thing is the methods for recording joint venture transactions. This is very, very important. Listen to me carefully. Sir, how to do the accounting for joint venture? See, there are basically two types of methods. One method is maintain separate set of books. Separate books you maintain for joint venture. For each venture, whatever you are doing, separate books you maintain. Separate books are maintained for joint venture. Second method is no separate books. Separate books you are not maintaining. Suppose if you are not maintaining separate books for joint venture, then who will maintain? Co-venturers will maintain. Now co-venturer keeps record of all transactions. Co-venturer will record only of its own transaction. So in second method, there are two possibilities. We are not maintaining separate books for joint venture. Okay, then each co-venturer will maintain record of all transactions. Or each co-venturer will maintain record of its own transactions. Sir, why we are not maintaining separate books, sir? See, in case of big joint ventures, the amount is high, so the project size is huge, then generally we will maintain separate books of account. Suppose if there is a small joint ventures, then it is not that much advisable to maintain separate books of accounts. They don't maintain. Why we want to waste our resources? Then in such a situation, the co-venturer itself will keep record of all transactions, or each co-venturer will maintain record of its own transactions. This is important, sir. You understood the difference. Each co-venturer, see the word is each. Suppose there are two co-venturers, means both has to maintain the records. In first case, they will maintain record of all transactions, not only the transactions which they have undertook for joint venture, but any transactions which is undertaken by other co-venturer will also be recorded by them. But in case, some cases, one possibility is the co-venturer will maintain record of his own transactions only. He will not maintain records in respect of transactions which is undertaken by other co-venturer. Okay, so understand, tell me what are how many methods are there in respect of accounting of joint venture? Two methods. What are the two methods? First, separate books are maintained for joint venture. Now we will see the separate books. Suppose, sir, when you maintain separate books for joint venture, the ultimate object is to ascertain the profit or loss of the joint venture. Like why we prepare consignment account in consignor books? To ascertain the profit or loss. Right? Similarly, for joint venture, what is the profit or loss of this venture? For that, we need to prepare joint venture account. Ultimate object is to this. Now, when separate books are maintained for joint venture, three accounts will play a major role. Like in consignment, consignor books, we will maintain consignment account, goods sent on consignment account, consignment stock account, consignment debtors account, like that, consignee account. Similarly, when separate books are maintained for consignment, three major accounts. One is when separate books are maintained for joint venture, three major accounts will be maintained. What is that? Joint venture account, joint bank account, then co-venturer account. See here, these are the three accounts will be maintained. I will tell you the purpose of each account. See, joint venture account to ascertain the profit or loss of joint venture. Joint bank account to record all the transactions involving cash relating to joint venture. Co-venturer account, the transactions done by the co-venturer with the joint venture. To record those transactions, we will maintain co-venturer account. Now see, joint venture account, it is like profit and loss account, where we will debit all expenses and losses, credit all incomes and gains. You will get profit or loss. But here one important thing is, irrespective of the nature, see generally we debit to P&L account all revenue items, but in case of joint venture, revenue as well as capital, whether incurred by the joint venture directly or whether incurred by the co-venturer on behalf of joint venture, whatever we will record it. See here, this is very, very important account. Debit all expenses paid personally by the co-venturers or out of the joint bank, irrespective of its nature, capital or revenue will be recorded. In credit side, all sales, all incomes will be recorded, and the net result will be either profit or loss. So joint venture, two parties together executing a project. Separate set of books are maintained. When the joint venture is huge in size, big, it involves huge amount. Now, when you maintain separate books, first joint venture account will maintain. Joint venture account, it is like a P&L account. So we'll debit all expenses and losses, credit all incomes and gains, irrespective who incurs and irrespective of the nature of the payment. And joint bank account, it is like a cash book where all cash related transactions will be recorded. Whenever we receive any amount, debit. Whenever we make the payment, credit. Co-venturer account, all transactions with co-venturers. Co-venturers' personal accounts are maintained to record the transactions relating to co-venturers. It is like a capital account in case of a partnership firm. Capital brought by partners, any amount withdrawn by the partners, expenses incurred by the partners on behalf of partnership firm, like that. Okay. So tell me, what are the three major accounts we will maintain in respect of joint venture, in respect of separate books of accounts? Joint venture account, joint bank account, and co-venturers account. Now look at the accounting transactions. Separate books we are maintaining na. First, contributions made by co-venturers. It is like a capital brought by the partners. Suppose tell me, in case of partnership firm, when the capital is brought by partners, what is the entry? Cash or bank account data to capital na? Right? Cash or bank. Here in place of cash, we will write joint bank account because we are maintaining a separate account na? Joint bank to record all cash transactions. So joint bank account data to, instead of capital account, you write co-venturer account. Co-venturer means the person, the partner. In case of partnership firm, in case of joint venture, we call him as co-venture. So joint bank account data to co-venture account. Very simple. Similar to partnership firm. Next, any expenses paid or goods supplied by the co-venturer from private account. Sir, suppose any goods, any expenses paid by co-venturer for joint venture, any goods supplied by co-venturer. Now, what is the entry we will write? We know that expenses, whomsoever it is incurred, it is debited to joint venture. So joint venture account will be debited. And who will be created? Co-venturer, because co-venturer is incurring expenses on behalf of joint venture. So joint venture account data to co-venture account will be created because he incurred the expenses on behalf of joint venture. So joint venture has to reimburse him the payment, like that. So joint venture account debit to co-venturer account. Now, expenses paid through joint bank account. Suppose if expenses paid directly from the bank account of the joint venture. So joint bank account data to cash or bank. So sorry, not joint bank, joint venture to joint bank. Your bank balance will reduce and joint venture account will be debited, irrespective of the whosoever incur, either directly from joint bank account or by the co-venturer. So you see, if the expenses paid by co-venturer also, we have debited joint venture. So that is what. So joint venture to, if it is incurred by co-venturer, co-venturer. If it is incurred from joint bank account, joint bank account. Now sales proceeds are collections. Whenever we sold the goods or whenever we make the sales and amount is collected. So joint bank account data to joint venture account, because it is an income now, it will be credited to joint venture account. Now, if any assets taken over by the co-venturer, the joint venture account, see, assets taken over by the co-venturer for the joint venture assets taken by the co-venturer. You tell me, when the assets are taken by the co-venturer and these are belongs to joint venture, so joint venture account will be created, co-venture account will be debited, because from whom we need to collect. Similarly, liabilities may be assumed by the co-venture, joint venture to co-venture. So see, the transactions are happening between joint venture and co-venturer, you see. And finally, we will get profit. So if you see joint venture account, what we have debited? What we have debited, sir? Expenses. May be incurred by co-venturer, may be incurred from joint bank account, may be incurred assets taken by co-venturer. Sorry, not this one. Liabilities taken by co-venturer. And this side, by co-venturer, any amount collected, any amount directly collected, joint bank. And this one, assets taken over, co-venturer. And finally, we will get profit or loss. So debit side all expenses, losses, credit side all incomes and gains. And finally, profit or loss. This profit, if it is a profit, it will be credited to co-venturer, joint venture to co-venturer. If it is a loss, same, it will be debited to joint venture. And final settlement we will do, co-venturer to joint bank. Any amount due to the co-venturer, so we'll make the payment, co-venturer account data to joint bank account. So total 10 entries are there, Nana. Very, very simple. When separate set of books are maintained, these are the things we have to write. So when separate set of books are maintained, 3 accounts will be maintained, each one for joint venture, one for joint bank and co-venturer. So whenever any contribution made by the co-venturer, joint bank account data to so co-venturer account. Any expenses paid by the co-venturer, joint venture to co-venturer. Any expenses paid through joint bank account, joint venture to joint bank account. Any sale proceeds or collections, so joint bank account debtor to joint venture account. If collections received by co-venturer, co-venturer to joint venture account. If assets joint venture taken over by the co-venturer, so co-venturer to joint venture. If liability is taken over, joint venture to co-venturer. And finally profit, joint venture to co-venturer. If it is a loss, co-venturer to joint venture. And final settlement, co-venturer to joint bank. So like this we have to learn. So this is when separate books are maintained. So if you see the study mats here, same thing we have discussed. Separate books are maintained for joint venture. 3 accounts: venture, bank, co-ventures. And see, once you immediately 15 minutes time it has taken for me to explain this method. Once you listen to that and go to the study material, immediately solve illustration 19, 20. That's it. The only 2 problems are there. This is the way you have to learn the things. Okay. So you quickly listen the concept, try to solve the questions. Then don't waste your time much thinking about too much. So just listen, and then because you don't have that much time now, so you listen to the concept and try to solve the question quickly. So this is one method, sir. 2 questions are there. So solve these 2 questions. Now next, sir, you said separate books are maintained. These are the things. Easily we by preparing joint venture account, we can ascertain the profit or loss of joint venture. Suppose if the joint venture is small in size, like see, I will show you. When the size of the business is small and it is for very short period of time, then they will not maintain separate set of books. In this case, all co-venturers will have the account for transactions in their books. Here no joint bank account is opened and co-venturers do not contribute in cash. See, when the project is so small and it is for very short period of time, generally co-venturer himself, they will maintain the records. And whatever the goods which is supplied by them out of their stocks and expenses for joint venture are also settled in the same way. So whatever the stocks, whatever the expenses they incurred on behalf of joint venture, they will maintain the records. See, in this I told you there are 2 possibilities. When the for example, when separate set of books are not maintained for joint venture, means so each co-venturer will maintain its own record. So they are incurring expenses now. So what is the need of having a joint bank account? Suppose when you want to maintain a separate recording, then you will open a joint bank account. So there you will write all expenses relating to joint venture. Whatever the payments you made, you will record. But here every co-venturer will incur the expenses. Whatever the share of his expenses, he will incur. Whatever the purchases he want to make, he will make the purchases. And finally we will see which account, whose account has to be settled, it will be settled. So here see, there are 2 possibilities. Each co-venturer keeps record of all transactions, not only the transactions which is entered by him, but the transactions which is entered by other party also he will record in his books. Sir, generally in this situation, sir, what co-venturer will do is he will prepare 2 accounts, sir. One is joint venture account, another is other co-venturer account. And in this method what happens is each co-venturer will ascertain the profit. Because they are maintaining record of all transactions now. So see here, each co-venturer will take into account all transactions that is done by himself and by the other co-venturer. Now what are the accounting entries generally will come? For example, there are 2 co-venturers, A, B. Now see, suppose A incurred any expenses paid by A or goods supplied by A for joint venture. Now in such situation, what is the entry he will write? He will debit to joint venture account. Joint venture account debtor to purchases, because he made purchases paid by A. Goods are supplied by A. In order to separate his own purchases from joint venture purchases, he will debit to joint venture account, joint venture to purchases and to cash or bank. These are the expenses he paid. These are the purchases he makes. So in case each co-venturer is maintaining separate records for his all transactions, in such a situation, whenever any expenses paid, any purchases made by the joint venturer, what we will do? We will debit joint venture account. So joint venture account debit to purchases to cash or bank. Now joint co-venture B point of view, think other co-venture. Whenever any expenses paid by co-venturer, he will maintain the transaction also. He will also maintain the record. And what he will do? Joint venture account debtor to co-venturer A account. Because these are the expenses, these are the purchases made by A na. So he will also think these are the expenses relating to joint venture. So joint venture account will be debited, but credit is given to A in his books. Similarly, expenses may be incurred, purchases may be made by B. Now in that case, B books, what is the entry? Joint venture account debtor to purchases to cash or bank. A books, same, joint venture to B. B account will be created because he incurred the expenses. Now sometimes any advance is given by A to B. Suppose, imagine a situation, suppose if advance is given by A to B, or B may also can give advance to A, or bill accepted by A. So any advance is given by A to B. For example, advance is given by A, one co-venturer to another co-venturer. So what is the entry we will write in the books of co-venturer? So suppose for example, A books, A has given advance to B. So B account will be debited to cash or bank account. So this is the advance given. So when advance is given from co-venturer books, cash is going out, sir. So cash or bank account will be created. B account, whoever receives, that person account will be debited. And suppose for example, advance may be given in the form of bills acceptance also. For example, B raised the bill, A accepted it. So A point of view, B account debtor to bills payable. So either advance may be in the form of cash or in the form of bills. Now think from B point of view, when he receives any advance, cash or bank account debtor, bills receivable account debtor, if advance is given in the form of bills receivable to A account. See, like this, for every transaction, each co-venturer will maintain record of all transactions. Next, when sale proceeds are received by A, for example, there are sales happened for joint venture. Now that amount is received by venturer, one co-venturer A. Now this will be credited to joint venture. In the books of A, see, we are writing entries in the books of one of the co-venturer. Co-venturer received the amount for sales for joint venture. So cash or bank account debtor to joint venture account. Now B books, same joint venture account will be created because whenever there is a sale, whenever there is a sale process, definitely it's an income. But who collected it? A. So therefore joint venture, A account debtor to joint venture. Next, when sale proceeds are received by B, same. In B books, cash or bank account debtor to joint venture. In A books also joint venture account will be created. B account will be debited. Next, unsold goods taken over by A. This is interesting, sir. Suppose for example, A is one co-venturer, sir. Sometimes what he will do is, he will take back the goods which is unsold. He brought the goods and whatever the unsold in the joint venture, he will take back. So whenever he takes back goods in his books, the amount of, goods value will increase, sir. So goods account will be debited. Joint venture account will be created because the amount of stock remain with the joint venture will reduce. Okay. So similarly, B books, what entry will write? Same, joint venture account will be created, A account will be debited. Similarly, suppose unsold goods taken over by B. Suppose for example, whatever the stock unsold in the joint venture, that is taken over by B. Now in B books, what is the entry will come? Goods account debit to joint venture. A books, so B account debtor to joint venture. So here also joint venture account created, here also created. Understand, sir, both the books, the effect of the transaction is same. But who is incurring, depending on that, you have to change the debit or credit. Next, finally, each joint venture account will be closed in the books. Everybody will maintain their records of transactions. Suppose for example, profit on joint venture business. So joint venture account debtor to B account, whatever the profit belongs to B in the books of A, and remaining will be created to P&L account. Similarly, in B books, when he close the joint venture account, whatever the profit belongs to A, so that will be created, and his share of profit will be created to P&L account. And for loss on joint venture, suppose if there is a loss, same treatment. So like profit, losses will also be transferred. Now after closure of the business of joint venture, the co-venturer who received surplus cash will be remitted to the other co-venturer. Now ultimately, once the project is completed, we will see which co-venturer has received surplus cash. Now that person, he will contribute to the other co-venturer. So like this, each co-venturer will maintain a separate, will maintain record of all transactions. Now tell me, in case when separate set of books are not maintained and each co-venturer will record all transactions, how many accounts will be maintained? 2. Joint venture, co-venture. Joint venture, co-venture. Joint venture main purpose is to ascertain the profit or loss. To ascertain the profit or loss. Now, immediately after this, see, each co-venturer will record all transactions. 21, question number 21. See here, if you see this joint venture account, Mukesh account in the books of Anil, joint venture account, Anil account in the books of Mukesh. So that means in Anil books, he is one co-venturer. They are asking joint venture account, Mukesh, other co-venture account. That means this is definitely each co-venturer books. Co-venturer books, you see, separate books are not maintained. Co-venturer books, he is recording everything. So that the moment you see, you should understand which method is this. That's why I'm telling, when separate books are maintaining, generally which accounts? Joint venture account, joint bank account, co-venture account. When separate set of books are not maintained, there are two possibilities. Each co-venturer will maintain record of everything. Then in such a situation, each co-venturer will maintain joint venture account and co-venture account. So in this problem, they have asked like this. Immediately listen to this. So solve question number 21. And I think one more question is there, 22. Simple questions. You solve them. More than sufficient. And come to the last situation, sir. Sir, sometimes what happens is, the co-venturer, in the last situation, he maintains record of everything, na sir. But here, he won't maintain everything. He will maintain record of his own transactions. Sir, when he maintain record of his own transactions, how he arrive the joint venture profit or loss? For that purpose, what they will do is, each co-venturer will send a statement to other co-venturer, whatever the transactions undertaken by him. So therefore, this co-venturer at the end of the year, along with the information, whatever the transactions he entered, whatever the transactions are entered by other co-venturer, together he will prepare one memorandum joint venture account. That's why this method is called memorandum method. Memorandum dummy method. Why? See, for every, till now whatever we have seen, double entry system we followed. For every debit there is a credit. But here there is no double entry system to prepare this memorandum method. Why there is no double entry? Because see, each co-venturer is maintaining his own transactions. He is not maintaining any transactions relating to other party. But at the end of the year, he wants to prepare a memorandum joint venture account to record the to ascertain the profit or loss. That's why we need to prepare one imaginary P&L account, memorandum joint venture account. Sir, okay. But in this method, what accounts each venturer will maintain? See, joint venture account he will not maintain, because I said he will prepare memorandum joint venture account at the end. See, when you can prepare joint venture account, when you know everything, you will record it, ascertain the profit or loss. That's why, see, separate books, joint venture account is there. When there is no separate books also, each one is maintaining complete records, joint venture account is there. But see, when there is no separate books, but each co-venturer is maintaining only his transactions, his record, he is not bothered about anything else, then in such a situation, joint venture account is not prepared. Then in respect of co-venturers, what account he will use? See here. In this system, the co-venturers may decide to maintain a separate memorandum joint venture account in joint books. Each co-venturer send a periodic statement of transactions effected by him for the joint venture to other co-venturer. On receipt of the above statement, each co-venturer prepares memorandum joint venture account for determining the profit or loss from the joint venture. This account is not double entry. Double entry nature. It is not double entry nature. There is no debit, credit, equal. No, because we are maintaining some transactions. That other party is maintaining records for his transactions. At the end, he is sending the statement. Both we are recording in our books. For using both, we are preparing memorandum joint venture account. And the co-venturer will keep an account. See, what co-venturer will do is, he will keep only one account in this method, that is joint venture with co-venturer, wherein all transactions done by him only are recorded, not the transactions affected by other co-venturer. This account is useful for the final settlement. So I will tell you this chapter in 2 minutes. First, two parties or two or more parties together for one venture. How to maintain the account? Simple. Separate books. Okay. Basic object is to ascertain the profit or loss of joint venture. When there is a separate books, prepare joint venture account. Ascertain the profit or loss. Joint bank account you maintain to recording all cash transactions. Co-venturer you maintain. You should know how much amount is due from the other co-venturer or how much amount is receivable. Over. Separate books. No separate books. When the joint venture is small, don't make an effort to make separate books. Don't waste your resources. Then in such situation, two possibilities. Co-venturer, all transactions he will record. When he himself recording everything, definitely he will prepare joint venture account because he all records is available. And co-venture account you maintain. You will get the profit or loss. Suppose co-venturer recording his own transactions. This is the problem. When he maintaining his only transactions, he cannot prepare joint venture account. Therefore, we will add a memorandum word. Memorandum joint venture account he will maintain after receiving the statement from the other party. Because we are maintaining record of only our transactions. So they will ask in MCQ also, memorandum joint venture account, when will we prepare? When there is no separate books and each co-venturer will maintain his own transactions. Then such a situation, at the end of the year, he will receive statement from other party for the transactions which other party entered. For that, we will prepare memorandum joint venture account. Very simple. Now, see, here, in this case, last case, what he will do is, this fellow, this co-venturer, he will maintain one personal account, that is joint venture with other co-venturer, because he has to record the transactions now. You see, in the first two cases there is a joint venture account, whatever expenses we debit to joint venture account. But here, then in third case, when he is not maintaining other transactions, so when he is not maintaining joint venture account, how can he record transactions relating to joint venture? That's why he will open one personal account, that is joint venture with other co-venturer. See, the co-venturer will keep an account called joint venture with other co-venturer, wherein all transactions done by him are recorded, affected. Okay, now very interesting. See, I think you understood the crux, main thing about this chapter. Very simple. Okay, see the entries. Now, amount received from co-venturer in cash or check or bills receivable. Suppose, for example, in this method, I am receiving any amount from the co-venturer, either in cash or in the form of check or in the form of bills receivable. Tell me what entry I will write. Cash or bank account debit, bills receivable account debit to joint venture with co-venturer. Because all the transactions affected by him relating to venture, he will return through this account. Next, discounting of bills receivable. See, suppose other party give the bill, I have discounted with the bank. So whenever I discounted with bank, what is the entry? Bank account debtor. The joint venture with co-venture account debtor discount. See, whenever I discount with bank, discount is my loss. It is debited. So debit to where? Joint venture with co-venture to bills receivable account. Purchase of goods. Suppose if he purchases any goods for joint venture with co-venture account debtor to cash or bank. Suppose that joint venture creditor has credit purchases, means joint venture creditor. Suppose if there is a cash purchase, he will make the payment. If it is a credit purchase, he will credit to ventures creditor's account. Whenever he makes the payment, joint venture creditor's account debtor to cash or bank. And if he gives any discount, credit to joint venture with co-venture. That means all expenses and losses relating to joint venture, he need to debit or credit to joint venture with co-venture account. Because he is not maintaining joint venture account now. At the end, he will prepare memorandum joint venture account. Next, suppose goods supplied by co-venture from own stock. Suppose if he supplies any goods. So generally, when any goods supplied by the venturer to the joint venture, what we will do? Joint venture account debtor to goods sent to joint venture. Na? But in place of joint venture here, joint venture with co-venture account debtor to goods sent to joint venture or purchases. Next, when he makes any payment of expenses for joint venture with co-venture to cash or bank. When he sells any sale of goods, suppose cash account debtor, bank account debtor, or joint venture debtor's account debtor, whenever there is a credit sale, so joint venture with co-venture. So you debit or you credit joint venture with co-venture. That is the account he is maintaining in this method. Whenever there is a collection from debtors, so any discount allowed, including bad debts, so cash or bank account debtor, if it is a discount or bad debts, debit to joint venture with co-venture to joint venture debtors. And whenever he takes away any unsold goods, we are maintaining transactions in the books of joint venture, co-venture. So whenever he takes back the goods, so goods sent to joint venture, we will credit none or debit. Reverse, goods sent to joint venture account debtor to joint venture with co-venture. Now, co-venturer entitled to commission, salary, etc. When for his services, if he is able to receive any commission, that will be his income. So joint venture with co-venture account, for that point of joint venture point of it is an expense, right? So he will debit to joint venture with co-venture to commission. And finally, share of profit on joint venture. So his share of profit from joint venture. So he will credit to his P&L account and debit to joint venture with co-venture. If it is a loss, P&L account will be debited. And finally, settlement of accounts with joint venture, other co-venture. Suppose, sir, in case of a debit balance, he will receive the payment, cash or bank to joint venture with co-venture. That means when incomes more than the expenses, so he will have a debit balance, he will receive the payment. Suppose if the credit balance is more, that means the expenses losses more than that. In such a situation, in case of a credit balance, joint venture co-venture to cash or bank he will give. Okay. Now see, I think the relating to this method also we'll see one thing. We have 23, 24, two problems are there. You solve these two problems. So total there are 6 questions relating to joint ventures. So first method, separate books, maintain joint venture account, joint bank account, co-venture account. Joint venture main purpose is to ascertain the profit or losses, debit all expenses and losses, irrespective of the nature, irrespective of whomsoever incurred, create all incomes and gains, irrespective of the nature, irrespective of whomsoever incurred. No separate books, each co-venturer will maintain everything. Then prepare joint venture account, prepare co-venture account. Now, whatever the expenses we incurred, see, each co-venturer will maintain a record of transactions. Joint venture account will be debited whenever he purchases, whenever he makes any expenses. So, and whenever he receives any sale proceeds, unsold goods taken over by him, profit. Finally, the profit will be given to other co-venturer and remaining will be credited to his P&L accounts, because we are maintaining recording transactions in co-venture books. And the third method is each co-venturer record of his own transactions, memorandum method. In this method, he won't maintain joint venture account. At the end, he will prepare one memorandum joint venture account. But usually what is the account? He will maintain joint venture with co-venture. Therefore, whatever the expenses, whatever the losses, whatever the incomes, whatever the gains, everything will be recorded to this. Generally, when you make any sales for joint venture account will be created. Here, there is no joint venture. That's why joint venture with co-venture account will be created. And finally, at the time of settlement, after taking everything, his account will be settled. If he want to receive anything, I mean, finally, if he is due to receive anything, cash or bank to joint venture with co-venture, close. So finally, if he is having credit balance, he has to make the payment. So this is how we need to record the transactions in respect of joint venture. Okay. And listen to this, 40 minutes it has taken. So listen to this joint venture, try to learn the method by method. First, you learn separate books. No separate books. So very easy. It will take around 30 to 40 minutes to learn the accounting quickly. Listen to this. And then try to solve 4 or 5 questions. That's it. Over. Leave this chapter, go to the next chapter. Like that you have to solve now. Okay. Thank you. Now the next chapter for discussion is insurance claims, sir. So basically in insurance claims, what are the things we are going to learn is how to determine the claim amount in case of 2 policies. In this chapter, we are going to cover only 2 policies. I mean, there are only 2 policies are there. One is loss of stock policy. Another one is loss of profit policy. So loss of stock policy, loss of profit policy. See, first we will see loss of stock policy. See, generally manufacturers, traders will do the manufacturing, or a trader deals with stock in trade. So therefore, he will take insurance on the stock. Definitely, he will take insurance on the stock. So stock is one of the predominant elements, right? So he will take insurance on the stock. See, because of any disaster, if there is a loss of stock, how much amount we need to make the claim from insurance company? That is what this chapter is all about. How much amount we are going to ask from the insurance company. Now, if it is a loss of stock policy, sir, there are certain steps. In fact, there are 4 steps to determine the insurance claim amount. First of all, think, suppose I have a stock in my godown, a fire happened and my stock is destroyed. How much amount I am going to ask the insurance company? Whatever be the value of the stock I lost, I will ask that. First of all, I should know the value of the stock now. For example, sir, what is the worth of stock you lost? 10 lakhs, sir. Okay, you ask insurance company 10 lakhs. Sir, 10 lakhs worth of stock is there, but out of 10 lakhs, 3 lakhs we have saved, sir. Only 7 lakhs lost, sir. Okay, you ask 7 lakhs. Okay, but subject to the insurance policy clauses, average clause will be there, under insurance, over insurance. So now listen quickly. Whenever there is a loss of stock policy, how much amount is the claim amount? So there are 4 steps. First step is always determine the value of stock on the date of fire. This is very, very important step. Because unless and until you don't know the value of stock on the date of fire, how can you ask insurance company, this much is my claim, this much is my loss? First of all, you should have an idea, na? What is the value of the stock you lost? So therefore, determine the value of the stock on the date of fire. Determine the value of stock on the date of fire. Okay. Sir, how to determine the value of the stock on the date of fire? For example, fire happened on 25th June 2024. Find out the stock on that day. How much worth of stock is there in the godown on that day? Take that. So what is the value of the stock on the date of fire? Take that. Sir, suppose along with the fire, our records are also destroyed, sir. We don't know how much worth of stock is there in our godown on 25th June 2024. Then what to do? Then prepare memorandum trading account. Ascertain the value of the stock, closing stock as the balancing figure. You prepare memorandum trading account from the beginning of the year in which the fire happened till the date of fire and ascertain the closing stock as the balancing figure. That is the value of stock on the date of fire. So you prepare memorandum trading account. Opening stock you take, purchases you take, direct expenses you take, gross profit you write, sales you take, and closing stock you ascertain as a balancing figure. So on 25th June 2024, what will be the value of the closing stock? You ascertain it by preparing memorandum trading account. So see the question first. Identify the date of fire. Next, is stock, what is the value of the stock on the date of fire is available or not? If available, take that. Not available, 100% not available. So then you need to calculate by prepare memorandum trading account. Remember, see, this memorandum trading account is prepared in the year in which the fire happened. From the beginning of the year till the date on which the fire happened and ascertain the closing stock as the balancing figure. And now you tell me, opening stock okay, purchases okay, direct expenses okay, sales okay. He has to give all of these things. Now gross profit. If you want to know the gross profit, sales into GP ratio you want to know. Now this GP ratio sometimes will be missing. You have to calculate. So sometimes what he will do is, so he will not give closing stock. Now you need to prepare memorandum trading account to ascertain the closing stock. Now to prepare memorandum trading account, you should know everything, including gross profit. How will you know gross profit? Without knowing GP ratio, it is not possible, na? So therefore, sales into GP ratio. I know the sales, but what is the GP ratio? If GP ratio is not given, I need to find out. Sir, which GP ratio I need to find out? Last year GP ratio. Because current year GP ratio not possible because fire happened, na? So therefore, you need to ascertain the gross profit ratio of the previous year. What is the formula for GP ratio? Gross profit divided by sales into 100. Take the gross profit of the previous year, take the sales into 100, you will get GP ratio of the previous year. Now that GP ratio you can apply for current year, subject to current year changes. Suppose if there is any changes in the cost levels or selling expenses, then accordingly you make the adjustment of this gross profit. Okay. So this is the first step. So what is the first step in ascertaining the value of stock on the day? First step in calculation of insurance claim, ascertain the value of the stock on the date of fire. Next, determine the salvaged or saved stock. How much stock you have saved? Determine it. So when there is a fire, how much worth of stock is lost? In order to know that, first you should know the value of the stock on the date of fire. Second of all, how much stock you saved from disaster. That one. Then step 3, loss of stock. Loss of stock. Step 1 minus step 2 to take it. Then you will get the loss of stock. Once I know the loss of stock, then I can calculate insurance claim. I see insurance claim. Now here the important point, listen to me carefully. Now see, in insurance, sir, for insurance companies, there is a concept called under insurance, over insurance, or full insurance. See, when we call it as over insurance, when we call it as under insurance. First of all, if the policy amount is equal to value of stock on the date of fire. Value of stock, don't compare with loss. You should compare with the value of stock on the date of fire. So step number 1, on the date of fire, whatever be the value of the stock is there, that value of stock on the date of fire, whatever be the value, that value you compare with policy amount. If both are same, that is called full insurance. Then entire loss in step number 3 can be claimed as insurance claim. Suppose, for example, if the policy amount is greater than value of stock on the date of fire, then no problem. If the policy amount is more than the value of stock on the date of fire, this is called over insurance. Suppose, for example, policy amount, value of stock on the date of fire 10 lakhs, sir, you have taken policy for 12 lakhs. That means from insurance company point of view, your insurable amount should be 12 lakhs or 10 lakhs, but you have insured for 12 lakhs. Okay, we will not apply average clause. Therefore, whatever the insurance claim is there, whatever the value of loss of stock is there in step number 3, that will be our insurance claim. Suppose, imagine a situation, suppose if the value of the stock on the date of fire is, suppose 10 lakhs, sir, but you have taken insurance for only 8 lakhs. Then what insurance company will do is, they will apply average clause. This is very, very important. So in case of insurance policies, there is an average clause concept. What is this average clause concept? Simple, sir. They will compare insured amount, policy amount with insurable amount. Here in this case, in the insurable amount is ideally the value of stock on the date of fire, not loss of stock. Value of stock on the date of fire before reducing salvaged stock. What is the value of the stock on the date of fire? You compare these two. If the policy amount is much more than this, then over insurance. Equal to it, full insurance. Over insurance, full insurance, no problem. Whatever the loss, that will be the insurance claim. But if the policy amount is less than the value of stock on the date of fire, then they will call it as under insurance. And they will apply average clause. And proportionately, they will give the claim. Proportionately, they will give the claim. For example, see, loss of stock into policy amount divided by value of stock on the date of fire. That means 8 lakhs. Suppose you have taken 10 lakhs is the insurable amount. 8 divided by 10. That means 80% of the loss will be given as insurance claim. So this is loss of stock policy. Can you tell me? Very simple topic, sir. So loss of stock policy, 10 minutes. That's it. So first, value of stock on the date of fire. How to ascertain the value of stock on the date of fire? Prepare memorandum trading account. Ascertain the closing stock as the balancing figure. So you need to prepare memorandum trading account for the period in which the fire happened till the date of fire. And you should know the opening stock, purchases, direct expenses, gross profit, sales, closing stock is the balancing figure. Now, if you want to know the gross profit, sometimes they will give gross profit, sometimes they will not give. If they have not given, again you need to prepare trading account of the last year and ascertain the gross profit as the balancing figure. And from that you need to ascertain this gross profit divided by sales into 100. See, sometimes gross profit is given, gross profit ratio is given, sometimes they will not give. Again you need to prepare a trading account for the last year. Suppose fire happened in the year 24-25. Okay. Now you will prepare memorandum trading account for the 24-25, the beginning of the year till the date of fire. Ascertain the closing stock as a balance figure. But if you want to ascertain the closing stock as a balance figure, you should know gross profit. But you know gross profit only when you know sales and GP ratio. But you don't know the GP ratio. GP ratio will be ascertained by preparing trading account of the last year 23-24. Now that's why last year data will also be given. Last year you take opening stock, purchases, direct expenses, sales, closing stock, ascertain gross profit as a balancing figure and apply this formula GP divided by sales into 100. Then you will get GP ratio. Now take this GP ratio on sales. Then you will get gross profit. Okay, this is the first step. Second step, salvaged stock. How much stock you saved from disaster? Step number 2. Step number 3, loss of stock, 1 minus 2. Step number 4, insurance claim amount. How to calculate? You have to see over insurance or under insurance. When we say over, what are the two things we need to compare? Policy amount with value of stock on the date of hire. If the policy amount is more than the value of stock on the date of hire, over insurance. Less than that, under insurance. If there is under insurance, apply average clause. Okay, and accordingly you have to solve the questions. So in this loss of stock policy, sir, there are some very good questions are there. One question is like normal items, abnormal items. Some of the stock may, slow moving items. One question is there in the study material. You please solve that question. Okay. Next, come to loss of profit policy, sir. See, what is this loss of profit policy? I will tell you. Suppose, sir, a fire happened. Now, disaster happened in the business, accident. Immediately after disaster, definitely our business is going to be affected for certain period of time. And to bring it to the normality, it will take some time now. To resume normality, it will take some time. For example, a fire happened on 1/4/2024. And our business got disturbed up to 30th September 2024. That means 6 months time it is disturbed. Now within this period of disturbance, okay, within this period of disturbance, definitely our performance is lower than the normal period. Suppose similar period in the last year, our turnover is 10 lakhs. But this period our turnover is only 1 lakh. Why? Because already a disaster happened, and after that 6 months our business got affected. How? For example, out of 10 plant and machineries, 9 plant and machineries destroyed. Then how can you do the production? So that means happening of accident, fire is one thing. Second thing is, after the disaster, for some period of time, your business may get disturbed. Now to recover the losses from that period, whatever the profits reduced in this period, to cover that, we will take loss of profit policy. So what is the importance of loss of profit policy, sir? Now, because of disaster, sometimes our business got affected, right? So because of that effect, our profits will reduce. Now to cover that loss, we will take loss of profit policy. That means loss of profit policy will start after disaster. Suppose I have taken a loss of profit policy for 6 months. That means the policy period is 6 months. But what is the actual period of disturbance? Whichever is lower, for that period I need to make the claim. Period of indemnity. See, for example, our business got disturbed for 3 months, for example, 3 months. And we have taken insurance for 6 months. Insurance company will give claim for 6 months or 3 months, only 3 months, not 6 months. So your policy period, your disturbance period because of disaster, whichever is lower. Sir, during that period, whatever the profit lost, that will be given as insurance claim. Not only that, sir. See, this loss of profit policy basically covers two things, sir. One is whatever the profit reduced, that one. Second thing is additional working expenses. See, because of disaster, what happens is sometimes we need to incur some extra expenses. For example, we have a factory here. Okay. Now, because of the fire, this factory got destroyed. Now we shifted our entire plant and machinery to another factory temporarily. To renovate this factory, to bring it to the normality, it will take some time. So meanwhile, we shifted to this factory. Sir, for shifting the factory, rental expenses will be incurred, shifting expenses will be incurred. These are all what? Additional working expenses. Why you are incurring all these expenses? Because of the disaster, na? No, so under this policy, you can cover those additional working expenses also. Sir, is this kind of policies are available? Yes. So immediately after disaster, your business got disturbed. So because of that, how much profit is reduced? That for that, to cover that, and also any additional working cost you are incurring, that can also be insured. Okay, under this policy. Now see, there are certain steps to calculate the insurance claim under this policy. Let us see these steps. So you have to remember all these steps. As it is, you apply in the exam, you will get full marks. First one is try to find out the GP ratio. Okay, I will connect every step. Wait. So try to find out what? GP ratio, gross profit ratio. How to find out GP ratio? Gross profit divided by sales into 100. But here, little bit different. Net profit plus insured standing charges divided by last year turnover. You find out the GP ratio of the previous year. Sir, how to find out GP ratio of the previous year? You take net profit first. Last year net profit. Add insured standing charges. Sir, what is the standing charges? Fixed expenses. In business, there will be certain fixed expenses, like rent, interest. These are all some fixed expenses, right? They are called standing charges. Now, out of these fixed expenses, you can insure some of the fixed expenses under this policy. Sir, this policy also gives coverage for standing expenses, standing charges. That means if you want, you can insure certain fixed expenses also. If you incur those expenses, they will be returned back by the insurance company. Now, whatever the standing charges you insured, they are going to be recovered. So therefore, for this net profit, they should be added back. Then you will get gross profit. Generally, once you arrive the gross profit, from that you need to reduce indirect expenses, right? Then you will get net profit. So here reverse, take net profit. How will you arrive this net profit? From gross profit, we reduced all indirect expenses. Now add back insured standing charges because they are also going to be recovered. So therefore, net profit plus insured standing charges divided by last year turnover. Then you will get GP ratio. And this is the last year GP ratio, right? So if you want to apply this GP ratio for the current year figures, suppose if there is any trend given, any adjustment given, you have to make the necessary adjustment. Then this GP ratio is ready for the current year. Suppose if there is no adjustment is given, the assumption is last year GP ratio itself is current year GP ratio. So first always try to find out the GP ratio. What is the formula? Net profit plus insured standing charges divided by last year turnover. You take this first. And next most important step is calculate short sales. Sir, what is short sales? See, in loss of profit policy, we want to find out how much profit we lost. For that, first we need to take the standard turnover. What is standard turnover? See, the indemnity period. For which period we are making the claim? For the same period in the last year, what will be our turnover? For example, 1/4/2024 to 30th June 2024. This 3 months is our period of indemnity. We got disturbed. So we are making the claim for these 3 months, right? Now in these 3 months, same 3 months in the last year, what will be our turnover? See, this is happened in 2024, right? 24-25. 2023 for this period, what will be our turnover? Take that turnover. That is called standard turnover. So what is standard turnover? Standard turnover means the turnover of the indemnity period for the last year. So indemnity period means the period for which you are making the claim from insurance company. For that period, what will be the turnover of the last year? You take it and add trend. Trend adjustments you have to take because you are taking the last year turnover. Now sales are subject to trend. Either there may be increasing trend or there may be decreasing trend. Whatever be the trend. For example, 10% increasing trend is there. Generally, trend will be given in the question. If it is not given, you have to find out the trend. How? Compare last year sales, this year sales. Last year quarter, this year quarter. Compare the sales, you will get, the trend. So suppose most of the times they will give 10% trend, increasing trend. You add 1 lakh, 10 lakhs into 10%. Then you will get adjusted standard turnover 11 lakhs. From that, what will be your actual turnover? You reduce it. During this period of indemnity, what will be your actual turnover? For example, 4 lakhs. Actual turnover will be less only. Why? Because we got disturbed by fire or accident. So therefore, we are not achieving the normal performance. Then this 7 lakhs is what? Loss of short sales. How much sales reduced? Then we will calculate how much profit we lost. Once you know how much sales reduced, on that if you apply GP ratio, then we will get how much profit you lost. Same step we do. Loss of profit on short sales. Short sales, just now we calculated in step 2. GP ratio, step number 1 we arrived. Apply GP ratio in short sales, then you will get gross profit on short sales. So 7 lakhs into 20%, 1,40,000 is the profit we lost. That means one of the component for claim amount under this policy we arrived. So understand, loss of profit policy means how much amount you are making claim from the insurance company, how much profit you lost. First you need to find out that. First find out GP ratio of the previous year. Net profit plus insured standing charges divided by last year turnover into 100. You will get GP ratio. Then second step is find out the short sales, standard turnover. Turnover of the indemnity period corresponding to the last year. And add less trend, then you will get adjusted standard turnover. From that you reduce actual turnover. Then find out the profit lost on short sales. Short sales into GP ratio, gross profit on short sales. Then step number 4. This is very, very important step. You need to calculate gross profit on adjusted annual turnover. What is that? Gross profit on adjusted annual turnover. Sir, in loss of stock policy, we have compared two things, sir. Policy amount and value of stock on the date of fire. Similarly, in loss of profit policy, we need to compare two things. What are those? Policy amount with gross profit on adjusted annual turnover. So what is this adjusted annual turnover, gross profit on adjusted annual turnover? First start with the last one, annual turnover you take. What is annual turnover? The date of disaster, the preceding 12 months turnover. Suppose the fire happened on 1/4/2024. From here to preceding 12 months, what will be your turnover? That is called annual turnover. Take it. For that, you adjust the trend. Then you will get annual adjusted turnover. Then you apply GP ratio. Then you will get gross profit on adjusted annual turnover. Now, this amount is very much useful to decide whether the insurance is over insurance, under insurance. Because the over insurance, under insurance, if it is an under insurance, we should apply average clause, na? So for that purpose, you need to compare the policy amount with gross profit on adjusted annual turnover. So what is the step number 4? Gross profit on adjusted annual turnover. First take annual turnover, add trend, add or less trend, then you will get adjusted annual turnover, apply GP ratio, then you will get gross profit on adjusted annual turnover. Okay. Next. Sir, I told you loss of profit policy covers mainly two things. One is loss of profit. We already arrived at step number 2. Step number 3. First we have ascertained short sales. On short sales we apply GP ratio. Then how much is the profit we lost on short sales? We already arrived at one component. Second component is additional working expenses. That is also covered under loss of stock policy. We can make the claim from insurance company. So therefore, how to ascertain it? A, B, C, whichever is lower, you have to take. A means actual additional working expenses we incurred. For example, we shifted to temporary premises. So because of the disaster, so any shifting expenses, any rental expenses, additional working cost, actually how much you incurred, take it. Second, how much sales we generated due to additional working expenses into GP ratio. That means profit. For example, because of these additional expenses, we shifted to other temporary premises. There we continued our production. Because of that, we are able to generate some sales. On that sales, what will be the profit? B. C. Additional working expenses, actual additional working expenses into net profit plus insured standing charges divided by net profit plus all standing charges. See, this is as per the CMA study material. So actually in other materials, they will give uninsured standing charges, but they have kept all standing charges. I am taken accordingly. Okay. So proportionate. Sir, is this make any sense, sir? I mean, is it logical? No logics here. Whatever they felt, they have drafted it. They have drafted in such a manner, these insurance IRDA regulations, they have drafted in such a manner that ultimately the claim amount will be less. So if you want the logics here, I think you won't get it. Because what is the logic for claim for additional working expenses? A, B, C, whichever is less. What is A? Actual additional working expenses incurred. B, whatever additional expenses, because of the additional expenses, whatever the sales generated into GP rate, gross profit ratio. Third, proportionate. What is this proportion? I don't know. So additional working expenses into net profit plus insured standing charges plus net profit plus all standing charges. Sir, you have to remember all these things, sir. So there is no way. Now, once you know this, whichever is lower, you take it. So then we know step number 3, how much profit we lost. Step number 4, additional working expenses. Then next step is gross claim. Before making net claim, first we need to calculate gross claim. How to calculate gross claim? Simple. What is the gross profit on short sales? How much is the profit we lost? Step number 3. Add claim for additional working expenses as per step number 5. Less savings in insured standing charges. So step number 3, step number 5 minus savings in insured standing charges. What is the savings in insured standing charges? Suppose I told you now there are certain fixed expenses we will take insurance as per the loss of profit policy. Suppose if these expenses you have not incurred, then there won't be any claim. That's why they have to be reduced. Savings in insured standing charges. Savings in insured standing charges. Okay. Next, you will get one amount. Now calculate net claim. How to calculate net claim? Simple. You have to decide under insurance or over insurance. Over insurance. Here, the over insurance is policy amount is compared with gross profit on adjusted annual turnover. If the policy amount is greater than gross profit on adjusted annual turnover, then it is over insurance. If it is over insurance, net claim, gross claim, both are same. Net claim is equal to gross claim. No problem, because insurance company does not have any problem. Because you have taken insurance more than what we expect. See, this is insurable amount. This is insured amount. Insured means policy amount. See, we are expecting you to take insurance on this, but you have taken insurance more than that. So we are happy. So therefore, net claim is equal to gross claim. We don't apply average clause. When we apply average clause, when policy amount is less than gross profit on adjusted annual turnover. then we apply average clause, because we are expecting you to take insurance on this under loss of profit policy. Annual turnover, apply gross profit, then apply trend, then you will get adjusted annual turnover, on that apply your gross profit ratio. So your policy amount is less than gross profit on adjusted annual turnover, so we apply average clause. When you apply average clause, so gross claim into policy amount divided by gross profit on adjusted annual turnover. Simple technique is what? Gross claim into policy amount, that means insured amount divided by insurable amount. So always compare insured with insurable. Insured means policy, insurable means what is the amount they are expecting to take us to insurance. So insurable amount, insured amount. So tell me, what are the steps involved in loss of profit policy? First, GP ratio. How to get GP ratio? Net profit plus insured standing charges divided by last year turnover into 100. If at all you want to make any changes given in the question, make a change. Next, find out short sales. How to find out short sales? First, take standard turnover. What is standard turnover? Indemnity period. For whatever the period we are making the claim in the current year, the same period in the last year, what is the turnover? Add a trend, either increasing or decreasing. If it is increasing, add. Decreasing, less. Then you will get adjusted standard turnover minus actual turnover of the indemnity period. You will get short sales. Next, find out the loss of profit because of short sales. Short sales into GP ratio. Then you will get how much profit you lost on short sales. Next, find out gross profit on adjusted annual turnover to finally decide whether it is under insurance or over insurance. First, take annual turnover. What is annual turnover? Preceding 12 months turnover. From the date of disaster to preceding 12 months. Then you adjust trend. Then you will get adjusted annual turnover. On that you apply GP ratio. Then you will get gross profit on adjusted annual turnover. Then claim for additional working expenses. Three things you take. A, B, C, whichever is less. A, actual additional working expenses. B, sales due to additional working expenses into GP ratio. 3, actual additional working expenses into net profit plus insured standing charges divided by net profit plus all standing charges. Then gross claim. Step 3, step 5, minus savings in insured standing charges. Then net claim. Net claim always compare insurable amount with insured amount. Policy amount, insured amount. Insurable amount means gross profit and adjusted annual turnover. If your insured amount is more than insurable amount, over insurance, no problem. Net claim is equal to gross claim. We will give entire claim. But if your policy amount is less than the gross profit and adjusted annual turnover, that means if your insured amount is less than the insurable amount, that is under insurance. If there is an under insurance, we apply average clause. Then accordingly, we will give average amount. That is, net claim is equal to gross claim into policy amount divided by adjusted annual, gross profit and adjusted annual turnover. So what I will do is, sir, I will add some one problem also, 1 or 2 problems relating to loss of profit policy. You see those problems, I think you will get the clarity. Okay, that's it. So total 30 minutes it has taken for me to complete the revision of both. Now, once you listen to these 30 minutes, open the material, solve some questions. So don't waste much time now. So just listen to it, apply. Okay, thank you. Problem number 5. From the following details, calculate the consequential loss claim. That means loss of profit policy claim. Date of fire, September 1st. Indemnity period, 6 months. Period of disruption, September 1st to February 1st. October, November, December, September, October, November, December, January. 5 months actually. So indemnity period 6 months. That means policy period 6, but period of disruption is only 5 months. October 1st, November 1st, December 1st, January 1st, February 1st. So October 1st, November 1st, January 1st, October, November, December, January, February. So 5 months. This is 6 months. Whichever is lower, 5 months. That is the period we make the claim. Sum insured 1,08,900 policy amount. Sales were 6 lakhs for preceding financial year ended 31st March. Okay. Net profit for the preceding financial year 36,000 plus insured standing charges 72,000. Rate of gross profit 18%. Turnover during disruption period, actual turnover within this 5 months disturbed period 67,500. Annual turnover for 12 months immediately preceding the date of fire 6,60,000. Standard turnover, that is corresponding months in the preceding year 2,25,000. Everything is given directly, sir. Increase in cost of working capital 12,000 with saving of insured standing charges 4,500. Reduced turnover avoided through increase in working capital 30,000. This was sales generated, gross profit on additional sales generated by additional working expenses. So reduction in turnover avoided through increase in working capital. Because we spend additional expenditure, we eliminated the reduction in turnover by 30,000. That means because of additional expenses we generated 30,000 extra sales. Special clause, increase in rate of GP by 2%. Okay, increase it. Last year GP, for that you need to add another 2%. Increase in turnover, trend 10%. Very simple sum, sir. Just to substitute the figures. It won't take much time. So we'll solve this also. So this is CRD number 5. So calculation of insurance claim as per loss of profit policy. As per loss of profit policy. So we are making the claim. First step, GP ratio of previous year. Actually GP ratio of previous year they have given. Correct? GP ratio of the previous year they have given, sir. How much given? 18%. No need to calculate. Directly they have given 18%. And they said there is an increase of 2%. So GP ratio of previous year 18%, for that add increase. Because see, this increase is very much important, because last year whatever turnover is there, this last year GP ratio is there, we are using it for current year calculations. So therefore whatever the GP ratio is there, for that you make this addition. So use this 20% for this calculation. Okay, adjusted GP ratio. Now second, short sales. How to get short sales? Simple. Standard turnover. First take standard turnover. What is the standard turnover? 2,25,000. Now for this 2,25,000, add trend. So increase in trend. How much increase, sir? Trend 10%. Increase. So that means 22,500. So it will be how much? 2,25,000 plus 22,500. So it will be 2,47,500. 2,47,500. And what will be your actual sales, actual turnover during this period of disruption? Period of disruption, actual sales, how much? Given. Turnover during the disruption period, 67,500. So therefore, what will be your short sales? So 2,47,500 minus 67,500. So it will be 1,80,000 short sales. Very simple. So standard turnover, that means this year, what is the period we have affected? I think we affected from September 1st to February 1st, correct? This year, this is the current year we affected. See, September 1st to February 1st of current year. Same period in the last year, September 1st to February 1st of previous year. This is standard turnover, and it is given in the question itself. So see, standard turnover 2,25,000. For that add trend, then you will get 2,47,500 minus 67,500. So you will get short sales. Now find out loss of profit. So loss of profit is equal to short sales 1,80,000 into GP ratio 20%. So 1,80,000 into 20%. 20%. So 36,000 is the profit lost. So this is one of the component. Next, step 4, gross profit on adjusted annual turnover. So take first annual turnover. Annual turnover given. See here. Where this 6 lakhs. So 6,60,000, I think annual turnover 6,60,000. This is 6,60,000. So 6.6 lakhs. For this add trend. How much? 10% increase. So that means it will be 66,000. 66,000 trend. So 6 lakh 60 plus 66,000. So it will be 7 lakh 26,000. 7 lakh 26,000. And then apply GP ratio on this 20%. Then you will get gross profit on adjusted annual turnover. So what is the gross profit on adjusted annual? 7 lakh 26,000 into 20%. So it will be 1 lakh 45,200. Very simple. Gross profit on adjusted annual turnover. Now step number 5. So claim for additional working cost. So what will be the additional working cost? Increased cost of working capital. So claim for additional cost of working. So A, B, C, whichever is least we have to take. So for example, A, actual additional expenses. How much is the actual additional expenses we spent, sir? Actual additional expenses. I think it is given in the question. Actual additional expenses. How much we spent? Increase in cost of working 12,000. Next, actual additional working expenses 12,000 into that formula you have to remember, net profit. What is the net profit of the previous year? 36,000 plus insured standing charges 72,000 divided by net profit plus total insurance, total standing charges. Total standing charges. What is the total standing charges here? I think here the total standing charges and these charges are 72,000. Any uninsured standing charges, sir? Net profit, insured standing charges 72, turnover, annual turnover, standard turnover, increase in cost of working expenses with a saving of insured standing charges of 4,500. I think both are same. So I think it will also come 12,000, sir. And what is the gross profit on additional sales generated? See, because of these additional expenses, we have able to reduce, avoided the reduction of turnover by 30,000. So therefore, what is the gross profit on turnover because of additional expenses? 30,000. So 30,000 into 20%. $6,000. That's it, sir. So therefore, whichever is least, therefore claim is equal to least of the above. Least of above. That is equal to rupees 6,000. Okay. Now, sixth one, gross claim. How to make gross claim? Simple. What is the loss of profit as per step number 3? How much profit we lost? Add claim for additional expenses. How much additional expenses you incurred? Minus savings in insured standing charges. Savings in insured standing charges. So what is your loss of profit? 36,000. Take here 36. Claim for additional expenses 6,000. How much is the savings in insured standing charges? They given, sir. Savings in insured standing charges 4,500. So therefore 36,000 plus 6,000 minus 4,500. So it will be 37,500. 37,500 is the gross claim. $37,500. Now you need to calculate what? Net claim. So net claim is equal to, we need to compare two things I told you. Policy amount versus gross profit on adjusted annual turnover. What is my policy amount? For what amount I have taken the policy? 1,08,900. So policy amount 1,08,900. Now I need to compare with gross profit on adjusted annual turnover. What is my gross profit on adjusted annual turnover? So we calculated in step number 4. Go to step number 4. So you see the gross profit on adjusted annual turnover 1,45,200. So 1,45,200. So policy amount less than gross profit on adjusted annual turnover. So since gross profit policy amount is less than gross profit on adjusted annual turnover, this is what? This is under insurance. Under insurance. So you need to apply average clause. Average clause you apply. So if you apply average clause, what will be net claim, sir? Net claim is equal to gross claim into policy amount divided by gross profit on adjusted annual turnover. So what is your gross claim? 37,500 into what will be your policy amount? 1,08,900. 1,08,900 divided by 1,45,200. So ideally you should take insurance for 1,45,200, but you have taken insurance for 1,08,900. So 37,500 divided by 1,45,200 into 1,08,900. So it will be 28,124.9. So 28,125. So 28,125. So this is the net claim, sir. So is there any great point in this sum? Absolutely nothing. Just we need to place the information. So in that format, in that procedure, then you will get the answer. Now next. See, we have one more problem, sir. We have one more problem. Say this problem number 6. A fire occurred on March 15th, 2021 in the premises of Omega Limited. So March 15th, 2021 there is a fire. A loss of profit policy was taken by Omega Limited for 80,000. So we have taken a policy for 80,000 and the indemnity period. So the indemnity period was 3 months. Okay. Net profit for the year ending 31st December 2020 was 56,000 and standing charges all insured amounting to 49,600. So determine the insurance claim from the following details available from quarterly sales returns. See, they have given sales returns data. Now by using this quarterly sales returns, you need to decide. See the quarterly sales data they have given, sir. 2018, 2019, 2021. So January to March, April to June, July to September, October to December. Like that 4 quarters data they have given for last 18, 19, 20, 21. And also they have given sales from 16th March 2020 to 31st March 2020, 28,000. Sales from 16th March 2021 to 31st March 2021, nil. Sales from 16th June 2020 to 30th June 2020, 24,000. Like that for different periods. For 15 days sales also given. Okay. Now by using this information, they are asking us to determine what they are asking, sir. See, very easy. Just you need to carefully see the dates. Calculate, determine the insurance claim from the following details available from quarterly sales return. See here, first of all, when fire happened, sir? March 15th, 2021, right? Omega. A loss of profit policy was taken by Omega Limited for 80,000. Okay. The indemnity period was how much? 3 months. So, see, indemnity period means the period of disaster. If nothing, this 3 months. For this 3 months, we need to make the insurance claim. The net profit for the year ended 31st December 2020 was 56,000. And last year, I mean, they are following calendar year, January to December, because based on the information. So last year, my sales was my net profit was 56,000, and standing charges 49,600. That means last year my fixed expenses is 49,600. Now they are asking us to determine the insurance claim from the following details available from weekly sales returns. So from weekly sales returns, how you are going to get the insurance claim, that is what they are asking. As usual, same steps. First we need to find out what GP ratio. So GP ratio of the previous year. So previous year net profit, we know how much net profit of the last year, 56,000 plus standing insured charges 49,600 divided by last year turnover. What is the last year? Current year 21, last year 2020. You add last 4 quarters turnover, you will get 2020 turnover. So you will get GP ratio. First step. Second step, you need to calculate short sales. What is short sales? First take standard turnover. See, tell me actually when fire happened? March 15th, right? March 15th, 21 to 3 months actually. Indemnity period is 3 months. That means March, April, May, June. So that means June 15th, 21. So March 15th, 21 to June 15th, 21. This is what? This is the period of the current year for which we make the claim. Now same period of the previous year, that is March 15th, 20 to June 15th of 20. Now this period, this 3 months, March 15th 20 to June 15th 20. So for this 3 months, what will be your turnover? So 2020 data we know. Now we want March to June. March to June. See, that means we know that the quarter, in which quarter it will fall? March to June. So that means April to June quarter. So April to June. But I want sales from March 15th to 30th April. So that means 15 days sales of March month, and I don't want entire June month sales because I need to take only June 15th till June 15th. So what I need to do is, see, this 15 days I can take the help of June, March, 16th March 2020 to 31st March 2020 I will add, and 16th June 2020 to 30th June I will less. Then I will get standard turnover. And similarly, annual turnover. Annual turnover means, see, March 15th 2021, right? From here to, you see, preceding 12 months. Preceding 12 months you go back. That means I think 16th March 2020, you see. So 16th March 2020. That means April, May, June, July, August, September, October, November, December, January, February, March. Exactly 12 months. Now find out these 12 month sales. So 16th March 2020. That means 2020 year, March month, first quarter you see, if you take away, then April, May, June, July, August, September, October, November, December, January, February, March. March month 15 days sales, required. Another 15 days not required. Here March 15, 2021 only 15 days sales required. So this 15 days sales is available here. So I think very easy sum, sir. I will analyze and I will tell. See, we'll solve it so that you will get an idea what I am doing. First we will, as usually our steps won't change. So this is CRD classroom sum. So this is problem number 6. Okay. Now see some useful steps we can do. Working note we can do first and then ascertain, or so directly also we can ascertain, nothing wrong. See, first of all I want two things: standard turnover, annual turnover. Standard turnover, annual turnover. So I can easily find out standard turnover or annual turnover. Anyway, I will do steps. First step, GP ratio of the previous year, right? GP ratio of the previous year. So GP ratio of the previous year I need to calculate, sir. How to calculate GP ratio, sir? Same, it will not change. Gross profit divided by sales into 100. Gross profit divided by sales into 100. That means what is my current year 2021? So last year net profit 56,000. So 56,000 previous year means 2020 here. Plus insured standing charges. All charges are insured. 49,600 divided by what is my last year turnover. You add last year sales. 1,42,000 plus 1 lakh plus 1,20,000 plus 1,66,000. So it will be 5,28,000. 5,28,000 into 100. So therefore 1,05,600 divided by 5,28,000. So it will be 20%. So GP ratio came 20%. And what is step number 2? Calculation of short sales. Short sales. I want short sales. How to get short sales? First you need to take the standard turnover. What is standard turnover? See, current year, for which period you affected, your business is affected. Your business is affected for 3 months from March 15th. Say fire occurred in March 15th. So we can say that the 16th March 2021 to 3 months. This is the period. So standard turnover means, see, standard turnover, for this you need to adjust the trend, right? So add trend. So maybe upward or downward. So trend upward. If there is an upward trend, we will add. Then you will get one figure. From this we need to reduce actual turnover. See, this actual turnover is for which period? See, fire occurred on March 15, 2021. So 3 months you suffered. So therefore can I say 16th March 2021 to 3 months actually. April, May, June. So that means 15th June 2021. Actually for this period you suffered. Now the same period in the previous year, that is 16th March 2022, 15th June 2020. Now 16th March 2022, 15th March 2021. So this is the actual turnover for this period, and the last year what will be the turnover, actual turnover. So if I ascertain, very simple, sir. See here, standard turnover I want first. So standard turnover I am calculating. What I will do is, I want last year 2020. See, I want sales from 16th March to 15th June. So can I take April to June quarter sales first? April to June quarter sales I will take, because my sales belongs to 16th March to 15th June. So it will come under April to June quarter. So if I take sales of second quarter, that is April 1st to June 30th quarter of which year? Last year. Should not forget this. 2020 I will take. It will be how much? 1 lakh. But I know I want sales from 16th March, but I am taking from April 1st. That means for this I need to add sales from this 15 days also. That is 16th March 2022. Okay, 31st March 2020. I want this sales also. But which sales I don't want? See, I want sales only till 15th June. So therefore, from sales from 16th June 2022 30th June 2020 I will eliminate, because see, in the sales what I have taken April 1st to June 1st, April month 1st onwards I want sales, and that means these 15 sales not included in the above, so I need to add. And June 15th I want sales till June 15th, but here the sales are there till June 30th, so therefore the sales between 16th June to 30th we need to eliminate. So therefore if you take sales from 16th March 2020 to 31st March 2020, 28,000 we will add, and the sales from 16th June 2020 to 30th June 2020, this one 24,000 I will eliminate. So therefore what I will get is 1 lakh plus 28,000 minus 24,000. So it will be 1,04,000. Actually this is my what? This is my standard turnover. 1,04,000. Very simple sir. Dates and there. 16th March to 15th June I want. So April, May, June quarter I will take. From that I need to eliminate June month 15 sales, and 16th March 15 days sales I have added. 1,04,000. Now I need to adjust the trend. And what will be my actual turnover during this period? Actual turnover during this period. So that also I need to eliminate. I need to find out what is my actual turnover. Same manner I need to find out. See, current year I have suffered from this to this. See, this is standard turnover. So annual turnover also, actual turnover also I need to calculate in the same manner. Actual turnover. So I want sales from April 1st to, I need to take April to June quarter sales of 2021, and I know that I need to add March month sales also for 15 days. So sales from 16th March 2022 31st March 2020 I will take 1, and I know I want sales June month 15th. So therefore sales from June 16th June 2021 to, so 30th June 2021 I need to eliminate. Here 2021 we need to take current year sales na. Okay. Now what will be my sales in the current year quarter? 40,000. Take 40,000. Current year March sales 16th March to nil. So nil. And current year 16 June to 30th June 6,000 minus 6,000. So you will get 34,000. 34,000. So you take here 34,000. So you will get short sales. But see, one adjustment I need to do is a trend. So what will be my trend, sir? Whether my sales are in increasing trend or decreasing trend. I need to compare turnover of the previous years. See, first I will do this. See here. What is my 2020 turnover, 2020 turnover? Just now we calculated here. 5,28,000. So take here 5,28,000. Okay. This year you take 2019 total 1,30,000 plus 90,000 plus 1,10,000. Sorry, 1,10,000, 1,50,000 plus 90,000 plus 1,30,000. So it will be 4,80,000 and 1,20,000 plus 80,000 plus 1 lakh plus 1 lakh 36,000. So it will be 4 lakh 36,000. So therefore you observe what will be the trend here. 4 lakh 36, 4 lakh 80, 5 lakh 28,000. So I will compare from 4 lakh 36 to 4 lakh 80. What will be increase? 44,000. So can you find out this in percentage? 44,000 divided by previous year sales into 100. So it will be 10%. Similarly, you compare this. 4 lakh 80 has become 5 lakh 28,000. So therefore 48,000 increase. So 48,000 divided by 4 lakh 80. So it will be 10%. So that means this indicates that there is an average increase of how much, sir? 10%. So therefore there is an upward trend of 10%. Upward trend of 10%. Now this has to be what? Increase. So 1,04,000 into 10%. So it will be 10,400. So 1,04,000 plus 10,400 minus 34,000. So you will get 80,400. So this 80,400 is what, sir? This 80,400 is my short sales. 80,400 is my short sales. So how I got this 80,400? I have compared standard turnover and this one. So 1,04,000 plus 10,400. So it will be 1,14,400. 1,04,1,400. So standard turnover, actual turnover. See, if you want, you can do it in a separate working note also. And a trend, how I have find out trend. See, I compared sales of the, see, for example, see here. So year, year sales trend. Tell me, year 2018, what is my sales? 4,36,000. 2019, what is my sales? 4,80,000. 4,80,000. 2020, what is my sales? 5,28,000. See, I am not required to compare current year, because current year there is a disturbance, there is a fire. So there is a disaster. So normal period, if I take the trend, what the trend is? See, if you observe from 2018 to 2019, so what will be the difference? 4,36,000, 4,80,000. So difference is 44,000. So what will be the trend? 44,000 increase divided by 4,36,000 is the previous into 100. So it should be 10%. Similarly, you compare these two. So there is an increase of 48,000. 48,000. Now 48,000 divided by 4,80,000. So it will be into 100. So it will be 10%. So on an average, there is a trend of 10%. So therefore, increase in trend, increasing trend, increased trend. Or I can say that there is a upward trend. Increasing trend or upward trend, both are same only, sir. Increasing trend or upward trend. So increased trend is what? 10%. So it will be fixed. You are comparing from last 2 years. So that is what I have taken here. 10% trend I have adjusted. So now I got the short sales. So once I got the short sales, what is the next thing, sir? Very simple. So loss of profit I need to calculate on short sales. So short sales into GP ratio I will apply. So I know my short sales is how much? Just now I got. My short sales are 80,400. 80,400. For that 80,400, if I apply GP ratio, what will be my GP ratio, sir? Step number 1, 20%. 20%. So 80,400 into 20%. So it will be 16,080. So this is, the first thing, that is profit lost on sales. GP, whatever the thing is there, this is the profit we have lost. 16,080. Now we need to calculate gross profit on adjusted annual turnover. So what is this gross profit on adjusted annual turnover? See, gross profit on adjusted annual turnover. So first you take annual turnover. Annual turnover means preceding 12 months. That means 16th March 2020 to 15th March 2021. For this period, what will be your sales? So that means I have to consider last year, see, 2020 sales. 2020 April to June and July to September and then October to December, and 2021 I need to take January to March. But I know I want sales from 16th March 2020, but I am taking April to June, April 2020. That means I need to add 15 days sales, that is 16th March 2020 to 31st March 2020 turnover. Sales I need to add. And also I have taken January to total March sales, but I want sales only till March 15th 2021. So therefore I need to less. So 16th March 2021 to 31st March 2021 sales I need to eliminate, because I want sales only till 15th March. So simple. First you need to take 2020. So April to June, how much? 1 lakh. April to June, 1 lakh sales. July to September, 1 lakh 20. And then October to December, 1 lakh 66,000. And 2021 January to March, 1 lakh 30,000 you take. And last year 16th March to 28,000 sales you add. Current year 16th March to nil. So that means you will get annual turnover. Now what will be your annual turnover, sir? If I add all these things, 1 lakh plus 1 lakh 20 plus 1 lakh 66,000 plus 1 lakh 30 plus 28,000. So it will be 5 lakh 44,000. Now you apply GP ratio on this, 20%. So it will be 1 lakh 8,800. Sir, I forgot to write the trend, sir. So for this, first I need to adjust the trend. This is only annual turnover. So I want adjusted annual turnover. So add trend. That is upward trend, sir. Upward trend. How much is the trend, sir? 10%. So 54,400 is my trend. So 5 lakhs 44,000 plus 10%. So it will be 5 lakh 98,400. Now this is adjusted annual turnover. On this you apply GP ratio at 20%. So it will be 1 lakh 19,680. So now I got gross profit on adjusted annual turnover. Now in the question, is there any additional working expenses, sir? Any additional working expenses? Nothing, sir. So no additional working expenses and all. So therefore there won't be any step number 6, that is claim for additional working expenses not to make. So you can make gross claim. How to make gross claim? Simple. What is your loss of profit as per step number 3? What is your loss of profit? See, 1680. So 16,080 you take. For that add there is no savings, claim for additional working expenses. So therefore no need to take this. But What is the next item we can eliminate is in savings in insured standing charges. Savings in insured standing charges. I think this is there. There is savings in insured standing charges, sir. How much given? Anything given? Savings in insured charges. 49,600. Any savings in insured standing charges? Nothing, sir. I think savings in insured standing charges also nil. Nothing. So therefore your claim is 16,080. This is gross claim. Now we need to calculate the net claim. So what will be net claim? Net claim, simple, sir. We need to compare policy amount with gross profit on adjusted annual turnover. So what is your policy amount, sir? See, you have taken policy for 80,000. So policy amount is 80,000, sir. 80. And what is your gross profit on adjusted annual turnover? So this is gross profit on adjusted annual turnover. And GP ratio, if I apply 20% on this, I will get this 1,19,680. 1,19,680. So therefore net claim is equal to gross claim into policy amount divided by GP on adjusted annual turnover. What is my gross claim? 16,080 into what is my policy amount? 80,000. And what should be the insurable amount? 1,96,80. Actually here policy amount is less than gross profit on adjusted annual turnover. Ideally you should take insurance for this 1,19,600. But you have taken insurance for 80,000 only. So therefore this is under insurance. This is under insurance. So you have to apply what? Average clause. Since this is a case of under insurance, you need to apply what? Average clause. Now if you apply this average clause, how much insurance claim you will get, sir? So 16,080 divided by 119,680 into 80,000. So it will be 10,749. 10,749 rupee. Sorry, 10,749 is the answer. 10,749. So what is the uniqueness in this sum? Dates. See, you should have a clear idea about what is standard turnover. Which period we need to consider to calculate standard turnover. This year, what is the indemnity period? For which period we affected, we are making the claim. The same period corresponding to the last year. What will be the turnover? You need to adjust the trend, adjust at annual turnover. If you less, you will get short sales. So standard turnover I am taking here. So now see, I know I need to take sales. Standard turnover means this period. Actually I want this sales. Sales from 16th March 2020. So see here, I need to take sales from 16th March 2020 to 15th June 2020. Actually for this period I want sales. That means March month 15 days sales, then April full month, May full months, June month only 15 days. But see, that's why I have taken first quarter, April, May, June. Majority of the period belongs to second quarter, April to June. Now to this April to June quarter, these 15 month sales I have added. That's why see, they have given data. And from this I reduced 15 month sales, 24,000. And now I have considered the annual turnover. How annual turnover I prepared? Same. This is not annual turnover, sir. This is actual turnover. Because I need to compare my standard with actual. How much actually we achieved the turnover. With that we need to compare. So same period, April to June 2021. Same. See, this period is this. This is 16th March 21 to 15th June 21. So for this period, what will be your sales? So April to June sales you take. For that March month 15 days sales less June month 15 days sales you reduce. Okay, you will get this one. So trend, how I got the trend, sir? I compared the sales of the previous years. Current year sales I compare. See, 4 lakh 36, 4 lakh 80. Some students are unable to understand the comparison. That's why I have written here. How much increase in sales? 44. So always you have to compare with previous. See, this 44,000 divided by 4 lakh 36 previous year turnover. Then you will get how much increase? 10%. And similarly, your sales increased from 4 lakh 80 to 5 lakh 28. So 48,000. Now 48,000 divided by 4 lakh 80 into 10%. So 10%. So the increase in trend is this. Now that is the only important thing in this. And one more thing, sir, how to get annual turnover. See, you know what is annual turnover? Annual turnover is nothing but the date of disaster to the preceding 12 months. So I know that 15th March 2021 is my date of disaster. So from that to back 12 months I have taken. And I know I need to take sales from 16th March of last year to 15th March of current year. So therefore, majority of the sales, so April to June I know 2020, July to September, October to December of 2020, current year January to March sales. But I want March month 15 days salaries, 15 days sales, 15th I want first 16th March to 31st March sales also added. But unfortunately it is 28,000. But and I don't want total March month sales for this year because I need to take only 15th March. So this 15 days sales I have eliminated nil. Now I got 5,44,000. Now trend, don't forget to add trend adjusted for 54,400. Then I will get adjusted annual turnover. On that I applied GP ratio. So gross profit ratio I applied. GP ratio. Gross profit ratio. What is the gross profit ratio? 20%. Now I will got gross profit and adjusted annual turnover. Now gross claim. See, in this problem there is no additional working expenses. So I have not taken. So loss of profit given 16,080 and savings in insured standing charges also not given. Therefore this is the only item 16,080. Now I find out the net claim. How? Compared policy amount with gross profit and adjusted annual turnover. My policy amount is 80,000. My gross profit and adjusted annual turnover 1,19,680. And by looking at this, I know my policy amount is less than gross profit and adjusted annual turnover. How much? So actually this is 80,000, but I should have take policy for 1,19,680. So therefore there is an underinsurance. So when there is an underinsurance, you should apply average clause. That means insurance companies will generally apply average clause and they will give the insurance amount based on average. So I got 10,749. So this is how you are going to solve the sums relating to loss of profit policy. Now the next topic for discussion is hire purchase and installment sales. So in this chapter, first we should understand the basics, like what is hire purchase, what is the difference between hire purchase and installment sale, what are the important terms which we use in hire purchase. So all those things we have to learn. Then calculation part is there, sir. That is calculation of cash price, calculation of interest calculation in each installment, then accounting for hire purchase, and there is a concept of repossession. Now, first of all, what is hire purchase, sir? See, as a seller, suppose for example, there is a seller, Honda, and there is a buyer, Mr. X. He wants to purchase a bike. Actually, the bike cost is 1 lakh rupees. So right now, if you want to purchase by directly cash, by using cash, he has to make the payment of 1 lakh rupees. That is called cash price. Suppose, sir, if he wants to buy the car, buy the bike by hire purchase basis, so along with the cash price, he has to pay some interest, because what is hire purchase? It is a type of credit sale where the seller initially collects some amount from the buyer. We call it as down payment, and the balance amount in the form of installments. Now each installment includes the principal cash price plus interest also. So here if you see, the buyer initially will make the down payment. For example, the down payment is 20,000. Now the balance is 1 lakh rupees. Sir, actually the cash price is 1 lakh, sir. If I want to purchase the bike now by cash, 1 lakh I have to pay. Now since I am purchasing it in the form of hire purchase, Initially, I have to make the down payment 20,000. I made payment of 20,000. Remaining balance I will pay in the form of installments. Suppose 5 installments. Each installment, suppose 20,000. See here, 1 lakh cash price plus interest added. So total 1,20,000 is hire purchase price. Now, the unique point in hire purchase sale is that the seller who is selling the goods on hire purchase basis is called hire vendor, and the buyer is called hirer. See, whenever any goods are purchased or sold on hire purchase basis, if the buyer unable to make the payment of installments, what the seller can do is he can take back the goods. Repossession is available. And till now, whatever the installments paid by the buyer, which is paid by the buyer, so they will not be returned back by the seller. They will be treated as higher charges. They will be treated as what? Higher charges. So that is the uniqueness. But in case of installment sale, sir, and one more thing, sir, in case of hire purchase, sir, so the ownership will be transferred. The legal ownership is there with seller only. Only when the buyer makes all the installments, so then the legal ownership will be transferred. But in case of installment sales, the ownership will be transferred immediately. And suppose when I purchase any item on installment basis, and if I can unable to make the payments installments, what seller can do? He cannot take the repossession of the goods. He can only go to the court of law. So what is a hire purchase? Hire purchase is a type of a credit sale where we will collect initially some amount called down payment, the balance amount in the form of installments. Now each installment is combination of two things. One is principal, another one is interest. Okay. Now what are the important terms which we come across in hire purchase? For example, seller, we call him as hire vendor, the person who is selling the goods on hire purchase basis. And there is hire purchaser, or he may be called as hirer, or there may be a buyer who is purchasing the goods on hire purchase basis. Next, down payment. See, what is down payment? See, whenever an hire purchase agreement is entered, initially some payment is made by the hire purchaser to the hire vendor, that is called down payment. Now this down payment is made at the beginning of the year, so therefore no interest component in this, so it will be treated as payment of principal only. And one more important term in this is cash price. So what is the cash price? If I want to purchase any asset right now by paying cash, how much amount I need to make the payment? That is called cash price. And what is hire purchase price? Hire purchase price is nothing but cash price plus interest. If you add total interest to the cash price, then you will get hire purchase price. And what is hire purchase interest? I need to find out the interest in each installment. Simple. If you, from installment amount, if you separate interest component, suppose if you separate the principal component, you will get interest. Okay. So this is hire purchase. Now next, sir. Now the main difference between hire purchase and installment sale also we discussed, sir. So the main difference is this: seller's right to repossess. In case of goods are sold on hire purchase basis, if the buyer doesn't make the payment, seller can take back the goods. Repossession is possible, but the same repossession is not possible in case of installment sale. Okay. Now the most important part in hire purchase is, see here. Actually, what is hire purchase? It is a type of a credit sale where buyer initially will make some amount, that is called down payment. Remaining amount we will pay in the form of installments. And in this chapter, the most important part is this one, calculation part. What is this calculation part? See, either they will ask you to calculate interest involved in each installment. What is the interest in each installment? This they may ask. Or they may ask cash price calculation in each installment. So each installment, how much is the cash price included? They may ask. And then we need to learn the accounting treatment. Okay. See how to calculate cash price, how to calculate interest in each installment. Sir, how to calculate interest in each installment? See, I will explain you through an example. One question I will take and I will explain. See this question number 1, sir. See here. Suppose sir X purchases a car on hire purchase system on January 1st 2018. Okay, the total cash price of the car 4,50,000 given, cash price is given in the question. Payable 90,000 as down payment and 3 installments of 1,70,000, 1,50,000, 1,08,460 at the end of the first, second, third year respectively. Interest 10%. Calculate, you are required to calculate interest paid by the buyer to the seller each year. So now see, you tell me what is the cash price? 4,50,000. Now this I am purchasing on hire purchase basis. Initially how much amount I paid? 90,000. First installment 1,70,000. This installment is includes two things, principal plus interest. 1,50,000, 1,08,460. Now in each installment how much interest is there? That is what we need to find out. Sir, very simple sir. Any time when the installment becomes due, what is the outstanding amount? On that outstanding amount you calculate the interest. That much interest is there in the installment amount. See here, see in this problem how we need to solve. See, this is the way to solve. See, problem number 1. First you take the cash price given in the question. How much cash price given? 4,50,000. This is the principal amount. If I purchase the asset right now, I have to pay 4,50,000. Right? So take 4,50,000. Okay, cash price. Now from that you reduce the down payment. So because initially this is the payment they made now, so reduce it. Outstanding amount reduced. So this entire 90,000 what you pay at the time of down payment, it is treated as cash price, nothing but principal portion. Next, what is the amount to due after down payment, sir? 3,60,000. Now you are required to pay first installment. So tell me, at the time when the first installment become due, what is the outstanding amount? 3.6. So 3.6 into interest. So what is the rate of interest here? 10%. So calculate 10%. So 3,60,000 into 10%. 36,000. 36,000. See, this is the interest on first installment. So total first installment 1,70,000. In that 36,000 is the interest component. Reduce it. The principal portion is 1,34,000. So that means you paid 1,70,000 first installment. The buyer paid. But in this 1,70,000, 36,000 is the interest component. Only 1,34,000 is the principal component he paid. So reduce it. Now what is the outstanding amount after paying the first installment? 2,26,000. Now you calculate interest on second installment. 2,26,000 into 10%. 2,26,000 into 10%. You calculate. 22,600. See here. Now second installment 1,50,000 minus 22,600. So therefore 1,27,400 is the principal amount you paid. So reduce it. 98,600. Now 98,600 into 10%. 9,860. That means third installment 1,08,460 minus 9,860 is the interest component. So interest you separate it. Remaining is the principal 98,600. So therefore the balance outstanding is nil after three installments. And the principal component is 4,50,000. That is nothing but the cash price. And the interest component is 68,460. Now what is the thing? See here how I have done. So if at all they have asked a question relating to calculation of interest on each installment, you follow this. Very simple method I told. First you need to find out the cash price. See, you should know the cash price. See, this is the outstanding amount, nothing but. And each installment is a combination of two things. Cash price plus interest. Cash price means principal. So every time when you calculate interest, what is the outstanding amount you see? How to get outstanding amount? Simply nothing but in installment, what is the interest portion? You reduce it. Remaining amount is the principal you paid. If you reduce that, what will be the outstanding balance? On that you calculate the interest. Okay. Now, how to get higher purchase price? Simple. Cash price plus total interest. 4,50,000 plus 68,460. That is 5,18,460. So this is how you calculate interest in each installment. So whenever any goods are sold on hire purchase basis, they may ask in the question how to calculate interest in each installment. Now, one more question they may ask is in calculation part is calculation of cash price. How to calculate the cash price in hire purchase? See, actually, you see problem number 2. Suppose Y purchase a TV on hire purchase system. As per the terms, he is required to pay 3,000 down payment, 4,000 at the end of the first year, 3,000 at the end of the second year, 5,000 at the end of the third year. Now interest is 12% per annum. Now you are required to calculate the total cash price of the TV and interest paid with each installment. So they are asking both cash price as well as interest in each installment. Last question cash price given, interest in each installment we have find out. Now in this problem we need to find out the total cash price and interest included in each installment. So down payment 3000, first installment 4000, second installment 3000, third installment 5000. So you are required to calculate the total cash price of the TV and interest paid with each installment. Sir, whenever you need to calculate cash price, sir, there are two methods for calculation of cash price. One is without annuity table, second one is with annuity table. Suppose without annuity table, how to calculate the cash price? So see here, actually in order to find out the cash price, we need to follow backward calculation method, sir. We need to follow which method, sir? Backward calculation method. Very, very important, sir. You see it here. If you understand this question, I think cash price calculation you can easily get. So first of all, what is cash price? Cash price is nothing but interest, excluding interest component. What is the amount you are paying? So if you want cash price, what you need to do? You take down payment. Down payment is entirely cash price plus each installment principal component you take. That means if you can able to separate the interest from each installment, the remaining is nothing but cash price. Now first installment, second installment, third installment, whatever the principal is there plus down payment, then you will get cash price. Okay, now my job is in each installment how much is the interest portion. If I can able to separate it, the remaining is the cash price. And if I aggregate every cash price in each installment with the down payment, then I will get total cash price. Now see here how to calculate. First always starts with the last installment, third installment in our example in this question. Always start with third installment. Sir, why you always start with third installment? See, there is a logic. You want to separate or you want to identify the interest in each installment now? Now, first thing, once you pay the last installment, okay, there is no outstanding amount. Therefore, I can assume that the last installment is combination of principal plus interest. Suppose if the principal is 100 rupees and the interest is how much? 12% given in the question. So therefore, it will be 112. Including principal plus interest, because after last installment outstanding amount is 0. Therefore I am assuming last installment the outstanding amount is 100 plus principal interest portion 12, therefore 1112. So therefore can I say my third installment is how much, sir? 5000. So this 5000 is equal to 1112. How much is for 12? You will get the interest component. So 5000 into 12 by 1112, you will get 536. That means in third installment 536 rupees is the interest. So from 5000, if I reduce 536, then I will get 4464. This is the cash price in third installment. So that's why I start with third installment. Sir, if I start with first installment, can you say 100 rupees is my outstanding amount? I calculated interest on that. No, not possible, because even after first installment also there is an outstanding amount, still balance is there, I need to pay. Therefore, I can't make an assumption like that for first, second installment. I can only make such kind of assumption for third installment, because after third installment the outstanding amount is 0. Therefore I can assume that outstanding amount is 100 and I paid interest 12% on that. So therefore last installment is equal to 1112. How much is per 12? So therefore 5000 into 12 by 112, 536 is the interest portion. So if I reduce from 5000 this interest portion, then I will get 4464. This is the cash price in third installment. Now come to second installment, backward calculation. Come to second installment. Now you are at the end of the second year, second installment. What is the second installment? At the time of second installment, what is the amount due? See here, amount due. At the end of the second year, second installment plus third installment cash price. Both are outstanding now. See, at the end of the second year, you have to pay second installment. Installment means whatever the principal you are paying in the second installment, that plus interest on outstanding amount. Now you are at the end of the second year means third installment principal is also outstanding. Therefore 3000 plus 4464. What is this 4464? Third installment cash price. You add everything. This is 7464. So that means by the end of the second installment or second year, the total amount due is 7464. Once again, I am telling, sir, this is where students are confusing. See, simple. Every installment, how much amount is due? Last installment amount is 5000 only, because after that 0 outstanding. So therefore 5000. In that 12% interest. So 12 by 112. Because I am assuming outstanding amount is 100. And if I add interest, then only I will get installment amount. Na? So this installment amount is principal plus interest both together. Now come to second installment. Find out what is the total amount due. Second installment plus third installment principal. You add everything, 7,464. This is the total amount outstanding, including interest. So this is equal to 1112. Because see, this 3,000 component is what? Installment. That means this 3,000 includes interest on outstanding amount. That means whatever the interest you are paid, you calculate it. So second installment 3,000 plus 4,464. 7,464 is the amount due. Now this 7,464 is equal to 1112. How much is for 12? 800. That means in second installment 800 is the interest included. See, this 800 is included in this 3,000 here. But I told you interest is calculated on outstanding amount. So this is also outstanding na, 4,464. Third installment cash price is also outstanding by the end of the second year. That's why it is taken here. And second installment 2,200. Same manner first installment. Amount due at the time of first installment 4,000 installment plus second installment cash price, third installment cash price. Total 10,664 into 12 by 12, 1142. Therefore first installment minus 1,124. So therefore 2,858 is the cash price in each installment. Now what I have done is, in each installment, what is the cash price, what is the interest I separated? Backward calculation. Now if I add the down payment with cash price in each installment, then I will get cash price 12,522. So these kind of problems they will ask. See, sometimes you have to find out cash price by annuity method. See, there is annuity method, means they will give you annuity factor in the question. So by using that annuity factor, you have to calculate. Suppose for example, you see in this question, on 1/1/2018, X purchased a plant from Y on hire purchase system. The hire purchase rate was settled at 60,000, payable at 15,000 on 1/1/2018, 15,000 at the end of 3 successive years. So that means 15,000 down payment, remaining 3 installments, 15, 15, 15. Interest was charged at 5% per annum. The asset was to be depreciated in the books of purchase at 10% on reducing balance method. Given the present value of annuity of ₹1 per annum at 5% interest is 2.7232. The present value of the annuity of ₹1 at 5% interest is 2.7232. Ascertain the cash price. So in this case, you should not follow backward calculation method because they have given annuity factor. So whenever there is an annuity factor, you have to follow annuity factor. See, simple here, ₹1 present value of annuity of ₹1 is 2.7232. See here, just now I have calculated. See, ₹1 annuity factor given in the question. So ₹1 will become 2.7233. This is the present value. So 15,000 is the installment. So 15,000 into 2.7233. See, this is the annuity factor for 3 years at 5% per annum. Multiply with it. Then you will get the value 40,848. This is the cash price, including down payment. Down payment another 15,000. So 55,848. So you need to multiply the installment amount with annuity factor. So annuity factor given in the question, ₹1 at 5% is 2.7232. Present value of annuity. So convert this into the present value. So the present value of ₹1 at 5% interest per annum for 3 years, it will be 2.7233. How much is for 15,000? Then you will get the present value of the installments plus you add down payment, because down payment is always part of cash price. Next, sir, third set of problems in this chapter is accounting for hire purchase. So whenever any goods are sold on hire purchase basis, what is the accounting we will follow in the books of hire purchaser as well as the hire seller? First, you take hire purchaser books. See, there are two methods: cash price method, interest suspense method. In cash price method, what happens is we will follow substance over form concept. Whenever any goods are sold on cash price basis, whenever any goods are sold by the seller to the buyer, in the buyer books, we treat it as if he purchased the asset. So therefore, asset account debtor to hire vendor account, because he purchased the asset. Substance over form will follow. Sir, you said in hire purchase, only when you pay the last installment, the ownership will be transferred. Sir, that is legal ownership. Possession will be given immediately. Therefore, in accounts, we see substance over form. So whenever any person purchase goods on hire purchase basis, he will recognize as if he purchased the asset. So therefore asset account debtor to hire vendor account. We need to make the payment. Sir, at what price? Cash price. That's why this is cash price method, at cash price. Now next, when we make the down payment as a purchaser, so hire vendor to bank, down payment. Next, interest on first installment. So when I make the payment of interest, what is the entry? Interest to hire vendor account, interest due. Interest account debtor to hire vendor account. So interest on first, interest on installment. Interest account debtor to hire vendor account, interest due. Because see, at the end of the first year, when installment become due, first I need to recognize the interest. So interest is my expense. So interest to hire vendor. So the main thing about cash price method is, initially we recognize the asset as well as hire vendor account at cash price. As and when installment become due, interest we will recognize. So interest account debtor to hire vendor. And when we make the payment of installment, hire vendor to cash or bank. And since we have recognized the asset, so we have to calculate the depreciation. So depreciation account debtor to asset. And at the end, we need to transfer the depreciation and interest to P&L account. So on transfer, what is the entry we will write? P&L account debtor to depreciation account to interest account. And next year, suppose second year, third year installments also there. Repeat the entries. Which entries will be repeated? First, purchase of asset on hire purchase basis, down payment. They will come only in the beginning year, at the time in the first year. Remaining entries like interest becomes due, installment paid, so depreciation, transfer to P&L, these entries will be repeated in the next years also. So therefore, repeat 3, 4, 5, 6. Now what is interest suspense method? See, hire purchaser, whenever he purchases any item on hire purchase basis, so asset account debtor to hire vendor account. But in interest suspense method, what he will do is, total interest also he will recognize in the beginning itself. But in cash price method, he will not recognize interest in the beginning. He will recognize asset as well as hire vendor at cash price initially, and at the end of the year, the interest will be recognized. As and when the installment becomes due, I will recognize the interest. So similarly in interest suspense method, so in interest suspense method, in the beginning itself, he will recognize the interest, but you don't know how much interest amount will accrue on each installment. That's why interest suspense account. So therefore, asset account debtor, cash price, interest suspense account debtor, total interest to hire vendor account. And whenever I make the down payment, same entry, hire vendor to cash or bank. Now whenever interest becomes due on installment, when installment becomes due, you need to recognize the interest now. So in cash price method, what entry you have written? Interest to hire vendor. Here already it is credited to hire vendor account in the beginning itself. Therefore interest account debtor to interest suspense account. Now you make the payment of installment, hire vendor account debtor to bank. Depreciation to asset. And transfer of interest and depreciation to P&L account. P&L account debtor to interest and depreciation. And which entries you will repeat? 3, 4, 5, 6. Will continue for the future years also. So this is hire purchaser books. Now coming to hire vendor books, sir. Suppose if I am a seller who is selling the goods on hire purchase basis, there are two methods. Sales method, interest suspense method. Sales method is like a cash price method. So whenever I sold any goods on hire purchase basis, so I will treat them as normal sales. So like for example, hire purchaser account debtor to sales, I will write. Hire purchaser to hire purchase sales. At what price? Cash price. Suppose in interest suspense method, in the beginning itself, I will recognize the interest. See, for me, interest is my income. So therefore, in the beginning itself, I will write hire purchaser account debtor to hire purchase sales to interest suspense. Like in cash price method, see, if I am a hire purchaser, under interest suspense method, total interest I will credit to hire vendor in the beginning itself. As and when actually the interest installment becomes due, the suspense account is cancelled. Similarly here, under interest suspense method, as a seller, whenever I sold the goods, I will recognize interest in the beginning itself. I will credit to interest suspense account. As and when actually the interest becomes receivable, installment becomes receivable, on that the interest becomes receivable, I will cancel this interest suspense account. Suppose I will receive the down payment bank to hire purchaser account. Okay, same entry in there also, interest suspense method. Interest due on installment, you see. Whenever interest becomes due, under sales method, since I have not recognized interest in the beginning, so therefore now interest becomes receivable to me. It is income for me. So interest account I will credit, hire purchaser account I will debit. See, hire purchaser to interest. But if I follow interest suspense method, the interest itself I have created in the beginning. Therefore, to the extent interest income on the installment, I will cancel interest suspense to interest. Next, on receipt of installment, whenever I receive the installment, cash or bank account debtor to hire purchaser account. Same entry. And transfer of hire purchase sales. So where we will say transfer, we will transfer it to trading account. Same entry here also. And transfer of interest. So interest is my income. I will credit to P&L account. And which entries will be repeated out of this? So the sale entry will not repeat. Remaining entries will repeat except this also. What is that? Hire purchase sales transfer to trading account. So 3, 4, 6 will be repeated. So see, very simple, Nana. If you are a hire purchaser, you have two options: cash price, interest suspense method. The basic difference is in cash price, whenever you purchase any asset, asset account, hire vendor account, you will recognize that cash price. And whenever installment become due, on that installment, whatever the interest due, that you will recognize when the installment becomes due. Like in cash price method, interest to hire vendor, there you will credit. But in interest suspense method, you see total interest itself is already created. Therefore, this interest suspense account, we will cancel it to the extent the interest now becomes due. So here the entry is interest to hire vendor. There the interest is interest to hire interest suspense account. So instead of creating to hire vendor, we will cancel the interest suspense account under interest suspense method. But if you follow this hire vendor books, he follows sales method, interest suspense method. So in the beginning, if he follows sales method, he will not recognize any interest. But if he follow interest suspense method, in the beginning itself, he will recognize the total interest. As and when actual interest becomes due, he will cancel this interest suspense account. And there are questions, you solve it. And one more important concept is repossession. Listen to me carefully, very simple. Sir, in hire purchase, there are two types of repossession. One is complete repossession, one is partial repossession. For example, there is a hire vendor who sold 3 cars to hire purchaser. Out of 3 cars, suppose if Mr. B unable to pay the installment, all 3 cars are repossessed back. This is called complete repossession. Complete repossession. Suppose if only 2 cars are taken back, this is called partial repossession. So complete repossession, partial repossession. Now see, whenever there is a repossession happen, what happens is the hire purchase transaction will be closed in the books. Okay. Now suppose for example, if you are a hire purchaser, what you will do? If you are a hire purchaser, what will you do? You have to close 2 accounts in your books. So at the time when you purchase the goods on hire purchase basis, what entry you have written? Asset account debtor to hire vendor account, na? You have to cancel both. See here, asset account you cancel and hire vendor account also close, because the transaction is completed, goods are repossessed back. So therefore, when I purchase the asset on hire purchase basis, asset account debtor to hire vendor, now reverse it, hire vendor to asset. At what value? Book value. Because complete repossession, all assets are taken back. So assets is no more there with me. So as a hire purchaser, I need to close the asset account, I need to close hire vendor account, both at book values. Suppose if there is a difference here, that will be debited to P&L or credited to P&L account. That is called loss of repossession or profit or repossession. For example, the assets cancelled is 50 lakhs. The liability, hire vendor account cancelled is 60 lakhs. So therefore the profit on repossession, 10 lakhs, it will be credited to P&L. So in case of complete repossession, hire purchaser books, close the asset account, hire vendor account at book values. Simple. Now come to hire purchaser, hire vendor books. Whenever he takes back the goods, because the hire purchaser doesn't pay the installment, what he will do is, he will open an account called goods repossessed account. So goods repossessed account debtor, in his books, he close hire purchaser account at book value. So goods repossessed account debtor to hire purchaser account. And after that, he may done some repairs, reprocessing relating to these goods. So goods repossessed account debtor to cash or bank. Then he will sell the goods repossessed. So if he sell may be at profit or loss. Suppose if there is a profit, bank account debtor to goods repossessed to P&L account. If there is a loss, it will be debited to P&L account. Now, the partial repossession. This is very, very important. Sir, suppose what happens is partial repossession. Suppose whatever the assets sold on hire purchase basis, out of that only some of the assets are taken back. For example, hire vendor sold 3 cars. Out of 3 cars, only 2 cars are taken back. Now, is hire purchase transaction is completed or it will continue? It will continue, na? It is not like complete repossession. See, in case of complete repossession, entire hire purchase transaction is closed. Why? Because entire hire purchase transaction is closed because all cars are taken back. That's why in hire purchaser books, we close the hire vendor account, asset account at book values. But in case of partial repossession, the entire hire purchase transaction is not cancelled. It will continue. Therefore, what they will do is the hire vendor and hire purchase sit together and they will come to an agreed price. See, hire purchaser books, hire vendor account will be closed at agreed value. Hire vendor books, hire purchaser account will be closed at agreed value. And assets will be cancelled at book value. See, for an asset, it is very easy to find out the book value. For example, out of 3 cars, 2 cars are taken back. What is the book value of the 2 cars? You take it, you cancel it. Assets account at book value. But hire vendor account, you have to cancel at agreed value. This is the basic fundamental difference between complete repossession, partial repossession. In case of complete repossession, hire vendor account will be closed in the books of hire purchaser at book value. But in case of partial repossession, at agreed value. Sir, what is agreed value? They will give you in the question the methodology to compute agreed value. Based on that, you arrive the agreed value. Similarly, if you say hire vendor books, hire purchaser account will be cancelled at agreed value. So therefore, these agreed values will be decided by the parties. Because the transaction is not completely closed, only partially the transaction is completed. So the transaction is still continuing between the parties. That's why. So therefore, hire purchaser books, hire vendor account will be closed at book values. Asset account will be closed at, hire purchaser books, hire vendor account is closed at agreed value. Asset account is at book value. The difference will be transferred to P&L account. Similarly, hire vendor books, hire purchaser account will be closed at agreed value and goods repossessor account will be debited. So this is partial repossession, complete repossession. And see, once he repossessed the goods, any expenses incurred on that goods repossessor to, like here, goods repossessor to bank, and then after selling bank goods repossessor, any profit or loss will be transferred to P&L account. So this is hire purchase chapter. So basically, first you need to understand what is hire purchase, and then there are some questions. Calculation part, I think this part is very important, sir, and this is also. So it is a type of a credit sale. The speciality is that when you have not paid the amount, I will take back the goods, and till now whatever you paid, that will be treated as hiring charges. Okay, your money will not be returned back. So that is the unique thing in hire purchase. And in cash price calculation, interest calculation, each installment, interest is always calculated on outstanding amount. Remember, cash price calculation 2 ways: backward calculation with annuity table. Both the problems I told. So you do one thing, around 40 minutes it has taken. So 40 minutes you listen and please try to solve the questions to the extent possible. Okay, thank you. Hi students, welcome you all. Let us discuss accounting standard 10, property, plant, equipment. Very important standard. Definitely 1 or 2 questions can be expected from this standard. See, previously we have accounting standard 10, which talks about fixed assets, and there is accounting standard 6, which talks about depreciation. Now this accounting standard depreciation, they have merged into accounting standard 10, and they have made complete changes in AS 10, and they have changed the name also as property, plant, equipment. So basically this standard has 2 parts. One is the entire accounting treatment of property, plant, equipment. Second thing is depreciation relating to property, plant, equipment. So depreciation is very easy, you can easily manage. The main focus is on the accounting treatment of property, plant, equipment. Now, what is property, plant, equipment? As per the accounting standard 10, sir, property, plant, equipment is a tangible item. In order to become PPE, it has to satisfy 2 conditions. So there are 2 conditions to be satisfied for a tangible item to be called as property, plant, equipment. So what are the 2 conditions which need to be satisfied? First of all, held for and expected to be. So property, plant, equipment is a tangible item which is held for use in production or supply of goods or services, or rental to others, or for administrative purpose. Production. See, any asset which is held for use in production of goods or supply of goods. For example, you are using plant and machinery, you are using factory in production, so they are held for use in production. For example, you are having vehicles, lorry for supply of goods, or suppose if you are a service provider, to provide your services, whatever the assets you held, they are also covered. Not only that, rental to others. See, any asset which is held by the organization for the purpose of earning rental income. For example, an organization may purchase a land or a building for rental, for getting rental income. That is also covered. For administrative purpose, any asset which is held by the organization for administrative purpose. See here, the word administrative purpose has a broader meaning, which includes all functions of the business, like selling and distribution, like accounting and financing, like personal and any other functions of the enterprise. For example, an organization may purchase a bus for transportation of its employees, so that is covered under administrative purpose. For example, an organization may purchase a car for directors traveling, so that is also covered under administrative purpose. Suppose for example, an organization may purchase a building for employees, so residents, so that is also covered here. So the term administrative purpose has a wider sense, and it includes all business purposes. So it includes selling and distribution, accounting and finance. For example, a company purchased printers, scanners, computer systems. So these are all used in accounting and financing. So that is also covered under administrative purpose, personal and other functions of the enterprise. So these are the three purposes for which an asset may be held. Now the most important condition is we are expecting to use it for more than 12 months. So in order to become any tangible item as PPE, first of all, it must held for any of the three purposes. Either it is held for the purpose of use in production of goods or supply of goods, or if you are a service provider, for the purpose of providing services, or maybe you are holding it for rental to others, or maybe for administrative purposes. And the most important thing is you are expecting to use it for more than 12 months. Now there is a separate standard AS 26 which will cover intangible items. So AS 10 is going to cover only tangible items. So this is property, plant, equipment. Now what is the objective of this standard? See, the main objective of this standard is to prescribe the accounting treatment for property, plant, equipment. See, the entire journey of property, plant, equipment, right from its purchase and initial recognition, after that its recognition in the balance sheet and everything. So all stages of the property, plant, equipment is covered in this standard. So the object of this standard is to prescribe the accounting treatment of property, plant and equipment, to put it simply. Now the scope of the standard, very important sir. MCQ may be possible, or maybe a small question can also be framed from scope of accounting standard 10. See whether AS 10 is going to cover all kinds of property, plant, equipment, I mean all kinds of tangible fixed assets. The answer is no. See, if there is any specific accounting standard relating to any tangible fixed asset, we need to follow that standard. So this is an exception to the accounting standard 10. See, in accounting standards, generally we have specific accounting standard and we have general accounting standard. Now, when there is a specific accounting standard, always follow specific accounting standard. No need to follow general accounting standard. For example, when you take any asset on lease, so there is a specific standard called AS 19 which cover all accounting of leased assets. Therefore we need to follow AS 19. No need to follow accounting standard 10, even though it's a PPE, tangible fixed asset, as per the definition of accounting standard 10. So AS 10 applied in accounting for PPE, But exception, when another accounting standard requires or permits different accounting treatment. When another accounting standard gives you different accounting treatment, and if that is the specific standard for this asset, follow that standard, don't follow accounting standard 10. This is one exception. And one more exception is, this standard is not applicable to, there are two exceptions they have given. First exception is biological assets. Sir, biological assets relating to agriculture activity. This standard is not covered, not covering these biological assets, but other than bearer plants. So that means bearer plants are subject to AS 10. AS 10 applies to bearer plants, but it does not apply to produce of bearer plants. Remember, MCQ possible. So AS 10 applies to bearer plants, but it is not applicable to the produce of the bearer plant. Now, first point, biological assets. First, we need to learn biological assets. Sir, what is biological assets? See, standard said biological assets are two things. One is living animals and plants. Living animals, plants. And most important thing is, these living animals and plants are relating to agriculture. So our ICA thought of bringing a separate accounting standard for agriculture. That's why what they're telling is, any assets in agriculture, relating to agriculture activity, generally relating to agriculture activity, the assets are plants as well as the living animals. Okay. Now these living animals and plants generally relating to agriculture activity not covered under accounting standard 10. But what they are saying is, in plants there are bearer plants other than bearer plants. Other than bearer plants, again they are not subject to AS 10. But if it is a bearer plant, then this standard is applicable. So the point number one, agriculture activity. So there will be a separate accounting standard. So therefore, relating to agriculture, any biological asset means living animals and plants. So whatever we are using in agriculture, living animals and plants, these are not subject to AS 10. See, as far as the plants is concerned, there are two things. One is bearer plant and others. Now for others, AS 10 is not applicable, but for bearer plant, AS 10 is applicable. But remember, as far as the bearer plant produce is concerned, whatever produce generated by the bearer plant, that is also not covered under accounting standard 10. This is one exception. Sir, what is bearer plant? We will discuss. See, when a plant will be called as bearer plant, see here, a plant that satisfies all three conditions. Generally, a plant which satisfies the three conditions, it is called bearer plant. Sir, what are those three conditions, sir? First condition, sir, the plant is used in growing or production of agriculture produce. Second condition is, it is expected to bear produce for more than 12 months. The third and most important condition is, there is a remote likelihood of being sold as an agriculture produce. That means the plant itself cannot be sold as an agriculture produce, of course, except for incidental scrap sales. So what are the three conditions to become any plant as agriculture plant? First, it is used in production or supply of agriculture produce. First of all, that plant is used in production or supply of agriculture produce. For example, imagine yourself a coconut tree. Now, coconut tree is grown for production of coconuts, agriculture produce. That means first condition is satisfied. Similarly, mango tree. A mango tree is grown for mangoes. Mangoes is an agriculture produce. Condition number one is satisfied. Second condition, it is expected to bear produce for more than a period of 12 months. So more than 12 months. That means that plant, we are expecting that it is going to give us benefits for a period more than 12 months. This is condition number two. Condition number three, the plant has a remote likelihood of being sold as an agriculture produce. Remote means very rare. Rare chances that it is sold as an agriculture produce. That means, suppose imagine, sir, there is a coconut tree. Now, whether this coconut tree you are growing or the farmers which are growing this coconut tree, are they willing to sell the coconut tree, or are they willing to sell the coconuts which is produced by the coconut tree? So the point is, in order to call any plant as bearer plant, the plant itself cannot be sold for agriculture as an agriculture produce. Of course, once the life is over, except for incidental scrap sales. That means, suppose for example, there is a plant which is no longer used to bear produce, they might be cut down and sold as a scrap. For example, used as a firewood. We can use it for fire as a firewood. Such incidental scrap sales would not prevent the plant from satisfying the definition of bearer plant. For example, there is a teak tree. Now you tell me, why teak tree is grown, sir? Teak tree is grown for its wood. So therefore the plant itself will be sold as an agriculture produce. Therefore it will not become a bearer plant. In order to become a bearer plant, there is a rare, remote likelihood of being sold as an agriculture produce. Only the production, the produce which is generated by the plant, the plant which is generated by the produce which is generated by the plant, for that purpose only this plant is initially grown. So these are the three conditions in order to become any plant as bearer plant. Now see, I will give you some examples. For example, tea plant. Tell me whether tea plant is a bearer plant or not. Apply three conditions. What are the three conditions? First condition, tea plant. Is it, these tea plants are grown to produce agriculture produce, is grown for agriculture produce. Of course, tea plant is giving what? Tea leaves. Second thing is it expected to bear produce for more than 12 months? Definitely more than 12 months it is giving produce. Next, whether tea plant is sold as an agriculture produce? Answer is no. So we are not growing tea plant for sale it as an agriculture produce. We are growing it for its tea leaves. So these three conditions are satisfied. Therefore, this is a bearer plant, age 10 applicable. Now for tea leaves, which is the production of this bearer plant, whether age 10 is applicable? Answer is no. Similarly, take mango tree, mango plant, mango tree. First of all, mango tree. Is it giving any agriculture produce? Yes, mangoes. Now, second thing is it expected to bear produce for more than 12 months? Definitely. Third, is mango tree is sold as an agriculture produce? Except for incidental scrap sales. Once the life of the tree is over, maybe it is cut down and sold. That is okay. That does not prevent the plant to become a bearer plant. By nature, whether that plant is grown for sold as an agriculture produce, answer is no. The mango tree is not grown for its wood. So it is not grown to cut down and sell the entire tree. It is basically for its agriculture produce. So therefore, no. So therefore, all three conditions are satisfied. Therefore, we can say it's a bearer plant. Okay. Now, standard has given some exceptions to bearer plants. In the definition itself, they said some following are not bearer plant. For example, any plants cultivated to be harvested as an agriculture produce. Just now I discussed. Just now I have given one examples also. Teak tree. Sir, any tree which is grown for its lumber, for use as lumber. Lumber means wood. Best example, teak tree. So why we are growing teak tree? For its wood. Therefore, it is not a bearer plant. Because the plant itself will be cut down and sold. Next, trees which are cultivated both for their fruit and their lumber. So sometimes some of the plants are, we are growing it for its fruit, for its produce as well as for wood. So that is also not a bearer plant. And annual crops like maize, wheat, seasonal crops, so paddy, all these are not bearer plants. So therefore, we are discussing scope of accounting standard 10. In accounting standard 10, biological assets are not covered. Now, biological assets relating to agriculture activity, not covered. Biological assets are living animals and plants. In plants, there are bearer plants, other plants, but bearer plants, this standard is applicable. Now, what is bearer plant? Three conditions: which is grown for agriculture produce, expected to bear produce for more than 12 months, remote likelihood of being sold as an agriculture produce, except for incidental scrap sales. And which are not bearer plants? Annual crops are not bearer plants. Any trees harvested for agriculture produce, for lumber, they are not bearer plants. And any trees which is harvested both for their fruit as well as lumber are also not agriculture. They are not bearer plants. Okay, and remember, AS 10 is applicable to bearer plants, but not the produce which is given by the bearer plant. Similarly, there is second exception, that is, this standard is not applicable to wasting assets. So what is wasting assets, sir? See, as and when you extract them, they will got depleted. Those are called wasting assets. The resources which is given by Mother Nature. So like for example, any minerals, oils, natural gas or similar non-regenerative resources which we cannot regenerate, only nature will give. Now those resources, so if you are extracting them, now they will got depleted. That's why they are called wasting assets, including any mineral rights. So expenditure on exploration and extraction of minerals, oils, natural gas, similar non-regenerative resources. See, these kind of assets, they are not covered under accounting standard 10. For example, a mine, so a coal mine. So is it covered under accounting standard 10? It is giving resources. So as and when you are, extracting it, it is got depleted, right? So it's a wasting asset. So that is also one kind of an asset. Whether it is covered under accounting standard 10, answer is no. Because for these kind of assets, there are some industrial standards. So those standards will be followed. So the companies which is engaged in the business of these kind of extracting these kinds of assets, there will be a separate accounting standards, they will follow it. So this is the scope of accounting standard. So if any PPE have a specific accounting standard, we will follow that standard. No need to follow accounting standard 10. First thing. Second thing, AS 10 is not applicable to biological assets relating to agriculture activity, exception bearer plant, but not to the produce of the bearer plant. And second thing, wasting assets are not subject to accounting standard 10. So we completed the definition of PPE, the objective, the scope. Now next thing is, sir, recognition criteria for PPE. Important, sir. So suppose if you want to recognize tangible fixed asset into your books, when you can recognize in the books? So this same criteria, asset recognition criteria. Asset recognition criteria. So this criteria is there in framework chapter also. So this is a fundamental. Whenever you want to recognize any asset, the two conditions must be satisfied. And the same points are applicable for AS 26 also. In AS 26, you learn about recognition of intangible assets. Same two conditions. So what are the two conditions? Whenever you want to recognize any asset in your books there, first of all, probable that future economic benefits will flow to the enterprise. It is probable. Probable means more likely that future economic benefits will flow to the enterprise. Now see, probable means more likely. That means more than 50% chance. Of course, this more than 50% chance, nowhere it is specified in the standard. But so we can assume that more likely chances means more than 50%. We are estimating or we are expecting that this asset, what we want to recognize in our books, at least it is going to give us some future economic benefits. Sir, what is future economic benefit? See, future economic benefits, maybe it may give some income in future. For example, plant and machinery. Now, you use plant and machinery in the production, so it is giving you output. Now you are selling it and it is indirectly generating sales. So it's a future economic benefits, income. Sometimes some assets will save cost. Now saving cost is also future economic benefit. Generating income, saving cost, maybe improving the performance, improving the previously assessed standards of performance. Those are all future economic benefits only. So first condition to recognize any asset is it probable that this asset is going to give me future economic benefits? any kind of benefits, either in the form of income or in the form of savings of cost? Are you confident? Are you, I mean, is it probable? That is the first question we need to ask. Second question is, can I measure this PPE, the cost? Can I measure it reliably? See, this is the most important condition, because after all, at the end of the day, we want to make sure that our financial statements are representing true and fair view. Now, when you are recognizing assets in the financial statements, they must be valued correctly. So that's why they are saying that reliable measurement should be there. You recognize any value you want. Now, it doesn't serve the purpose. That's why the standard itself categorically saying that cost of the item must be measured reliably. So therefore, two conditions are very, very important. Probable future economic benefits. Second thing is cost is measured reliably. Okay. Now, in this recognition criteria, there is one more point. Actually, this is an amendment part, of course, not now, way back. Treatment of spare parts, standby equipment, service equipment. Remember, see, spare parts. For example, in factory, there are number of machineries. Suppose, for example, there is a plant and machinery. Now, in this plant and machinery, there are number of parts, right? Now, out of these parts, some of the parts may be replaced quite regularly. Now, so suppose if I want to replace any particular part, now suppose for example I will go to the market and I will purchase it and I will fix it, so it will take a lot of time. That's why what companies will do is they will maintain spare parts, some extra parts they will maintain in the factory. Similarly, standby equipment. See, sometimes a standby equipment is necessary. So for example, the existing equipment may fail, so our production activities may got disturbed. So in order to prevent those situations, what we do is we will purchase standby equipment, and also some servicing equipment which is used in the factory or in the business. Maybe we will keep it, additional servicing equipment. So whatever standby equipment, whatever the spare parts, whatever the servicing equipment which we use in our business, which we use in factory, whether is it, treated as PPE as per AS10 or some other treatment. See, they are saying that simple treatment, case 1 and case 2. Case 1, if these three, the spare parts, the standby equipment, servicing equipment, if they are satisfying the definition of property, plant, equipment, then apply AS10. Recognize them as PPE as per AS10. That's it. Now, if they do not meet the definition of PPE, then treat them as inventory as per AS2. See, previously there is a complex procedure is there to decide whether they will be covered under fixed asset or inventory. But now they said very simply that if they are meeting the definition of PPE, we discussed now property, plant, equipment definition, it is held for expected to be. So held for use in production, supply of goods, rental, or for administrative purpose, and expected to use for more than 12 months. So if they are satisfying these two conditions, then treat them as PPE as per AS10. Accordingly, you follow AS10 in recognition of them. Otherwise, you follow AS2, treat them as inventory. So this is the recognition criteria for PPE. Now, so we covered recognition. If these two conditions are satisfied, we need to recognize PPE in our books. Now, the question is, sir, when you want to recognize an asset in your books, at what value you will recognize? That is measurement of PPE. See, in measurement, there are two situations. First, initial measurement. First time when you want to recognize, at what value you recognize. Always follow cost model, cost basis. First time when you are recognizing any asset, recognize at its cost. Of course, what elements are included in cost and how to determine the cost, that we will discuss. But understand, first time when you are recognizing any PPE in your books, follow cost model. After recognition, once you recognize any asset in your books, definitely you need to carry this asset in the balance sheet. Now in the balance sheet, either you may follow cost model or you may follow revaluation model. This is called subsequent measurement or after recognition. Now we will discuss first initial recognition. First time recognition. Sir, first time when you want to recognize any asset, any item of PPE that qualifies for recognition and asset should be measured at its cost. Always remember, it is measured at its cost. Now, accounting standard 10 says what elements are there in cost. Now, the cost of an item of PPE comprises, how to determine the cost, because the standard saying first time when you want to recognize any asset, determine the cost. How to determine the cost? What elements are there? This is very, very important. The accounting standard 10 says there are three elements in cost. One is purchase price. When you purchase the PPE, when you acquire PPE from somebody, definitely purchase price will be the first component of the cost. Second component is directly attributable cost. Third component is decommissioning restoration cost. And of course, in accounting standard 10 itself, they have categorically mentioned a list of costs with which any cost should not be part of cost of PPE. See, look at this chart. Cost of an item of PPE includes, excludes. So the cost of PPE includes what? Purchase price. This is the first. When you acquire the PPE, when you purchase the PPE, for example, you are purchasing a plant and machinery from China. So that means definitely you have to pay some amount to the supplier, and directly attributable cost, any directly attributable cost, and decommissioning, restoration, and similar liabilities. So you need to add these three in order to determine the cost and exclude these things. That means they should not be considered as a part of cost of PPE. Actually, there are four costs. At any moment or at any time, make sure that they will not be part of cost of PPE. Now, first to see the exclusion part, very simple, four cost. Remember, inauguration cost. Suppose any cost what we are incurring for opening a new facility or business, such as inauguration cost. For example, we are starting a new factory, right? Now, for opening of that new factory, some cost we incurred, inauguration cost. So we invited some guests, we distributed sweets. So some puja happened, so puja expenses, all these things happened, right? Inauguration cost. Now, these inauguration cost, can I include it as a part of cost of PPE, or can I include it as a part of cost of factory? Answer is no. So they should not be included. Anyway, they are no way connected with the asset. See, that's why the standard itself is saying that cost should not include cost of opening a new facility or any business. Similarly, any cost of introducing a new product or service, including cost of advertising and promotional activities. Very, very important, sir. Suppose, sir, an organization, suppose for example, Hindustan Unilever Limited, they are launching a new product, one soap, new soap they are launching. Now, for launching of this new soap, suppose they have hired one film star, and for him they pay 10 crore rupees. Now, you tell me whether this 10 crores, whatever the company cost incurred for promotion, advertising of this soap, will it be part of cost of PPE? For example, this 10 crores, can this Hindustan Unilever Limited can include it as a part of cost of plant and machinery which is producing this soap? Answer is no. So this advertisement cost and promotional activities. So whatever the advertisement on the holdings, papers, electronic media advertisement, Facebook advertisement, Instagram advertisement for launching of this product. So much company has spent for promotion of its product. Now all those costs definitely should not be included. Third one is cost of conducting business in a new location or with a new class of customers. This is also you should remember. Including cost of staff training, important, staff training cost. For example, sir, you have shifted, for example, your business is there in one place. For example, city X, you are doing business. Now, you want to do business in city Y. That means the place you want to conduct business in new location. Now, for that, whatever the cost you are incurring, for example, in the new city, you set up a factory, you hire some people, or you set up an office. So there are some costs you incurred for conducting business in the new city. Now, majority of the companies, what they're doing is, see, why this list has been introduced now. See, in all these cases, there is a chance that there's so many business enterprises. Definitely, I think this has practically happened. So many business organizations, what they have done is, all these costs, the inauguration cost or cost of opening a new business, cost of opening a new product, they're all capitalizing this cost, and they started adding this cost to the assets. So unnecessarily the asset cost is overvalued. So there is a no fair valuation of assets. So the assets look so huge in the balance sheet, but actually the expenditure what they have spent is for these purposes. So imagine a situation, sir, if company keep on increasing the asset cost and the life of the asset is decreasing. So suppose for example the asset life is 10 years. The 10 years is over, but still the asset value is there. Very huge amount in the balance sheet. So that will be the situation if you keep on adding all unnecessary items to the asset value. So that's why see standard says what is the common point in here? New. Remember the word new business, new product, new location, or with a new customer. For example, we are producing a product for adults, and now we want to enter into the kids business. For example, we want to manufacture products for kids. Now see, definitely that means you are dealing with a new customer, new class of customers, right? Now some cost definitely you need to incur. So can I add to the cost of the asset? No. Including cost of staff training. For example, you have given a training to staff to cope up with the business in new location. For example, in your city X, you have 100 employees. Now out of these 100 employees, 10 employees you selected for city Y, the new place where you want to do business, and you have provided training to these 10 employees and you send them to city Y for handling new business. Now whether this staff training cost can I capitalize? Answer is no. No capex is allowed in these cases. And the last one is administration and other general overheads. Admin cost we should not capitalize. General overhead cost we should not capitalize. So remember these four things. What are the four cost which is excluded from cost of PPE? Cost of opening a new facility or business, inauguration cost. Cost of opening a new product, launching a new product or service, including advertisement, promotional activities. Third, cost of conducting a business in new location or with a new class of customers, including cost of staff training, admin and general overheads. We should not include. Now, this is exclusion. Now come to inclusion. So cost includes three items. Now. First one is purchase price. Generally, what is purchase price? See, purchase cost plus taxes. Whatever the taxes relating to purchase, we will add. For example, if you are importing from foreign country, you need to pay customs duty. So that cost we will include. Of course, if it is refundable, we should not include. Only non-refundable duties and taxes will be included. So any kind of taxes, non-refundable duties you are paying for directly related to purchase include. Similarly, any brokerage, any commission we are paying which is directly relating to the purchase, so we will include. And any discount which is given by the supplier, trade discount relating to purchase, we will decrease it. So purchase price include import duties and non-refundable purchase taxes. It requires deduction of trade discounts and rebates. This is purchase price. Now second one is directly attributable cost. This is very, very important. Sir, what is directly attributable cost? See, suppose you purchased the asset. Now after purchasing the asset, to bring this asset to the present location and condition as intended by the management. So the standard says what is directly attributable cost? Directly attributable cost means the cost which is incurred to bring the asset to its present location and condition as intended by management. So as a management, for which purpose you are purchasing this asset? So to bring this asset as intended by you, as you required, as you desired, what are all costs you incurred? Capitalize. That is called directly attributable cost. So to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. For example, sir, here you can take. For example, you purchased a machinery. Suppose you purchased plant and machinery. Now suppose this is imported from China to India. Now from this moment till the moment the asset is ready for its use, all these costs, whatever you incurred to bring this asset, this plant and machinery to the present location. For example, the present location is factory. And once you brought this asset to the factory and make it ready for it capable of operating in the manner intended by management. For example, this plant and machinery, so you want to use it for production. Now, whether it is capable of operating in the manner intended by management, is it can be used for production. Now that means till the asset is completely ready for its use. For example, trial run. Last stage is trial run. Once the moment is trial run is done, we know that this asset is capable of operating in the manner intended by management. Now till that point, whatever the cost we incurred to bring this PPE to its present location and condition, we will include it. So this is called directly attributable cost. So what is directly attributable cost? To bring the asset to its present location and condition as intended by management. As intended by management. Sir, generally in this what costs are included, sir? See, standard itself has given 6 examples. With these 6 examples, you will understand. Generally, what type of costs are included here? See, once you bring the asset to the factory, present location and condition, generally what cost you will incur? For example, transportation cost, freight. Suppose this plant and machinery we imported. So from the port to the factory, so freight cost is incurred, insurance cost is incurred, loading, unloading cost is incurred, loading and unloading cost is incurred. Now see, once it is brought to factory, it must be installed. So installation cost, assembly cost, and see where you are installing this plant and machinery in your factory premises, the place must be ready. This is called site preparation cost. Site preparation cost. Now once the asset is installed, trial run will be done. So for that some cost will be incurred. All these costs, whatever the cost you are incurring to bring the asset for its location and condition capable of operating in the manner as you intended, all those costs will be included. Now see, in problems, sir, they will generally ask with these examples only. So if you remember these examples, then directly attributable cost is taken care of. See the first example, cost of employee benefits as defined in AS 15, arising directly from the construction or acquisition of an item of PPE. Very, very important, sir. Suppose, sir, you purchased a plant and machinery. Now you are installing that plant and machinery in the factory, right? Now for installation of this plant and machinery, what we have done is we have used our own labor or employees for this installation purpose. Now for that, company paid some installation fees or some compensation company paid. Now what this accounting standard 10 says, any kind of benefits, cost of employee benefits arising directly from the construction. For example, employees are directly involved in the construction of asset. So for that, you give them some amount. That is also part of cost of PPE. Don't treat it as a salary expenses. Include it as a part of cost of PPE, because the remuneration what they have paid, the amount what they have paid is directly relating to the construction of the asset or acquisition of the item of PPE. So whoever employees involved, whatever the payments you are making for construction or acquisition of item of PPE, that will be directly attributable cost. We should include it as a part of cost of PPE. Second one is cost of site preparation. See, to install this plant and machinery, sir, for example, the site must be ready. Now, for example, there is a land in the factory. Now this land, so you need to level it. And after that, suppose, for example, to install this plant and machinery, some concrete flooring is required. So you have done some concrete flooring here. So some flooring, some construction has happened. On this construction, you installed the plant and machinery. Now, whatever the cost you incurred to make the site ready for installation of the plant and machinery, that is called site preparation cost. Now, that site preparation cost is also directly attributable cost, because it is necessary to bring the PP to its present location and condition as intended by management. Next, initial delivery and handling cost. What is this initial delivery? Taking the delivery, freight to bring it to the factory, loading, handling cost, loading cost, unloading cost, all these. To bring the plant and machinery to the location, freight cost, loading cost, unloading cost, labor charges, whatever. Initial delivery and handling cost, they are all included. Directly attributable cost, they will be included. Next, installation and assembly cost. For example, once you bring the plant and machinery to the factory, you need to install it. So suppose the plant and machinery is received in knockdown condition, semi knockdown condition. So you need to completely install it, assemble it. So that installation cost. And cost of testing, trial run. I said trial run. Sir, whether trial run cost is also included? Yes. Whether trial run cost is included? Is it necessary for bringing the PP to its location and condition capable of operating in the manner intended by management? Answer is yes. Because whether we need to know, we need to know whether the PP is working in the manner we intended or not. For that, trial run is necessary. Now, whatever the cost we are incurred for trial run, that is also necessary cost. Therefore, it is directly attributable cost. So, it is part of cost of PP. But here, the important thing is, through trial run, whatever the samples we generated, whatever the production we have done, we call it as samples. Now, suppose if such samples are sold, now whatever the proceeds we received, na sir, those proceeds we need to reduce from the trial run cost. Only net trial run cost. Net trial run cost. See, after deducting the net proceeds from selling any items produced while bringing the asset to that location and condition, generally we will capitalize. And last one is professional fees. Suppose for example, any professional technician, any engineer we appointed for purchase of this plant and machinery, installation of the plant and machinery, because see, some plant and machineries are very technical in nature. So definitely outside professional services are required, an architect service, an engineer service. Now they will not come freely, so they will charge some amount. So those professional cost also should be included as a part of cost of PP. So I think you understood now directly attributable cost. So directly attributable cost means once you purchase the asset, to bring that asset to the location and condition as intended by management, what are all the costs you incurred? That is called directly attributable cost. So give me 6 examples. Cost of employee benefits, which is arising directly from the construction or acquisition of PPE. Second thing is site preparation cost. Third one, initial delivery and handling cost. Fourth one, installation and assembly cost. Fifth one, net trial run cost. Last one, professional fees. And these 4 examples are exclusions we already covered. Which cost should not be part of cost of PPE we covered. So that means in the elements of cost we covered 2 things. One is purchase price, another one is directly attributable cost. Now the most important thing is third element of cost, that is decommissioning, restoration and similar liabilities. Decommissioning, restoration and similar liabilities. Now I will explain this. Listen to me carefully. Sir, what is this decommissioning, restoration and similar liabilities cost? See, for example, sir, there is a plant and machinery. You installed this plant and machinery on this leased land. You have taken one land on lease. On that land, you installed a plant and machinery. Now, suppose this land you have taken for 10 years lease. Now, as per the lease agreement, after 10 years, you need to remove this plant and machinery. You need to remove it. And second thing is, whatever the land, so on which you installed this plant and machinery, see, for your installation, you might have done some excavations, you might have constructed some concrete flooring on the ground. So you need to restore the land as it is. Restore the land. So before lease, whatever the situation of the land, you need to restore as it is. Generally, whenever we enter any agreement relating to installation of the asset on a particular land, definitely as per the agreement, once the lease completed, you need to remove that plant and machinery from the ground. Second thing is, you need to restore the land as it is. Now you are purchasing a plant and machinery. Now that plant and machinery you are installing. So purchase price capitalized, plus directly attributable cost capitalized, plus decommissioning cost. Sir, you know, at the time of installation of plant and machinery itself, that you need to remove this after 10 years. And you also know that we need to restore the land to its original position. Suppose, for example, what accounting standard 10 says is, whatever the cost you are estimating to incur after 10 years relating to this plant and machinery, you need to estimate that cost and you need to include it as a part of cost of PP. That cost is called decommissioning, restoration and similar liabilities cost. So the future cost of removal of the asset and restoration of the land to its original position as intended, as per the agreement, is called decommissioning cost. Now this decommissioning cost should also be included as a part of cost of PPE. Sir, that means, suppose for example we are estimating, now see, we are at the beginning. Now as per the agreement, we need to remove after 10 years. Suppose we are estimating that after 10 years to remove this plant and machinery, suppose 50 lakhs cost is required. We are estimating that 50 lakhs cost is going to be incurred to remove this plant and machinery, because removal is also requires professional services, right? A professional has to remove it completely. We are estimating 50 lakhs cost. Similarly, to restore the land, we are estimating another 50 lakhs to be incurred. Now that means total estimated cost, how much we are estimating? 100 lakhs for removal and restoration. Removal and restoration. Now whether this 100 lakhs will be included as a part of cost of PPE? Answer is yes. So that means decommissioning cost, restoration cost should also be included. But the point is, sir, this 100 lakhs is a future cost. Future cost. Now if I add this 100 lakhs as it is to the cost of the asset, is asset is properly valued? Isn't it a overvaluation? Answer is yes. That's why they are saying that this 100 lakhs is a future cost. Now you are deciding the cost now. Therefore, bring it to the present value and include. Bring it to the present value and include. So that's why what we do is property, plant, equipment account debtor to provision for decommissioning cost. So this decommissioning restoration cost, for that we need to create a provision. For example, here 100 lakhs is the future cost. Now bring it to the present value. For example, the present value is 90 lakhs. Add only 90 lakhs to the cost of the asset. Sir, why can't be 100 lakhs be added? If you add 100 lakhs, what happens is your asset is overvalued, because you are deciding the cost of the asset now. But this 100 lakhs you are going to incur after 10 years. So after 10 years, 100 lakhs. But what is the position now? Because we are learning initial recognition. First time when you want to recognize an asset in your books, decommissioning cost should also be included. But the decommissioning cost should be brought to its present value. So therefore, here we need to bring it to the present value and we need to include it. See, generally there is a standard called AS 29 which talks about provisions. Generally provision should not be discounted, but I think this is the only exception. So where provision can be discounted to its present value. So here the 90 lakhs can be included as a part of cost of PP. I think you understood. So whatever the initial estimate of cost of dismantling and removing the item and restoring the site on which it is located, referred as decommissioning, restoration and similar liabilities cost. But see, there is one exception, sir. What is this exception says is, for example, there is a standard called Accounting Standard 10, which you all know, inventories. See, if an enterprise applies AS2 to the cost of obligations for dismantling, removing and restoring the site on which an item is located that are incurred during a particular period as a consequence of having used the item to produce inventories during that period. See, sometimes there is a possibility that you are installing a particular plant and machinery on a particular land, leased premises. Now suppose if this plant and machinery you are using it for production of a particular item, suppose if that is your inventory, then there is a chance that AS2 may be applied there, and those decommissioning, dismantling cost is also included as a part of cost of inventory. Now if in this case if you apply AS2, then AS10 is not applicable. Then that means you should not include it as a part of cost of PPE. Therefore, you need to see whether already companies applied AS2 relating to this dismantling restoration cost or not. If it is not applied, then we need to apply AS10. So these are the three elements of cost we need to include it. So first, purchase price. Second, directly attributable cost. Third, decommissioning, restoration and similar liabilities. Now next, sir, cost of self-constructed asset. For example, sir, you are making a self-construction of asset. That means you are not purchasing the PPE. Instead, you are making your own construction. For example, you are constructing your own building, or you are constructing a factory, or you are constructing one plant and machinery. Then in such a situation, how to determine the cost? Same manner. Same how we determine when you acquire the asset, purchase price, directly attributable cost, decommissioning cost, which cost should be excluded. Same procedure we need to follow. But some special points we need to remember. The cost of self-constructed asset is determining using the same principles as for an acquired asset. So whatever the cost you are including when an asset is acquired, same we need to apply when an asset is constructed. Self-construction. But Important 3 points are important. Remember these 3 points. First point is any internal profits should be eliminated. Sir, what is internal profit? For example, in the construction, if you are consuming your own materials, now in that material, if there is any profit element, make sure that that profit element should not be part of cost of PPE. For example, sir, I will give you one example. See, suppose for example, you are constructing a building. Okay, you are making a construction of one building on your own. Now, in your godown, there are some cement. So, in our factory, suppose you are a cement manufacturer. Now, see, from your godown, suppose for example, you have sent 1,000 cement bags for construction of this building. For example, each cement bag cost, for example, 1,000 rupees. Now, how this, cost, for example, each cement bag you are selling at 1,000 rupees in the market. Now, what is the selling price, sir? Cost plus profit. For example, your cost is, assume 800 and profit is 200. Now, that is 1,000 rupees, right? Now, what they are saying is, since you are consuming your own material, cement is your material, your inventory, but you are consuming in the construction of a building. Therefore, in the cost, how much should be added to the building? 1,000 cement bags into 800 we should take. We should not take this 200 because this is an internal profit. We should not add our own profit, internal profit to the cost of the building. So we should eliminate this internal profit because within the organization only these cement bags are consuming, right? So there is an internal profit of 200 in each cement box, each cement bag. So we should eliminate it. So therefore the cost should be taken only 800. So that is what the first point is. Any internal profit, eliminate. Second, any cost of, and one more example also I can give, sir. For example, you are installing, suppose for example, a building is constructed or one plant and machinery is installed. One plant and machinery is installed, sir. In suppose for example, department B. Now we are department A. Now suppose for example, from department A, some services are taken by department B for this installation of plant and machinery. Now department A, what they have sent is, they have sent an invoice, right? Now in this invoice, the cost plus profit they have included. Now what accounting standard 10 is, department A, department B, both of part of a single organization. So therefore, if department A services are used by department B, for that department A charged some cost plus profit, this profit should not be included as a part of cost of PPE because that is an internal profit we should eliminate. So that is the first condition you need to remember. Second thing is, always abnormal wastage of material, labor, other resources in construction of asset should not be included. The same point is there in accounting standard 2 also. If you see accounting standard 2, some cost should not be included as a part of cost of inventory. They say, what is that? Abnormal wastage of material, labor, any other overheads. Same points applies in AS 10 also. Sir, normal wastage, which is inevitable, it can be part of cost of PPE. It can be part of cost of inventory. But abnormal wastage, because of your negligence, any wastage arises and you want to add that to your cost of asset, accounting standard 10 says, no, we are not allowing it. Your negligence should not be treated as your asset. So your weaknesses, see for example, abnormal wastage of material, labor, for example, labor. So there is a normal wastage, there is an abnormal wastage. For example, if the labor abnormal wastage is more than the normal and you want to include that abnormal wastage also as a part of cost of the asset, that means you want to treat your inefficiency of the labor as a part of asset. So is it allowed? No. That's why in AS2 also it is not allowed. AS10 also not allowed. This is the second important point you need to remember. And the third important point is borrowing cost. Establishes criteria for recognition of interest as a component of carrying amount of self-constructed item of PP. See, listen, important. See, there is a standard called Accounting Standard 16 which talks about borrowing cost directly relating to acquisition, construction, production of a qualifying asset is capitalized, otherwise charged to P&L account. For example, as per Accounting Standard 10, 16, suppose if there is a qualifying asset What is qualifying asset? An asset which takes substantially necessary period of time to get ready for its intended use or sale is called qualifying asset. For example, building is a qualifying asset. Now suppose for example, if this building is constructed with borrowed funds, now the interest cost on this borrowed funds, is it capitalized to the building or is it charged to P&L account? That is what A16 says. Now suppose for example, if it is a qualifying asset and if the borrowing cost is directly relating to the construction of this qualifying asset, then we will capitalize. That is what they are saying. So any borrowing cost which is directly relating to the construction of the PP, because you are making a self construction, right? When you are making a self construction with borrowed funds, on those borrowed funds, whatever the borrowing cost incurred, if they are satisfying A16 principles, then that borrowing cost you may capitalize to the cost of PP. That is also you need to remember. So how to determine the cost of self constructed asset? Same manner as in when you acquire the asset, how you determine the cost, same manner you need to determine the cost. But you need to remember three things. One is internal profits, don't consider as a part of cost of PP. Second, any abnormal wastage of material, labor, other resources, don't include it. Third, any borrowing cost, if subject to accounting standard 16, you can capitalize. Now, the next thing is exchange of assets. This is also very, very important, sir. Sir, sometimes you may acquire PPE by exchange of asset. See here, PP acquired in exchange for a non-monetary asset or combination of monetary and non-monetary assets. For example, we acquired plant and machinery by giving some cash and one of our assets called car. That means this is what we received. This is what we have given. This is called exchange of assets, right? Now in this case, how to determine the cost of the plant and machinery we are acquiring? So, okay. Now listen, important. Now standard says, sir, in case of exchange of assets, how to determine the cost? You need to see whether there is commercial substance in the transaction or not. You need to see what? Commercial substance. Is there a commercial substance or is there no commercial substance? See, what is commercial substance? See, most of them doesn't know this commercial substance. I will explain. See, what is commercial substance? Commercial substance. See, in accounting, whether a transaction has commercial substance or not, three things we need to take: risk, timing, amount. Risk, timing, amount. See, whether the asset what we are giving up and the asset what we are receiving, the risk of cash flows, the timing of cash flows, the amount of cash flows, is there same or is there different? Suppose if they are different, then we say there is a commercial substance. If they are no different, more or less the same, then there is no commercial substance. See here, risk. For example, sir, we are receiving plant and machinery and we have given away car. Now see, this is what we are receiving, this is what we have given up. You tell me, risk of cash flows. Is car and plant and machinery is having same risk, sir? Risk of cash flows, is it same, plant and machinery and car? Definitely no. Because plant and machinery, for example, we are using in the production on daily basis. Car may not be used daily. And for example, plant and machinery requires daily servicing, maintenance. Car may not require daily servicing. So car may require daily consumption of petrol, so diesel. So therefore the risk is different. Timing of cash flows may be different. For example, servicing is done daily for this plant and machinery. For this car, for example, servicing is done once in every year or once in every 6 months. Timing of cash flows. Amount of cash flows, how much cost you are incurring. For example, plant and machinery. By using this plant and machinery, how much income you are generating or how much cost you are incurring. For car, how much cost you are incurring. So the amount of cash flows. So they say whether the asset you are receiving and the asset you are giving up, is there same? Is the risk of cash flows, timing of cash flows, amount of cash flows same or not? That is only commercial substance. So don't think about much about commercial substance. It's a very easy concept. Commercial substance means whether the asset what we are receiving and the asset what we are giving up is having same risk, different risk. Is their amount timing wise, whether they are generating cash or outflow of cash, is it same timing wise, or the amount is it same or different? For example, sir, we are exchanging one plant and machinery with another plant and machinery. Now, this plant and machinery, what we are giving up, and plant and machinery, what we are receiving, more or less same. Risk, same. Timing of cash flows, same. Amount wise, same. Then in such a situation, we say there is no commercial substance. See, when there is no commercial substance, Nana, AS 10 says, simply whatever the asset you are giving up, that asset WDV, book value, will be the value of the asset you are receiving. Because there is no commercial substance. Na? The asset is same. The asset, what you are receiving, what you are giving up, risk wise, timing wise, amount wise, same. For example, you are giving one van and receiving another van. For example, you have a delivery van. Now, you are giving up this delivery van and you are receiving another delivery van, whatever be the purpose. Now, this delivery van, what you are receiving, and the delivery van, what you are giving up, both are same. Risk wise, timing wise, amount wise, both are same. Then in such a situation, simply whatever the delivery one we are receiving, the cost will be the WDV of the asset what we are giving up. That means the same value at which the exchanged asset is there in the books will continue for this newly received delivery van. But suppose, sir, if there is a commercial substance, if the asset what we are receiving and the asset what we are giving up, risk wise, timing wise, amount wise, if it is different, sir, then in such a situation, what standard says is, in such a situation, you need to see the fair value of the asset given up. That will be the cost of the PPE. What we are receiving is the fair value of the asset you are giving up. Unless the fair value of the asset received is more reliable. That means fair value of the asset given up, fair value of the asset received, whichever is more clearly evident, we need to take. Suppose if the fair value of the asset given up is more clear, take it as the cost of the new PPE. Suppose, for example, if the fair value of the asset given up is not available. See, what is fair value? Fair value is nothing but knowledgeable buyer, knowledgeable seller in arm's length transaction. So, in perfect market conditions, at what price they are ready to value this asset, that is called fair value. Maybe it can be called as market value, but technically there is a difference. So maybe you assume it is a market value, nothing wrong. So suppose the fair value of the asset given up is known, take it. If the fair value of the asset received is more reliable, take it that. So this is the thing. Now see, if information about reliability is not available, suppose for example, reliability is missing, then in such a situation, AS 10 is suggesting three things. One is measure at fair value of the asset given up. First priority is whatever the asset you are giving up, take the fair value of that asset. Okay. Now, otherwise, if this is the question mark, then measure at fair value of the asset received. Okay. If fair value of the asset given up is not available, take second priority. Third priority is WDV of the asset given up. But of course, this is not practically possible. Definitely, you will get either the fair value of the asset given up or the fair value of the asset received. Now, so this is when, sir, when there is a commercial substance. And what is commercial substance, sir? Risk, timing, amount of cash flows of the asset given, received. Both are different. That is commercial substance. Suppose risk, timing, amount of cash flows of the asset given up and received, both are same. That means there is no commercial substance. If there is no commercial substance, no need to worry. Whatever the WDV of the existing asset you are giving up, that will be the cost of the asset you are receiving. That means the same value for the asset you are receiving will continue in the books. That is what the intention of the standard is. When there is no commercial substance, when you are not affected much by this exchange transaction, what is the need to revalue the asset again? So a transaction lacks commercial substance if the position of the company in terms of cash flows or enterprise specific values before and after the exchange transaction remains the same. If before and after the cash transaction remains the same, the exchange transaction remains the same, there is no need to make any valuation. In such a cases, the assets acquired will be measured at the WDV of the asset given up. Simply remember, whatever be the WDV of the asset we have given up, that will be the exchange, that will be the cost of the new asset. So this is how we need to decide the cost of the asset when we acquire through acquisition. Now, there are some special cases also there, sir. Special cases also there. Now see the first one. If payment is deferred beyond the normal credit terms, this is important, sir. Listen, sir. Sometimes what we do is, when we sell any asset, we will defer beyond normal credit terms. For example, when we sell our asset or when we sell our product, suppose we give 90 days credit. We give 90 days credit. This is normal credit period we are giving. For example, for a particular buyer, suppose we have given 6 months time. This is called what? Deferred beyond normal credit terms. Beyond normal credit terms. What is the normal credit terms? 90 days. But we have given how much time? 6 months time. See, when you give beyond normal credit terms, definitely you will make some extra charges. Now, what standard says is, when you have deferred the payment beyond normal terms, whatever the total payment you are receiving, from that payment, you need to reduce the cash price equivalent. Total payment minus cash price equivalent is treated as interest expenses over the period of credit, unless such interest is capitalized in accordance with A16. For example, sir, generally, credit period is 90 days, but since buyer requested, we have given 6 months credit period. And the cost of the plant and machinery is 10 lakhs. And for credit period beyond 9 months, we have charged some extra amount. For example, on this 10 lakhs, we have charged 5% extra, 50,000. So 10 lakh 50,000 is the amount received, right? Now the standard says the total payment, how much? 10 lakh 50 minus cash price equivalent. What is the cash price equivalent? 10 lakhs. Now this 50,000 is recognized as an interest expense. Don't include it as a part of cost of PPE when you have made a differing of the credit terms, unless A16 come into the picture. Suppose if A16 says the interest cost, if it is directly relating to acquisition, construction, production of qualifying asset, then capitalize. So if this instruction, what the buyer is paying, if he feels that it's directly relating to the acquisition, construction, production of qualifying asset, if this is a qualifying asset, then capitalize. So therefore, there is always an interlinking between 10 and 16. Okay. Next, sometimes PPE purchased for a consolidated price. Sir, PPE purchased for what price, sir? Consolidated price. Sir, what is consolidated price? See, one single amount we pay for a group of assets. So one single amount we paid for group of assets. In such a situation, what we do? Whatever the consideration we pay, we will apportion between all the assets based on their fair values. If the fair values are not available, there will be a competent valuer who will make the fair values, and based on the fair value of those assets, we will apportion this consideration. For example, we paid 100 lakhs to purchase one factory. Now suppose this factory is having 10 plant and machineries. Okay, two tables, office table, 2 tables, like that some assets are there. Now what we do, this 100 lakhs we will apportion between these assets based on their fair values. Based on their fair value. See, when several items of PP are purchased for a consolidated price, the consideration is apportioned to various items on the basis of their respective fair values at the date of acquisition. At the date of acquisition, suppose that in case fair value of the items not measured reliably, then make approach competent valuer. They will tell you the fair values. They will give you the values. Based on that, you apportion the consideration. Next, PP held by lessee under finance lease. Sir, suppose for example any asset is purchased under finance lease, then follow AS19. I told you in scope. So whenever there is a specific standard, follow that standard. Don't come to AS10. Next, government grant related to PP. Suppose for example any grant received from government relating to acquisition of PP. So we need to follow accounting standard 12. Now suppose what happens is, in accounting standard 12 is, suppose if you have received any grant which is directly relating to depreciable fixed asset, then in such a situation, there is one option for us that this grant amount can be adjusted from cost of PPE. This grant amount can be adjusted from cost of PPE. So you see here, the carrying amount of an item of PPE may be reduced by government grant in accordance with AS 12. So that is government grant. So when you see government grants, you will understand it. So generally remember, government grants directly relating to acquisition of depreciable fixed asset, we may reduce it from the cost of PP. So I think we have discussed the entire concept of initial recognition of PP and its different cases. Now see, treatment of subsequent cost. Sir, once PP is recognized in the books initially, there is a subsequent expenditure we are going to incur. See, what are the subsequent expenditures? Three things covered here. Regular day-to-day repairs and maintenance. Suppose in our factory there are so many plant and machineries. Now these plant and machineries requires regular day-to-day repairs and maintenance, na sir. So suppose there is a plant and machinery which requires daily maintenance, day-to-day servicing. Now all these expenses will be capitalized. It will be charged to P&L account. It should not be capitalized. Second, any expenses which increase life or efficiency of the asset beyond originally assessed life or efficiency. This is important. So always any expenditure you incurred which increases the asset life or which increases the efficiency of the asset beyond its original life or efficiency, capitalize. For example, there is a building. It's a capital asset. See, for this building, you have made one extra construction. You made, suppose for example, you constructed one room, extra room, or for example, you have a complete modification of this electric fittings in this building, so that in future when you go for expansion, these fittings will help you. Electronic fitting, complete revamping of electrical fittings. So that is also what? That is also capital expenditure, because which increases the efficiency of the asset beyond the originally assessed life or efficiency. So previously, what is the efficiency? For example, there is a plant and machinery. So to this plant and machinery, there is a old engine in this plant and machinery. Now this old engine is replaced with a new engine. Now because of this new engine, the efficiency of the plant and machinery increased. So therefore that will be capitalized. So always see whether the subsequent expenses what we are increasing, what we are spending, is this increasing the efficiency of the, is it increasing the life of the asset? Is it increasing the efficiency of the asset beyond the originally assessed life or efficiency? Then in such a situation we should capitalize. And the third one is replacements, inspections and overhauling. This is important. Sir, major replacement, major inspection, major overhauling cost. First we will discuss major replacement. For example, sir, there is a plant and machinery. In that plant and machinery, certain parts will be replaced. Suppose there is a plant and machinery. In this plant and machinery, there is one part which is one of the essential part of this plant and machinery. Now this part has to be replaced once in every 5 years. Now you tell me, whatever the cost we incurred, for example, the cost of this part is 25 lakhs. You need to purchase it separately. Can you include it as a part of cost of PP? Generally, yes. Generally, yes. That is what they are saying. Major replacements. Major replacement, not minor replacement. Major inspection and overhauling cost. Major overhauling. Overhauling means complete examination. For example, you are in aviation industry. So aeroplanes, so flights, they have to be completely overhauled once in every year or once in every 2 years as per the regulations, legal regulations. So that is overhauling expenses, inspection expenses. For example, you are having some buses. Now those buses, they have to be inspected. Major inspection must be done once in every year or once in every 2 years. So this overhauling cost, inspection cost, replacement of parts in that particular, that is major replacement. What we need to do it? Simple, we will capitalize to the asset cost. We will capitalize. Sir, see, when you are adding the cost of the new asset, obviously the WDV of the old part has to be deducted. For example, sir, I am telling you, suppose the plant and machinery WDV is 100 lakhs. Okay. Now, in this WDV, the WDV of the old part, which right now you want to replace it. So WDV of the old part is suppose 20 lakhs. Remove it because you are adding a new part, right? Cost of new part. Cost of new part. Add. Suppose the cost of the new part is how much? For example, 40 lakhs. Add it. That means what is the revised cost, sir? 120 lakhs. This is how we need to do. So any major inspection, any major overhauling, any major replacement, whenever done, you add the cost of the new replacement cost, new overhauling to the asset, but the WDV of the old must be reduced. So this is the treatment of subsequent cost. Day-to-day regular repairs and maintenance, so charge to P&L account. Expenses which increases the life or efficiency of the asset beyond the originally assessed life or efficiency, capitalized. Major replacements, major inspections, major overhauling, capitalized. Cost of the new cost will be added. Old cost WDV, which is already included in the WDV of the asset, must be deducted. Next, measurement after recognition. Sir, this is important, sir. I told first time when you recognize PP in the books, you follow cost model. Now, once it is already recognized, now the balance sheet date came. In balance sheet, we need to show this asset, right? At what value you show? That is called carrying amount. We call it as what? Carrying amount of the asset. Carrying amount of the asset. Sir, at what value you carry PP in the books? See, AS10 says there are two models. Either you follow cost model or you follow revaluation model. Whatever the model you want to follow, you follow for the entire class of PPE. So within the same class of PPE, don't follow different models. Entire class of PPE, same model. For example, plant and machinery. So see, what is class of PPE? Class of PPE is grouping of assets of similar nature and use. Similar nature and use in operations of the enterprise. Like in income tax, we have block of assets concept. Same class of assets we will classify under same block with same rate of depreciation. Similarly here, the similar nature and use in the operations of the enterprise. So for example, all plant and machineries. If you want to follow cost model, follow cost model. Suppose if you want to follow revaluation model, follow revaluation model for all plant and machinery of similar nature and use. Suppose for example, you have buildings and the buildings. Suppose you have office buildings and you have factory buildings. Now you tell me, now the company wants to follow for office buildings, they want to follow cost model. For factory building, they want to follow revaluation model. Is it allowed, sir? Answer is yes, it is allowed, because office building is one class of PPE, factory building is another class of PPE. Both are different classes of PPE. Therefore, they can follow different models. But within the office buildings, for example, we have 5 office buildings. Can I follow one for one office building cost model, for another office building revaluation model? Answer is no. So if you want to follow one particular model, you follow for the entire class of PPE. Within the class, you should not follow different models. Next. Okay, sir. You said a PP will be carried in the balance sheet, either cost model or revaluation model. Sir, how to determine the carrying amount under cost model? It's simple. After recognition of an asset, an item of PP should be carried at cost model. So cost model, simple, sir. First, take the original cost, what we determined initially, minus 2 things you need to deduct. One is accumulated depreciation. Okay. Second thing is accumulated impairment loss. So first is accumulated depreciation. Till now, how much depreciation accumulated, minus it. Second thing is accumulated impairment loss. Sir, what is this impairment loss? See, the asset subject to losses other than depreciation. You have separate standard called AS28. Any loss other than depreciation. See, an asset may lose its value due to different reasons. There should not be always a depreciation. Depreciation is a common reason why an asset loses its value. So we will reduce it, total accumulated depreciation. Apart from accumulated depreciation, there is other reason also an asset may lose its value. That is called impairment loss. If there is any accumulated impairment loss deducted, then you will get the cost of the asset. For example, cost of the asset 100 lakhs we determined originally, minus till now the depreciation is 50 lakhs, minus it. Till now the accumulated impairment loss is 10 lakhs. Therefore, what is the amount of the asset? 40 lakhs. At this value, we will carry this asset in the balance sheet. So we will show 40 lakhs in the balance sheet. By which model? Cost model. Now, suppose I want to follow revaluation model. Now, how to do this, sir? See, revaluation model is we need to revalue the asset. We want to do the revaluation of the asset. So first we will take the fair value of that asset on the date of revaluation. For example, there is a building, office building. Now for the entire class of buildings, we want to follow revaluation model. See, organization has an option. The standard itself is giving an option. If you want to follow cost model, you follow cost model. If you want to follow revaluation model, you can follow revaluation model. But which model you need to follow, which kind of assets? See, that depends. So you can select depending upon the nature of the asset you select. For example, an asset whose market value, whose pair values keep on changing, keep on fluctuating, better you follow revaluation model. And you make sure that frequent revaluation will be done. Suppose if the asset value is not changing frequently, then it is better to follow cost model. So which model I need to follow, that depends upon the nature of the asset. Okay, so but in revaluation model, what we need to do is we need to compare, we need to know the fair value of the asset at the date of the revaluation. For example, on 31st March 2024, okay, I have find out the fair market value of this building. Suppose the fair market value of this building is 100 lakhs. Take 100 lakhs. Now, from that, two things you need to reduce. What are those? Any subsequent accumulated depreciation, any subsequent accumulated impairment loss, then you will get carrying value. Here the important word is subsequent. That means, see, once you decide the fair value of this building, now 100 lakhs, after revaluation, is there any depreciation we provided? That is called subsequent accumulated depreciation. And after that, any accumulated impairment loss, that impairment loss we need to deduct. That means, see, on 31st March 2024, for example, building 100 lakhs. After taking the revaluation, fair value at the date of revaluation, any subsequent accumulated depreciation, once you revalued the asset to its fair value, after that, any accumulated depreciation, that you need to minus. Any accumulated impairment loss, that you need to minus. For example, next year onwards, for example, last year you done the revaluation. Now, next year onwards, for example, next year, 100 lakhs, suppose next year, 31st March 2025. See here, this is on 31st March 2024, you run the revaluation, the revalued amount is 100 lakhs. Now, 31st March 2025, building fair value 100 lakhs, 1 year depreciation, for example, any subsequent accumulated depreciation 10 lakhs, accumulated impairment loss 5 lakhs. So minus it. Now what is the carrying amount? 85 lakhs. So the base is fair value at the date of revaluation. See, suppose if you done the revaluation of the last year, what is the value at which you revalued? Take that value. After that, any depreciation, any impairment loss occurred, that has to be deducted to determine the carrying value. But in cost model, you take the cost. In revaluation model, you take the fair value on the date of revaluation. So the market value, you take the base. From that, after the revaluation, whatever the things happen, whatever the loss, depreciation, accumulated impairment loss, deduct it. Now, revaluation of entire class of PP, this point I told. So if an item of PP is revalued, the entire class of PP to which that asset belongs should be revalued. So there is no selective revaluation. So suppose if you want to do the revaluation for factory buildings which are of one entire class, you have to do revaluation for all factory buildings. Suppose if you want to do the revaluation of plant and machineries which belongs to same class, you need to do the revaluation for entire class of PP. Next, sir, this may be possible. MCQ, sir, frequency of revaluation. Sir, how frequently we need to do revaluation? The frequency of revaluation. See, standard says, if the PP, if the asset experience significant and volatile changes in fair value, and if the asset experiences significant changes in fair value, see here, items of PP experience significant and volatile changes in fair value. Items of PP experience significant changes in fair value, but here significant and volatile changes in fair value. So if there are significant changes and at the same time there are very volatile changes, so therefore changes happening and the change of the magnitude is also so high, in such a situation better you go for annual revaluation. But if there is only significant changes in fair value, then revalue the item once in every 3 or 5 years. For example, there is a plant and machinery. So suppose for example the fair value of the plant and machinery, or suppose for example you take building, you will understand it better. For example, there is a building. Now this building fair market value is 50 lakhs. Next year it came to 70 lakhs. Next year it came to 90 lakhs. That means there is a significant changes and which is very volatile. Suppose for example next year it came to another 40 lakhs. So because of the huge volatile changes, and of course they are significant, better you follow annual revaluation. Once in every year you do the revaluation. But even though there are significant changes, but they are not volatile, then better you do once in every 3 or 5 years. Okay. Sir, you said in revaluation model we need to determine the fair value. How to determine the fair value? See, this fair value is determined by market-based evidence. I told you, fair value is nothing but market value. So consider the evidence from the market. So market-based evidence, which is normally undertaken by professional qualified valuers. Suppose if there is no market-based evidence, see, fair market value, there is some qualified people in the market who can determine the fair market value of any asset. Take that. Suppose if there is no market-based evidence, then standard says it may be possible as MCQ that you can estimate the fair value either by following income-based approach, that is discounted cash flow projections. You need to find out the income-based approach. I mean, you need to discount the cash flows of that asset, or you may follow another concept called depreciated replacement cost approach. So it can be asked as an MCQ. For example, there is a PPE which you want to do the revaluation and fair value, market-based evidence is not available. Which of the following can be used to determine the fair value? A, discounted income-based approach, discounted cash flow projections. B, depreciated replacement cost approach. C, A and B both. D, none of the above. So therefore the answer is A and B. Either you can follow cost flow approach, discounted cash flow projections, or you can follow depreciated replacement cost approach. So these are the ways for revaluation of an asset. Now, accounting treatment of revaluation. This is very, very important, sir. See, whenever you are doing revaluation of PPE, there are two techniques, sir. At the date of the revaluation, the asset is treated in one of the two ways. Now remember these two techniques, very, very important. First, technique number 1. What is this technique number 1? See, in technique number 1, what we do is the gross carrying amount is adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. And there is technique number 2. Accumulated depreciation is eliminated against the gross carrying amount of the asset. So I think you will understand this with one example. See this example, sir. With this example, I will explain these techniques quickly. See, suppose for example, we have one PP. Now before revaluation, let us assume the cost is 1000. Okay. Now we want to do the revaluation and we want to do revaluation at 1500. Okay. So there is a cost of the asset 1000 and accumulated depreciation on it 400. And what is the net book value? 600. These are all figures already given. Assume. Okay. 1000 is the cost of the asset. Accumulated depreciation 400. Net book value 600. Now you want to do the revaluation. Revaluation will be done at fair value. Now the fair value is 1500. That means how much is the revaluation gain? 900. Because 600 is the WDV. Now the fair value is 1500. So you need to increase the asset value by 900. That is called revaluation gain. Now technique 1 says this revaluation gain should be allocated proportionately to the cost and depreciation. Sir, how to allocate the cost to how to allocate the gain proportionately to the cost of the asset as well as the accumulated depreciation? Simple, sir. This 900, whatever the gain, revaluation gain, allocate to the cost and accumulated depreciation based on their values. 1400. So suppose for example, see here, 900 into 1000 is the cost divided by 600 they have taken. So 900 into 1000 divided by 600. So therefore it will be 1500. Similarly, this one 900 into 400 divided by 600, that will be 600. So what is the meaning? See, if 1000 is the cost for 600 net book value, how much is for 900? That is what they have done. See, if 600 is the WDV, for 1000 cost, how much is for 900? So proportionately you will get 1500. Similarly, if 600 is for 400, how much is for 900? That is 600. That means proportionately they have allocated this gain to the cost as well as accumulated depreciation. Now see, after this revaluation, PP after revaluation is 2500. So 1000 plus 1500, accumulated depreciation 400 plus 600, it will be 1000. So therefore 1500 will be the cost of, net book value of the asset. Net book value of the asset. So what entry they have written here? The increase on revaluation is 900. So the journal entry is PP account debtor 1500, accumulated depreciation they have increased 600, and the gain is 900. This is what the accounting treatment. Have you understood the first accounting treatment, sir? So the first accounting treatment is whatever the revaluation gain is there, this revaluation gain is proportionately allocated between the cost of the asset and accumulated depreciation. See here, here the revaluation gain is how much, sir? 900. Now this 900 we need to allocate proportionately to the cost as well as accumulated depreciation. See, that is what exactly they have done. If you make a proportionate allocation, what happens? The cost of the asset will increase as well as accumulated depreciation will also increase. Now after revaluation, after allocation, your cost is 2500, your accumulated depreciation is 1000, and 2500 minus 1000, so 1500 is the net book value. So that's why they are saying in technique number 1, gross carrying amount is adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. So gross carrying amount is adjusted in a manner which is consistent with the revaluation of the carrying amount of the asset. So what is the carrying amount of the asset? 1500. Previously it was 600. Now you need to increase another 900 so that it will become 1500. Now in order to bring it to that 1500, how much cost to be increased? How much accumulated depreciation should be increased? That is what they are asking is. So simple, sir. If for 1000 it is 600, for 900 how much? So that is what they are doing. Okay. So proportionately you need to do it. So 900 into, so 600 divided by, 1000 divided by 600. That is what they have done. Proportionately. Here also proportionately they have increased. Cost and depreciation. This is one technique, sir. Now second technique, what, either if you want to follow first technique you can follow. There is another technique called technique 2. See, the technique 2 says this entire accumulated depreciation is eliminated against the gross carrying amount of the asset. For example, same example you take here. Suppose the cost 1000, accumulated depreciation 400, net book value 600. Now PP after revaluation it is 1500, right? Now what they have done is, first is accumulated depreciation already there, 400, that is adjusted against the cost of the asset. Now the cost of asset come down to 600. See, accumulated depreciation eliminate against the gross carrying amount of the asset. Now thus the carrying amount of the asset is reduced to 600. Now you want to make it for 1500. So how much we need to increase? 900. Therefore PP to gain on revaluation, 900. So there are two techniques. Technique 2 says, first whatever the accumulated depreciation is there, adjust against the cost of the asset. Okay. Now the cost of the asset will brought to its the WDV. Now whatever the amount you want to increase it. So therefore two entries will come. First entry is accumulated depreciation to PP, 400. Then you need to increase the asset value, PP to gain on revaluation, 900. So either you follow this, technique 1 or technique 2. Technique 1 says whatever the gain you want to increase it, proportionately increase the cost value, accumulated depreciation value. That is what exactly we have done. We have increased the cost by 1500. We have increased the accumulated depreciation by 600. That means 1500 asset increased, 600 liability, accumulated depreciation increased. Therefore, what is the net 900? That is what exactly the revaluation gain. So to account this revaluation gain, proportionate increase in asset and liability, provision for depreciation happened. But in technique 2, whenever you are doing revaluation, simply do one thing. First, accumulated depreciation adjust against the cost, so that the cost is now brought to its WDV. See, in this case, first 400 is adjusted with this cost. See here, accumulated depreciation to PP. Now it is brought to 600. Now you want to make it 1500, so increase it 900, PP to gain on revaluation. Okay, so these are the two techniques. You see it once, so very simple. Now the revaluation. What is the accounting treatment? See, whenever there is an increase in value of asset, you have done the revaluation, there is an upward revaluation. Whenever there is an increase in value of the asset, you will credit to revaluation surplus. That revaluation surplus is part of shareholders fund. Okay. Now suppose, for example, exception, when it subsequently increased, initially decreased. So, or see, for example, increase first created directly to owner's interest under the heading of revaluation surplus. But there is an exception. When it is subsequently increased, initially decreased. Suppose initially there is a decrease in the value of asset and subsequently there is an increase. Then what we need to do is recognize in the statement of P&L loss to the extent that is reversed a revaluation decrease of the same asset previously recognized in the statement of P&L account. Suppose when there is a decrease in the value of asset, we recognize that loss to P&L account. Now subsequently, if there is an increase in the value of asset, whatever the revaluation gain happened, first we need to adjust against the loss what we have already debited to P&L account previously. Only remaining amount we will credit to revaluation surplus. And suppose if there is a decrease, loss charged to P&L account. Exception, when it subsequently decreased, initially increased. Initial increase gone to revaluation surplus. Suppose if it subsequently decreased to the extent of revaluation surplus, so we need to reverse whatever the excess loss is there, that will be charged to P&L account. See, decrease should be debited directly to owner's interest under the heading of revaluation surplus. So this is very easy treatment. Anna. First time when there is a revaluation, what you have done? For example, if there is an increase in value of asset, you might credit it to revaluation surplus. Subsequently, if there is a decrease, reverse it. Suppose first time when there is a decrease, you might have, treat it as a loss debited to P&L account. Subsequently, if there is an increase, to the extent what the loss already you recognize, reverse it. Only balance loss you need to recognize. Only balance amount you need to transfer it to the revaluation surplus. Now, treatment of revaluation surplus. This is important, sir. Sir, suppose for example, there is an asset. In respect of that, you have done the revaluation. So there is a revaluation surplus. Now that asset is retired or disposed. What we need to do with that revaluation surplus? See, when an asset is disposed or retired, in respect of that asset, if there is a revaluation surplus, that revaluation surplus must be transferred to revenue reserve. This is important, sir. The revaluation surplus included in owner's interest, that is revaluation surplus, which is part of reserves and surplus, in respect of an item of PP may be transferred to where? Revenue reserve, which is nothing but free reserves when an asset is derecognized. Suppose for example, there is a plant and machinery. In respect of this plant and machinery, there is a revaluation reserve of 10 lakhs. Now this plant and machinery is retired or disposed. So it is no more there. Therefore, this revaluation reserve should also be transferred to revenue reserve. Revaluation reserve is it's a kind of fake reserve which we will not use for any purpose. But if it is a revenue reserve which can be used for any purpose. So if you see the Companies Act, for majority of the purposes, we don't use revenue reserve. Sorry, we won't use revaluation reserve, but we definitely use it for revenue reserve. But sir, here one important point, sir. Suppose for example, case 2, when whole surplus is transferred, when asset is retired or disposed, when that particular asset is retired or disposed, then the whole asset may be transferred to revenue reserve. Some of the surplus may be transferred as the asset is used by the enterprise. In such a case, the amount of the surplus transferred would be, for example, sir, when some of the revaluation reserve may be transferred to revenue reserve. For example, if the entire asset is retired or disposed, the entire revaluation surplus may be transferred to revenue reserve. Suppose, for example, you are not disposing or you are not retiring or disposing the entire asset. Only part of the asset is retired or disposed. Then only part of the revaluation surplus may be transferred to the revenue reserve. How to decide that part? The amount of surplus to be transferred in case number 2, simple. Calculate the depreciation based on the revalued carrying amount. Calculate the depreciation based on the revalued carrying amount. What is the value of the asset now? So revalued carrying amount, based on that you decide the depreciation. Depreciation based on original cost. Based on the original cost of the asset, you decide the depreciation. So based on the revalued amount, decide the depreciation. Based on the original cost, decide the depreciation. The difference is transferred from revaluation reserves to revenue reserve. This is also very important. Don't transfer revaluation surplus to revenue reserve through P&L account. Don't make it through P&L account. Okay. Now the last topic relating to PP is retirement. Suppose for example, when PP is retired from active use and it is no more giving any benefits which is held for disposal, now we need to show that PP in the books that its book value, carrying amount and net realizable value, whichever is lower. Suppose sir, once the asset life is over, what we do sir? So we want to dispose it. So we will see what is the carrying amount. For example, carrying amount means book value. Suppose the book value of the asset is 1 lakh. And if you sell it as a scrap, how much it will get? For example, it will get 1.5 lakhs. So whichever is lower, at that value, we need to show the amount. That means if the carrying amount is 1 lakh, if net realizable value is 1.5 lakhs, we need to show the asset at 1 lakh. For example, imagine a situation. Suppose if the net realizable value is only 80,000. The carrying amount is 1 lakh. Therefore, how much is the loss in value of asset? 20,000. That 20,000 we need to charge it to P&L account. So when we need to derecognize the asset. So retirement, derecognition. Derecognition means completely remove the asset from the books. When will you derecognize the asset? When you sell the asset, when you enter into finance lease, when by donation you want to give to somebody else. So when no future economic benefits are expected, then you remove the asset from the books, and at the time of removal, whatever the net disposal proceeds you are receiving, what is the book value, the difference is charged to P&L account. Okay, so this is what the accounting standard 10 entire treatment about PP. Depreciation part I am not discussing sir, because depreciation part is not that much important, or even if I think one time reading of depreciation is more than sufficient. Hope you enjoy this standard. So any doubts you had, any queries you had, please post in the comment section. So thank you all. Hello my dear students. Let us now discuss accounting standard 11, which is very important examination point of view. So what is the name of accounting standard 11? The effects of changes in foreign exchange rates. And basically in this standard, what we are going to cover is three major areas. One is any foreign currency transactions entered by Indian enterprises, and those transactions which we entered in foreign currency, and if there is any fluctuations in this foreign currency exchange rates, how we are going to deal with those foreign currency fluctuations. And also, if any Indian enterprises are having operations outside India, now the items, financial items of those foreign operations, if you are converting into Indian rupees, so what exchange rates we need to use, and how to deal with the exchange differences arising at the time of conversion, that is also addressed by accounting standard 11. The third important thing is forward exchange contract. Whenever an Indian enterprise is purchasing or buying any foreign currency, either for business purpose or for trading purpose, so at that time the differences in exchange rates, how we are going to deal with, so also addressed by accounting standard 11. Look at here, this is the notes I have given in the classroom. Now these are the basic contents what we are going to discuss in this standard. So first we are going to cover the basic object of accounting standard 11, then scope of AS 11, then some important definitions are need to be covered, then major areas 4, 5, 6. Fourth topic is foreign currency transactions, so FCTs. Fifth transaction, transactions of financial state, translation of financial statements of foreign operations, and then forward exchange contracts and disclosures. Okay, now let us discuss first of all what is object of accounting standard 11, why accounting standard 11 has been brought into the picture. See, over the last few years, or over the last 20 to 30 years, the transactions which is entered by Indian enterprises, Indian companies in foreign currency has been tremendously increased. Now Indian companies selling goods outside India, Indian companies purchasing goods from outside India, taking loans from outside India, giving loans outside India, or running branches outside India, having operations outside India. So there are so many transactions which is entered by Indian companies or Indian business enterprises in currency other than Indian rupees. See, our reporting currency is Indian rupees. Being an Indian company, we have to report everything in our reporting currency, our functional currency, which is Indian rupees. But if you entered any transaction in other than rupees, definitely that transaction has to be converted into Indian rupees in order to record, in order to report in our books. Now the challenge here is, so there is a mechanism called exchange rate. See, two different currencies. For example, we are dealing with Indian rupees, but we entered a transaction in American dollars. Now, if you entered any transaction in American dollars, this has to be converted into Indian rupees. How will you convert it? What is the unit measurement for conversion? Now, for that, there is RBI, Reserve Bank of India. Now, this Reserve Bank of India will, on daily basis, they will they will release the exchange rates. For example, they say $1 is equal to 70 rupees. Based on the international scenario, so economic conditions, they will fix this unit of measurement. Now, by following this unit of measurement, we need to convert into the Indian rupees. So next day, $1 is equal to, suppose for example, 71. So there may be fluctuations in these exchange rates. These exchange rates need not be same. So that is the challenge. This standard basically came to address only the changes in exchange rates. Normal accounting treatment will remain same. For example, when we sell the goods, if you sell the goods in India or outside India, it doesn't make any difference. Same entry we will write, sale entry we will write. But the main difference is the exchange rate fluctuation. When we sell the goods, exchange rate maybe $1 is equal to 70 rupees. When we receive the payment, maybe $1 is equal to 71. So there is a difference of exchange rates. Since you are dealing in foreign currency, now how you are going to deal with that change? What is the effect of that change in your financial statements? That effect accounting treatment is going to addressed by accounting standard 11. That's why if you observe, the name is the effects of changes in exchange rates. Exchange rate means this unit of measurement which is given by RBI on daily basis. $1 is equal to 70 rupees, $1 is equal to 71 rupees, like that they will give. Now by using that exchange rate, you will convert into Indian rupees. So there is a change in these exchange rates, and at the time when you entered a transaction, the exchange rate may be different. At the time there is a settlement of transaction, the exchange rate may be different. So that's why there is a need for a standard which exclusively talks about the changes in exchange rates. That's why ICA has brought this accounting standard 11. Of course, they have grouped these items into three categories. So first we are going to deal with FCTs, foreign currency transaction. Whenever an Indian company entered any transaction denominated in foreign currency, how we are going to deal with that, the changes in exchange rates. Second thing is foreign operations. Suppose an Indian company is having branch outside India, subsidiary associate outside India, associate outside India, and you need to convert into Indian rupees. How you are going to deal it? And forward exchange contracts is there. So this is the brief contents of this standard. Now let us start with objective of the standard. Suppose you are an Indian company. You are an Indian company. Now, being an Indian company, what is your functional currency, sir? Rupees, definitely. You have to report everything in rupees only. But you entered a transaction in American dollars. Suppose you sold goods to Mr. John in America. Now, definitely you have to, report. You have to, sell in American dollars only. And of course, when you receive the payment, you will receive payment through banking channel. So ultimately you are going to receive Indian rupees only, because holding foreign currency is not permissible as per FAMA Act. Even though you done the transaction in other than Indian rupees, ultimately the settlement will be done in Indian rupees only. So being an Indian company, your reporting should also be done in Indian rupees. Now the question is reporting which exchange rate is to be used. So which exchange rate I need to use? First thing. And then how to deal with the exchange differences, which exchange rate I need to use, and how to deal with this exchange differences. When there is an exchange difference, how I am going to deal with it, and what is the exchange rate I need to use for reporting in Indian rupees. I think you will get an idea about why accounting standard 11 came into picture. Imagine an Indian company entered a transaction in foreign currency. Now the question is, in India, we have to report it in Indian rupees. For that, which exchange rate I will use? Second thing is, if there is a fluctuations in the exchange rate, how we are going to deal it? For example, I sold the goods. I have given 3 months credit period. Now, on the date of sale, one exchange rate. On the date of settlement, another exchange rate. So there is a difference. Now, how I am going to deal with it? That is also addressed by accounting standard 11. Now, suppose an Indian company having foreign operations. You are having operations outside India. Maybe you are having a branch outside India, or maybe you are having a associate joint venture. Now you need to translate the financial statements of your foreign operations into Indian rupees, right? Because suppose you are having a branch outside India. At the end of the year, being an Indian company, I have to consolidate my branch figures also. I have to convert them into Indian rupees because this branch is suppose situated in America. Everything, every transaction, every asset, every liability, every expense, they report in American dollars. But being an Indian company, my reporting should be done in Indian rupees. So I need to convert every asset, every liability into Indian rupees. That is called translation. For that, which exchange rate I need to use for conversion? Which exchange rate I need to use? And again, suppose I have converted the entire trial balance of my branch into Indian rupees. Suppose there is a difference may also possible because I am converting different items with different exchange rates. So there is a possibility that this trial balance may not tally. Now, how I am going to deal with this that exchange difference? That is also addressed by accounting standard 11. So what I have done is I have written a simple notes that why accounting standard 11, what is the need for accounting standard 11. So accounting standard 11, why? First, Indian company entered any transaction in foreign currency. Now I need to convert into Indian rupees. Which exchange rate I need to use? And second thing is how to deal with my exchange differences. Second thing is, suppose I'm an Indian company, I'm having a branches outside India. So now at the end of the year, I need to convert into Indian rupees. Now each and every item of my branch financial statements, I have to convert into Indian rupees. Which exchange rate I need to use? And at the time of conversion, if there is any exchange differences, there is any difference in trial balance, how I am going to deal with it? It is also addressed by accounting standard 11. And third thing is, suppose I'm an Indian company or maybe a business individual, I entered a forward contract. So what is forward contract? See, forward contract is nothing but a contract for buying and selling of foreign currencies. Suppose I need American dollars after 6 months. Now I can enter a contract with bank to purchase these American dollars after 6 months for a fixed rate. So that is called forward contract. Suppose I am going to receive $1 lakh after 3 months. Now I may enter a contract of selling this $1 lakh with any bank. So at a specific rate. So that is called forward contract. So forward contract is basically a contract between two parties where one party is selling, other party is purchasing. Here the main thing is foreign currency. So Indian enterprises may also enter these forward contracts because they also require foreign currency in future. I see some enterprises doing this forward contracts as their speculation trading purpose business also. Now, if there is a forward contract, how to deal with it? What is the accounting treatment is addressed by accounting standard 11. So through objective, what I am trying to explain you is the main purpose of accounting standard 11. So that's why these four things, 4, 5, 6. So what is the object of AS 11? The object is very simple. Whenever an Indian company enters any transaction in foreign country, so foreign currency, which exchange rate I need to use to return in Indian rupees. Second thing, how I am going to deal with the exchange differences. Similarly, whenever an Indian enterprise is having branch operations outside India, I need to convert them into Indian rupees, which exchange rate I need to use, and if there is any exchange differences, how I am going to deal with it. Similarly, an Indian company entered a forward contract. So how to deal with this forward contract? That is what this standard is going to address. Now, the scope. Important, sir. MCQ is possible. Now, sir, whether accounting standard 11, what is the scope of the standard? See, this scope covers both the applicability as well as the negative items which are not covered by AS11. Very, very important. See, the items which is covered under AS11, just now we discussed. This standard discussed the following. First, FCTs, foreign currency transactions. The foreign currency transactions. Second one also, foreign operations. Translation of financial statements of foreign operations. Converting the financial statements of your branch into Indian rupees, because you are an Indian company, you need to report in Indian rupees, right? So that the translation part, at what rates we need to translate, and if there is any difference, how we are going to deal with it. AS11 addresses the issue. Third thing is forward exchange contract. So I think simply you can remember FCTs, FOs, forward exchange contract, FEC. Now the negative thing is, sir, this standard does not cover the following. See, this standard has some limitations. I think 3 limitations are there, very, very important. First limitation is, this standard is not applicable to cash flow statement. What is this? See, suppose any cash flows arising from foreign currency transactions or translation of financial statements of foreign operations, this standard is not applicable. So you cannot apply AS11 to prepare cash flow statement. Suppose we prepare cash flow statement, right? So when we prepare cash flow statement, what are all the cash inflows? What are all the cash outflows? Suppose if I entered any foreign currency transaction, from that foreign currency transaction, there may be inflow of cash. There may be outflow of cash. Sir, how to convert this inflow and outflow into Indian rupees? Can I use AS11? Answer is no. AS11 is not applicable. AS11 is not applicable. See here, sir. Non-applicability. See, this standard is not applicable to restatement of an enterprise financial statement. Second one, the presentation in a cash flow statement of cash flows arising from transactions in foreign currency and the transactions of cash flows of foreign operations. So MCQ possible. Suppose an Indian company sold goods outside India and received the payment. So inflow, sales, cash flow from operating activities. So suppose, for example, we sold $1 lakh, okay, in America. So which exchange rate I need to use? Suppose $1 is equal to 50. So 1 lakh into 50. So it will be 50 lakh rupees. Now see, this conversion, this exchange rate 50, on what basis you are taking? Are you taking based on AS11? Are you going to use AS11 to convert this financial cash flow from operating cash flow from foreign currency transactions to present cash flow statement? Are you going to use accounting standard 11? Answer is no, because for cash flow statement there is a separate standard, so therefore this standard is not applicable. So the presentation in a cash flow statement of cash flows arising from transactions in foreign currency and the transactions of cash flows of the foreign operations. Suppose you have a branch outside India. Now that branch has sold the goods, or that branch has taken a loan. So there is an inflow of cash. Branch has taken a loan. So there is an inflow of cash. So that we will present in cash flow statement. But which exchange rate I will use? AS11 remains silent. So don't apply AS11 for cash flow statement. See, that is the first exception to this standard. Second thing is most important thing. There, this standard is applicable only for translation of financial statements of foreign operations into Indian rupees, not reverse. Not, suppose for example, restatement of financial statements from foreign currency to reporting currency. That means, see, suppose for example, we are having a branch outside India. So they will prepare financial statements in American dollars. Being an Indian company, we prepare Indian rupees. Now this standard is applicable to convert this dollars into rupees, not rupees into dollars. You cannot apply AS11 for conversion of financial statements from reporting currency to another currency. Another currency to reporting currency, AS11 is very much applicable. So this is also one of the important points, sir. Here I have given restatement of enterprise financial statements from its reporting foreign currency into another currency for the conveniences of users accustomed to that currency. Not possible. This standard is not applicable. For example, we are an Indian company, so our reporting currency is here. Reporting currency rupees. Suppose we have some, users in America. So our investors are there. So we want to prepare financial statements in Indian rupees also. Suppose American dollars also. We want to prepare financial statements in American dollars also. So for that purpose, to convert this financial statements which is already reported in Indian rupees to American dollars, is this standard is applicable? Answer is no. So restatement of enterprise financial statement from its reporting currency into another currency for the convenience of users accustomed to that currency. So suppose, for example, we have investors in America, or we have investors in, for example, Russia. Now, for the convenience of those investors in Russia, we might convert our financial statements from Indian rupees to Russian currency. But for that, don't apply AS11. So this standard is, what is the intention of ICAI is very simple, sir. They drafted this standard keeping in view the requirements of the reporting currency. So not that this standard is drafted if you are preparing financial statements from one currency to another currency, you can convert from one currency to any other currency, use this standard. No, that is not the intention. Here, the intention is our financial statements should be mainly presented in functional currency, reporting currency. Now, keeping that in mind, we have given the standard. So therefore, apply this standard only to convert into Indian rupees, because for an Indian company, reporting currency is Indian rupees only. Don't apply for conversion into financial statements, restatement to other currencies. So this is also one more exception. So American dollars to Indian rupees, possible. So rupees to American dollars, not possible generally. Okay. So restatement of financial statements from foreign currency to reporting currency. Third exception, this standard is not applicable, is any exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. This is very, very important, sir. Actually, if you see accounting standard 16, which is borrowing cost definition, they say this is one of the element of borrowing cost definition. Borrowing cost includes any exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. So when we discuss accounting standard 16, I think you will understand it better. Very simple, sir. Whenever we have taken any foreign currency borrowings, and those borrowings we use it for qualifying asset as per accounting standard 11. Now A16 says to the extent it is recorded as adjustment to interest cost, we need to treat it as borrowing cost. So to put it simply, suppose there is a foreign exchange difference of 10 lakhs. AS11 generally says this foreign, now we are going to discuss it. Generally, this 10 lakhs will be charged to P&L account or will be transferred to P&L account. The foreign exchange difference, either it is a gain or loss, it will go to P&L account. But they say, see, this foreign exchange difference came from foreign loan. You have taken a loan, on that loan there is a difference, and now suppose this loan you use it for qualifying asset. Now A16 came into picture and which says, see, since you have used this foreign loan for qualifying asset, whatever the exchange difference arising from this foreign loan which you used for qualifying asset, this will be capitalized rather than charged to P&L account. But to what extent? To the extent they are regarded as adjustment to interest cost. Maybe suppose out of this exchange difference of 10 lakhs, 5 lakhs will be capitalized to qualifying asset, remaining 5 lakhs will go to P&L account. Sir, how to decide to what extent it is regarded as adjustment to interest cost? See, to the extent it is regarded as adjustment to interest cost, it will be treated as borrowing cost as per accounting standard 16. Okay, that is very, very important point. One time exam also that question came, and when we discuss accounting standard 16, we are going to discuss it elaborately. As of now, we understand that any exchange difference basically arising from foreign currency borrowings. See, they use the word borrowings, that means loans. So on foreign currency borrowings, if there is any exchange differences and to the extent they are regarded as adjustment to interest cost, now that will be not covered under accounting standard 16. That is not covered, that is not covered under accounting standard 11. So basically these are the three. This is the scope of the standard. So 3 items are part of the AS11, 3 items not covered under accounting standard 11. What are the 3 items which is covered in accounting standard 11? First one is foreign currency transactions. Second one is translating of financial statements of foreign operations. Third one is forward exchange contract. What are the 3 items which is not covered? Simple. Any cash flow statements presentation, cash flows arising from foreign currency transactions and foreign operations not covered. Second one, restatement of financial statements of foreign currency to reporting currency not applicable, and any exchange differences arising from foreign currency borrowings to the extent they are regarded as adjustment to interest cost. Now next, so we have covered the object of the standard and scope of the standard. Now there are 3 major areas as I told you. First area, foreign currency transactions. Now listen, very important. Sir, what is first of all foreign currency transaction? See, AS11 says foreign currency transactions are those transactions which are denominated in foreign currency and which requires a settlement in foreign currency, which is denominated in foreign currency. For example, see here, X Limited sold $10,000 goods to ABC Incorporation of USA. So which is denominated in American dollars and which requires settlement in American currency only. For example, see, when we sold goods to ABC Incorporation of USA, so they will pay American dollars only, na? They will not have Indian rupees to pay. So therefore, this is called foreign currency transaction. Very simple. Any transaction which is denominated and ultimately requires settlement in foreign currency is called foreign currency transaction. Now the question is, whenever an Indian company entered a foreign currency transaction, see how to do the accounting treatment. Simple. See, actually here the entire accounting of foreign currency transactions is divided into 4 parts. The first part is initial recognition. The second part is valuation on balance sheet date. The third part is exchange differences. And the last part is contingent liabilities. Okay, everything is independent. Please remember. So we are dealing with accounting treatment of foreign currency transaction. Suppose I am an Indian company, entered a foreign currency transaction. So I sold goods to Mr. John of USA, $10,000. Now how I am going to deal with it? First, initial recognition. Now the standard says, when you first time enter any foreign currency transaction, you need to record in your Indian rupees by using the exchange rate on the date of transaction. On the date of transaction. See here, initial recognition. Foreign currency transactions are initially recognized by using the exchange rate on the date of transaction. Suppose you sold goods on 25th January. So see the exchange rate given by RBI on 25th January. Use that rate to report in Indian rupees, to record in your Indian books, Indian company books. Or there is an alternative way. AS11 says, alternatively, you may use average rate of a week or a month, provided there are no significant fluctuations in exchange rates. This is very important, sir. This may ask as an MCQ. See here. Here 2 things possible, sir. First thing is, whenever an Indian company has entered any foreign currency transaction, you use the exchange rate on the date of transaction. Or you can use average rate. See here. Average. Alternatively, this is an only alternative option. Average exchange rate of a week, that week or a month. Sir, why this option is given? Provided there is no significant fluctuations in the exchange rate. So, see, suppose you are an Indian company, you are doing regular foreign currency transactions. So converting on daily basis may not be possible. That's why they are giving this option. See, do one thing. On the week or on a month, how many transactions you entered? For example, 100 transactions you entered in foreign currency. Do one thing. For this 100 transactions, you can use one average exchange rate of that month or that week, provided there should not be any significant fluctuations. Suppose, for example, during this week, exchange rate, for example, $1 is equal to 71, $1 is equal to 72 rupees, $1 is equal to 73, $1 is equal to again 71, $1 is equal to 72, like that is there in a week. Now, so there is no significant fluctuations in exchange rate. The exchange fluctuations are ranging from 71 to 73. Now in that situation, what we can do is we can take average rate of this week and use that rate to convert everything what we have entered in this week to Indian rupees. So this becomes very easy for us. But remember, there should not be any significant fluctuations in exchange rate. Suppose if there are any significant fluctuations, then this alternative option is not available. So tell me, whenever an Indian company entered a foreign currency transaction, initially you will recognize by using the exchange rate on the date of transaction, or you have an alternate option, that is average exchange rate of that week or a month can be used provided there are no significant fluctuation in exchange rates. So that means you can go for monthly conversion or weekly conversion also, if you have so many transactions. But for that we are allowing you to use average rate, but make sure that week or a month there should not be any significant exchange fluctuations. So very simple now. So I think first thing you understood. So whenever we entered any foreign currency transaction, on that date, what rate is available, use that rate to convert into Indian rupees. Or alternatively, on a weekly basis or monthly basis, take average rate provided there should not be any significant fluctuations and convert into Indian rupees. Now the question is, so you entered a foreign currency transaction. Now from this foreign currency transaction, so there may be assets, there may be liabilities arises, and this transaction will continue till its settlement, right? For example, I sold the goods, I have given 3 months time. Now that means from sale of goods, my assets will increase, debtors will come, right? Foreign debtor. Now this will continue for 3 months. Now meanwhile, subsequent measurement may also required because balance sheet date may come. See here, subsequent measurement. Suppose first we entered a foreign currency transaction, that is over, we recognize in the books. Now because of this foreign currency transaction, there may be assets, there may be liabilities arises. Now these assets and liabilities again we need to value on the balance sheet date. Sir, why sir? Because these are foreign currency assets and foreign currency liabilities. Suppose if you sell the goods in American dollars to a foreign customer, he will become your foreign debtor na? So therefore the exchange rate on the date of transaction is different from the balance sheet date. See here, that's why the concept of subsequent measurement came into the picture. So subsequent measurement or nothing but valuation on balance sheet date. After entering the foreign currency transaction, the next thing is subsequent measurement, that is valuation on balance sheet date. If this foreign currency transaction continue till balance sheet date. Now AS 11 says, for the purpose of valuation on balance sheet date, the foreign currency items, the transaction you entered in foreign currency, now because of the transaction, whatever the foreign currency items, assets or liabilities arises, they are classified into 2 types for the purpose of valuation. Those assets and liabilities are divided into 2 types. One is monetary items, another one is non-monetary items. Sir, what is monetary item, non-monetary? What is non-monetary item? We are going to discuss. First of all, why we need to classify into monetary and non-monetary item? That is the thing you need to understand. Why we need to classify foreign currency assets and liabilities into monetary and non-monetary items? Because we need to subsequently measure it. We need to make a subsequent valuation. Initially we recognized, but that initial recognition is not sufficient. Now whatever the assets and liabilities which is arising from foreign currency transaction, if they continue till balance sheet date, there should be a subsequent measurement. Now for that subsequent measurement, those assets and liabilities which is arising from foreign currency transaction, we need to divide into monetary, non-monetary item. Now say, if they say, suppose if it is a monetary item, they say if it is a monetary item, one rate we need to use. If it is a non-monetary item, and at different rates we will use. First of all, we'll understand what is monetary item. See, simple. Standard says monetary items are money held. That means cash in hand, cash at bank are always monetary items. Not only that, any asset to be received in fixed or determinable terms of money, any liability to be paid in fixed or determinable terms of money. So asset to be received in money, liability to be paid in money is called monetary items. For example, debtors. Debtors is always receivable in money. Land and billing. Land and billing, is it going to be received in money? No. So therefore it's a non-monetary item. Inventory. Inventory, is it going to be received in money? No. Only when you sell you are going to receive it money. By nature it is not going to be received in money. So anything to be received in fixed or determinable terms of money only. For example, I have given a advance for goods. So whatever the advance I have given, that is my asset. But in return, I am going to receive only goods. So therefore, it is not a monetary item. So in order to become a monetary item, either it should be an asset or it should be a liability. If it is an asset, it has to be received. If it is a liability, it has to be paid. But the remember, it must be received in fixed or determinable terms of money only. If it is a liability, it is to be paid in fixed or determinable terms of money only. So that is called monetary item. See here, I have given some examples also. Trade receivables, for example, debtors, monetary item. Trade payables, creditors, monetary item, because it is to be paid in fixed or determinable terms of money. And tangible fixed assets, for example, land and buildings. Is land and buildings is going to be received in terms of fixed or determinable terms of money? Answer is no. So it's a non-monetary item. Closing stock, is closing stock is going to be received in terms of money? No. By nature, that asset must be received in money. Anything to be received in terms of money. So monetary items. For example, investment in bonds, debentures, definitely they are going to be realized in money only, na? So whatever the investment we made in bonds and debentures, so they will be get back in terms of money only. So monetary item. Suppose if you invest in equity shares, there is no guarantee that your principal will be repaid back. So there is even though investment in equity shares is the amount to be received in money, but fixed or determinable terms of money is not possible. So therefore, non-monetary item. Prepaid expenses, non-monetary item. Why? Because prepaid expenses means what? Already expenses not incurred, but you paid. So they are not monetary items. So any asset to be received, no. Any liability to be paid, no. So any advance given to suppliers, non-monetary item. So point to understand here is what is monetary item, what is non-monetary item. Simple way to remember is anything to be received, anything to be paid in money, fixed money is monetary item. All apart from that, everything is non-monetary items. Now standard says if it is a monetary item, it is a monetary item. It's a see, monetary items always use closing rate. That means on the balance sheet date, whatever the exchange rate is there, so you need to revalue those assets and liabilities by using that rate. Suppose if it's a non-monetary item, you have to see whether it is carried at historical cost or it is carried at fair market value or NRV. For example, land and building, non-monetary item, it is not to be realized in fixed or determinable terms of money. So land and building. Now generally land and building carried at historical cost. So therefore actual rate, whatever the rate at the time of initial recognition you used, same rate. That means there is no subsequent remeasurement. No remeasurement is required if it is a non-monetary item which is carried at historical cost. Same rate, same thing will continue. Subsequent measurement is not required. Suppose if it's a non-monetary item like inventory. Now inventory carried at fair market value or NRV, maybe NRV, cost or NRV, whichever is lower. For example, NRV is lower, so you're carrying at NRV. Okay, now in such situation use closing rate. Or for example, investment in equity shares. Investment in equity shares is a non-monetary item, so generally carried at fair market value. So in such a situation use closing rate. So simple, you entered a foreign currency transaction. Initially at what rate, what on the date of transaction, what is the exchange rate, use that rate. Alternatively, you have an option to use average rate of a week or a month, provided there are no significant fluctuations. First thing is over. Second thing is come to subsequent measurement. Whatever the foreign currency transaction you entered, that transaction has given you either an asset or a liability. For example, you sold goods on credit basis to a foreign customer. That means that has given you debt or asset. Now that asset which is arising from foreign currency transaction, you need to remeasure it on balance sheet date. Of course, if it is settled before balance sheet date, then there is no problem. No subsequent remeasurement is see, subsequent measurement when it is required after initial recognition. Suppose balance sheet date may came. So on the date of balance sheet, again you need to revalue it. Or after initial recognition, there is a settlement of transaction. On the date of settlement, there may be again requirement of valuation. Subsequent remeasurement may be required. So for that subsequent measurement, what we need to do is we need to convert these items which is arising from foreign currency transactions into two: monetary, non-monetary. If it is a monetary item, closing rate you use. Closing rate means the exchange rate on the date of balance sheet date. Suppose if it is a non-monetary item, you have to see whether that non-monetary item basically carried at historical cost or is it carried at fair market value or NRV. See, there are some assets we will carry at fair market value or net realizable value. For example, inventory. Generally, inventories are carried at cost or NRV, whichever is lower, NRV. Investment in equity shares. So like that, there are certain items we may carry at fair market value also. When you are carrying these items, and if they are already non-monetary items and you are carrying at fair market value or NRV, use closing rate only. But if they are carried at historical cost, use actual rate only. No subsequent measurement is required. That means in this case, there is no exchange difference. Because initially, whatever the amount whatever the rate you used for conversion into Indian rupees, the same rate will continue now. So there is no exchange difference. But in these two cases, that is monetary items and then non-monetary items carried at fair market value, you need to subsequently remeasure it closing rate. So there is a difference. Opening rate, initial recognition, one rate. For example, you sold goods on January 1st, 2024. At that date, $1 is equal to 100 rupees. So you recognize sales at 100 rupees. You recognize debtors at 100 rupees. For example, now 31st March 2024, balance sheet date came. $1 has become 110 rupees. Now you need to increase debtors by another 10 rupees because the standard says debtors is a monetary item. We need to evaluate closing rate. That means you need to brought debtors from 100 to 110 rate. 110, 110, 110. So that is called subsequent measurement. So standard says you entered a foreign currency transaction, no problem. Initially use the exchange rate on the date of transaction. Then go for subsequent measurement. What is subsequent measurement? For that purpose, you convert the foreign currency item, the foreign currency transactions, from the transaction, whatever the assets and liabilities arises into two types: monetary, non-monetary. Monetary items are money held and any asset to be received in money, fixed money, any liability to be paid in fixed money. And monetary items always use closing rate. Non-monetary items, if they are carried at historical cost, keep it at original rate only, no need of subsequent measurement. If they are carried at fair market value or net realizable value, use closing rate. And there is one more thing here. So actually, we are discussing foreign currency transactions. So in this, we completed initial recognition, valuation on balance sheet date. Now, what about the exchange differences? So see, initially you recognized at one rate and you are doing subsequent measurement, right? The subsequent measurement, you are using closing rate on the date. Now, there will be exchange difference now. How we are going to deal with it? Simple. Exchange difference always transfer to P&L account. That's it. Exchange difference are always transferred to P&L account. So when you entered a transaction, whatever the rate is there, and on the balance sheet date, whatever the rate is there, the difference will charge to P&L account. And suppose if there is any contingent liabilities in foreign currency, use closing rate. So these liabilities are reported at the exchange rate on the balance sheet date. That means closing rate. So closing rate, you use it. So this will be done. So I think we have completed accounting for foreign currency transactions. Initial recognition, subsequent measurement, exchange difference, and contingent liabilities. Initially, rate on the date of transaction. Subsequent measurement, monetary items closing rate, non-monetary items carried at historical cost, original rate. That means rate on the initial recognition. So therefore, there is no remeasurement is required. no exchange differences will arise. Second thing is, if they are carried at non-monetary items, if they are carried at fair market value NRV closing rate, and any exchange differences, the difference on the initial recognition and subsequent measurement, charge it to P&L account, transfer it to P&L account. Any contingent liabilities, again use closing rate and report it in the financial statements. We know contingent liabilities are not part of direct balance sheet and P&L account. Of course, we can report them in the notes to accounts or board of directors report. For that purpose, they may be converted into Indian rupees. Now, next thing is, there is one option called option under para 46A, which is very, very important, sir. I will tell you that option. Yes, option under para 46A. Sir, what is this option? See, government has given an option to an Indian enterprise that if there is any foreign currency fluctuation, exchange difference, generally what is the treatment? Just now we learned, if there is a foreign exchange difference, we are transferring to P&L account, either if it is exchange gain or loss. See, foreign exchange difference can be a gain or can be a loss also. Either way, we are transferring it to P&L account. But one special option is also there. Suppose sometimes instead of transferring to P&L account, these exchange fluctuations you may adjust to the asset cost. Suppose especially if you are purchasing a depreciable asset by using foreign currency borrowings. Now, whatever the differences arises, those differences instead of transferring to P&L account, you adjust to the cost of the asset. Accordingly, the cost of the asset will change and the remaining depreciable amount will be depreciated over the remaining life of the asset. Sir, why this alternative has given to the companies? The simple, exchange difference will have a direct effect on P&L account. That means it is directly affecting the profits. So suppose in a particular year, if these exchange differences are so huge, then there is a possibility that it may negatively affect the profits of the organization because of these exchange fluctuations. Basically speaking, exchange differences, why exchange differences will come? There are so many reasons which are not under the control of any company. There are so many external factors which influence the determination of exchange rates. So how can you say these exchange differences, because of these exchange differences, your profits are going to be affected, so you are the reason, and there will be negative impact on the organization. So many investors feels that the company is not performing well. Suppose internationally the situation is not good, the exchange rates may fluctuate. Now we are taking a direct toll because of that. So in order to avoid that situation, companies made a request to the government. Now government came up with this clarification. They are saying that, see, we are giving this option. This is only an option. It is not compulsory. But in order to apply this option, there must be long-term foreign currency monetary items. Long-term. What is this long-term foreign currency monetary item? You entered a foreign currency transaction. Because of that foreign currency transaction, there must be an asset or liability which is having a life of 12 months. Suppose if you entered any foreign currency transaction which is to be settled within 12 months, don't apply this option. This option is only for any asset and liability arising from foreign currency transaction which has a life of more than 12 months. That is called long-term foreign currency monetary item. But first of all, it should be monetary item only. It should be asset or liability, monetary item, and it should be more than 12 months. Then it has divided into two types. One is if it is directly related to acquisition of depreciable asset. In other cases, suppose if it is directly related to acquisition of depreciable asset, what is this? For example, we have taken a loan from foreign country for acquisition of a depreciable fixed asset. That means this foreign currency borrowings has given me a liability. What is that liability? Long-term foreign currency monetary item, which is directly relating to acquisition of depreciable asset. Now, in such a situation, whatever the exchange difference arising from that loan, see here, exchange difference arising on such items is adjusted to the cost of the asset. So, adjusted depreciable amount is depreciated over the remaining life of the asset. For example, we have taken a loan from foreign currency $1 lakh. Okay. Now, on the date, 50 rupees is there. So that means we have taken 1 lakh into 50. That means 50 lakhs loan we have taken. By using this 50 lakhs, we purchased one plant and machinery. So suppose we purchased a plant and machinery. So plant and machinery account debtor 50 lakhs to loan account, to loan account 50 lakhs. Now the question is, this loan is a foreign currency monetary item. At the time you have taken the loan, $1 is equal to 50. Now you need to settle this loan, suppose in a period of 5 years. Now every year there is an exchange fluctuation. You need to subsequently remeasure it by using the closing rate, because it's a monetary item. Monetary items are always valued at closing rate. Suppose the closing rate of the first year is 55. That means 5 rupees increase. Now you need to brought your loan amount from 50 lakhs to 55 lakhs. So 50 has become 55 rupees. So 1 lakh into 55 rupees. That means 55 lakhs. Now 5 lakhs there is an increase now. That is called exchange difference. Basically that exchange difference will be transferred to P&L account, right? But here that exchange difference, instead of transferring to P&L account, what we need to do is we need to adjust it to the asset cost. Cost of the asset will be adjusted. Therefore here in this case what we need to do is foreign exchange difference account debit to loan account 5 lakhs, and this foreign exchange difference will be adjusted to asset cost. That means plant and machinery account debit to foreign exchange difference. And in other cases what we will do, in general case, if you have not opted for para 46A, you will transfer it to P&L account. Since you have opted for para 46A, you are adjusting to the cost of the asset. So remember, this option under para 46A is available only for long-term foreign currency monetary items. It has to be divided into two things. One is it is directly related to depreciable fixed asset. Then instead of transferring P&L account, exchange difference directly adjusted to the cost of the asset. Okay. Remaining depreciable amount of the asset will be depreciated over the remaining life of the asset. Now see, in any other case, all other long-term foreign currency monetary items. For example, you have taken a foreign loan, but that loan you have not utilized for purchase of depreciable fixed asset. That loan you might use it for working capital, or that loan may use it for business expansion, for any other purpose. Then in such a situation, government is saying that, see, generally you will transfer exchange difference to P&L account now, but if you elect para 46A and you have taken a foreign currency loan, that loan you have not utilized it for acquisition of depreciable fixed asset, then we say this exchange difference you can transfer it to separate account called FCMITD account. Very, very important. Foreign currency monetary item translation difference account. Foreign currency monetary item translation difference account. Sir, what is this FCMITD account? See, this FCMITD account is nothing but exchange difference arising from other long-term foreign currency monetary items. Long-term foreign currency monetary item directly related to acquisition of depreciable fixed asset is adjusted to asset cost. But if it is not directly related to acquisition of depreciable fixed asset, then it will be transferred to a separate account called FCMITD account. Don't directly transfer to P&L account. Now this FCMITD account, foreign currency monetary item translation difference account, is amortized over the remaining life of the asset or liability. For example, you have taken a loan from foreign currency. Now that loan period is 5 years. Now amortize it over a period of 5 years. Remaining life of 5 years, this difference will be amortized. I think this is the option under para 46A. So I think you understood option under para 46A. Once again, I'm telling, very simple. What is the basic general treatment? Option under para 46E. Basically, option under para 46E A is nothing but an indirect way of presenting foreign exchange differences. Generally, foreign exchange differences directly will be taken to P&L account. But government is giving an option that, see, we have an alternative mechanism. Since you are asking that in a year, suppose if there are huge significant fluctuations, your P&L account may got affected directly. So some of your investors might think negative about your performance. So that's why we are giving this option. See, this is only an option. If you want, you can take it. And the thing is, this is irrevocable option. Once you select it, you have to complete it. Okay. Now, I don't think so this option is now available to any business enterprises. This is an old option, but the companies which is already selected this option might be need to continue this till it is completely written off from the books. But what is this option? In exams, they may ask, do the accounting treatment as per para 46A. You have to remember, first of all, this foreign currency transaction, whatever entered, is it directly related to the acquisition of depreciable asset? Yes. Then the exchange difference arising from it adjusted to the asset cost. Simple. Don't transfer it to P&L account. Second thing, suppose if this foreign currency transaction, whatever I entered, remember foreign currency loan in a simple way. Foreign currency loan I have taken, but I have not used it for acquisition of depreciable fixed asset. I am using it for any other purpose. Then such a situation, whatever the exchange differences arising on this, you can transfer to FCMITD account. MCQ possible. foreign currency monetary item translation difference account, and this FCMI TD account will be amortized over the remaining life of the asset or liability which you have acquired through this foreign currency monetary item. Okay, so I think this is the treatment of this one. So that means we have completed the first part. So I told you this standard basically talks about three things. One is foreign currency transactions and its accounting. Second one is translation of for financial statements of foreign operations, that we need to discuss now. Translation of financial statements of foreign operations. Suppose, sir, you are an Indian company, you may have foreign operations. See, you may have foreign branch, you may have foreign subsidiary, you may have foreign associate, you may have foreign joint venture. Suppose you are having a branch. Now, you need to convert into Indian rupees now. Similarly, for subsidiary, associate, joint venture also we need to convert into Indian rupees because we need to prepare consolidated financial statements. We need to prepare consolidated financial statements for the entire group. For that purpose, you need to convert into Indian rupees, right? Now, what exchange rate I will use? Now, accounting standard says, see, whatever the foreign operations you have, those foreign operations financial statements, if you want to convert into Indian rupees, for the purpose of conversion, these foreign operations are divided into two types basically. For the purpose of translation of financial statements of foreign operations, these are divided into two types. One is integral foreign operations, another one is non-integral foreign operations. Sir, what is integral foreign operation? What is non-integral foreign operations? First, we need to understand that, because the main thing is, for the purpose, this will help you in branch accounts also. In branch accounts, we have a topic called foreign branches. Now, foreign branches trial balance we need to convert into Indian rupees, right? So what exchange rate you will use? So for that purpose, we've classified foreign branches into integral, non-integral. What is integral foreign operations? What is non-integral foreign operations? So in a way, we can say that integral or dependent, non-integral or independent organizations. But actually, that is a wrong way of classifying things. The people, those who don't know accounting standard 11, so they might put it in that way. But actually, AS11, if you read, there are some indications in AS11. Those indicators will help you to identify whether that foreign operations is integral or non-integral. I think I will try to show those indications. Yes. Now see, indication, integral foreign operations, non-integral foreign operations. So actually, there is para 20 of accounting standard 11. This para has given some indications. Now totally there are 8 indications. If majority of the indications indicating it is integral, it is integral. Otherwise, non-integral. See here. First indication number 1, significant degree of autonomy. Whether your foreign operations is having significant degree of autonomy? Answer is yes. Autonomy is there. Freedom is there. Then it may be non-integral. It is not integral. This is the first indication. You see whether they are enjoying significant degree of autonomy. Suppose you have a branch in America. Whether that branch is enjoying significant autonomy. So they have the freedom to take their own decisions. If answer is yes, then they are non-integral, not integral. Second indication, high proportion of transactions with reporting entity. See whether your branch outside India or subsidiary outside India is doing high proportion of transactions with the reporting entity only, with the Indian company only, reporting entity, high proportion of transactions. If answer is yes, then it is integral. If it is a non-integral, sir, it won't do high proportion of transactions with reporting entity. This is another indication. You see, out of the transactions they are doing, how many transactions they are doing with reporting entity? Suppose out of the sales they made, out of purchases they made, every purchases, every sales, every type of transaction they entered only with reporting enterprise. That means it's an integral foreign operation. Depends on local borrowings and own profits. Suppose your branch outside India or your subsidiary associate outside India, depending upon their own borrowings, local borrowings. For example, you have a branch in America, they are taking a loan in American rupees, American dollars, sorry, American dollars. So they are depending on their own profits. They are not depending on you. So then that means it's a non-integral foreign operation. Next, sale price determined by considering local competition and standards. The sale price decided by branch itself. They are not taking permission from head office. Non-integral. See here, these indication. I will fix my sale price. I will take my own borrowings. I will use my own profits. So these are all indications that they are non-integral foreign operations. Next, cash flows of reporting entity affected regularly. So if cash flows are affected regularly, definitely there will be huge transactions are happening between the reporting enterprise and its foreign operation. So it's an integral. This is an indication. Active sales. Suppose if the foreign branch are not have active sales are there, it's a non-integral. Suppose if that does not have active sales outside India, sorry, outside with others, they does not have any sales, then definitely it's an integral foreign operations. And cost of material, labor, other components settled in local currency only. Suppose for example, labor cost, material cost, so they will pay in local currency only, non-integral. They will not, all these payments will not be done by reporting entity. Sales mainly in currency other than reporting currency. If sales are happening mainly in currency other than reporting currency, so non-integral. See, you are not required to remember all these indications, but what we can conclude is, after reading all these indications, you see, first, autonomy is there, non-integral. Depends on local borrowings and own profits, non-integral. Sale price is decided by the foreign branch itself, non-integral. And we have active sales, non-integral. And our material cost, labor cost, other components we settled in our local currency only. Local currency means that currency where we situated only. And our sales is there mainly in currency other than Indian rupees, reporting currency. So all these things are indicating that we are functioning independently. We are taking our own decisions. We are not depending upon the reporting entity much. Then we say it is a non-integral foreign operation. Otherwise, it is integral foreign operations. So the standard says if it is an integral foreign operations, simple. If it is an integral foreign operations, what we need to do is, this is the procedure. Monetary items, use closing rate. Whatever the monetary items of foreign operations are there, convert them by using closing rate on the balance sheet date. If there are some non-monetary items in the foreign operations financial statements, if they are carried at cost, original rate only, same rate originally we used to convert. If they are carried at fair market value or NRV, closing rate. Same thing what we have learned, sir. Subsequent measurement on balance sheet date. So monetary items closing rate, non-monetary carried at cost, original rate only, continue at original rate only. And if they are carried at fair market value or NRV, closing rate. And suppose if P&L account items are there, expenses, incomes in foreign branch, foreign operations, trial balance, convert them by using rate on the date of transaction, or you use average rate. Any contingent liabilities are there, closing rate. This is integral foreign operation. Now see, any difference arises on translation into Indian rupees, transfer it to P&L account. Integral foreign operations. Because these integral foreign operations are nothing but dependent organizations. They are extensions of the head office. They are extensions of the reporting entity. So therefore, whatever the exchange difference arises, sir, transfer it to P&L account. Consider that as your own profit or loss. But if it is a non-integral foreign operations, so the rates will be different. Whether it is a monetary item or non-monetary item, so use closing rate. There is no such thing as non-monetary items carried at cost, original rate only, carried at fair market value, closing rate. No need to remember like that. Simple, if it is a non-integral foreign operations, whether monetary or non-monetary item, any asset or any liability, whether monetary or non-monetary, closing rate. If it is a P&L account item, simple, rate on the date of transaction or average rate. Any contingent liability, closing rate. So what is the difference, sir? The difference here is, in case of integral foreign operations, we will make a classification: monetary, non-monetary. Monetary, closing rate. Non-monetary, again we see whether it is carried at cost or fair market value. If it is carried at cost means original rate. If it is carried at fair market value means closing rate. But there is no such classification required here. Monetary, non-monetary, simple closing rate. But the difference is, any exchange difference arising on translation into Indian rupees will be transferred to a separate account called foreign currency translation reserve account. There, in case of integral foreign operation, any exchange difference arises on translation, we are transferring to P&L account now. But here we are transferring to FCTR account, foreign currency translation reserve account. See, actually this standard. And see, one more point, FCTR account should be shown under the head reserves and surplus till the date of sale of such foreign operation. This is also possible that an MCQ may be asked. So suppose you have converted the trial balance of non-monetary non-integral foreign operations into Indian rupees, exchange difference came. That exchange difference you need to transfer to FCTR account. Suppose FCTR account 50,000 came. Now this 50,000 account you need to show as a part of reserves and surplus. Now see, as long as you are holding investment in that foreign operations, it will continue. Suppose if you dispose the investment in that foreign operations, then it has to be, this FCTR account will be cancelled and transferred to P&L account. Okay. So here two things is important, sir. FCMITD account. What is this FCMITD account? Foreign currency monetary item translation difference account. This comes under para 46A. When it is a long-term foreign currency monetary item, other long-term foreign currency monetary item directly not related to acquisition of depreciable fixed asset, then the difference we will transfer it to this FCMITD account. This FCMITD account will be depreciated over the remaining life of the asset or liability. And this is FCTR account. When this will come? FCTR account will come when you are converting the foreign operations trial balance financial statements into Indian rupees. Whatever the exchange difference arises, in case of non-integral foreign operations, it will be transferred to FCTR account. So now there is one more concept called reclassification. This is also important. Listen, reclassification of foreign operations. See, initially there is a foreign operation for us. There is a branch that may be integral for us. Integral. Those indications we have seen. Majority of the indications suggested that it is integral, so we classified as integral. Now later on it may change. For example, foreign branch initially depend upon its head office, but now they are taking their own decisions, they are taking their own borrowings, they are making their own sales, they are not depending upon head office or reporting entity much. Then it becomes integral to non-integral. It has become now non-integral. So non-integral is a kind of a independent branch. So integral is kind of a dependent branch. Now anytime there may be change. See, because initially we want to control our branches. Suppose later on we changed our policy, management has changed the management structure and policy, and we may give autonomy to the branches so that they will function well, like that. So anytime there is a reclassification possible. Initially it is integral, now it becomes non-integral. Initially it may be non-integral, now it becomes integral. Now if there is a change, reclassification, what we need to do? Simple. If it is integral to non-integral, sir, any exchange gain or loss arising from the date of reclassification, FCTR account we should transfer, because till now it is integral, now it is non-integral. We have just now seen, in case of non-integral foreign operations, any exchange difference arising from foreign currency transactions definitely will be transferred to FCTR account. So we will transfer it to FCTR account. Okay, but non-integral to integral, important. Till now it is non-integral. That means whatever the exchange difference arises on translation, we transfer it to FCTR account. FCTR account. Now onwards it is integral, right? When it is an integral foreign operation, whatever the exchange difference arising from foreign currency transactions, will transfer it to P&L account. Now exchange gain or loss from the date of reclassification should be transferred to P&L account. Now what about FCTR account, which is already there? That will continue, and the balance in FCTR account will continue in balance sheet till the date of sale of foreign operations. This may be asked as an MCQ. Suppose you have one branch, it is your non-integral branch. So exchange difference arises on translation into Indian rupees, that you transfer to FCTR account. Okay, now it becomes your integral operations. The moment it becomes integral, now onwards, whatever the reclassification, whatever the translation you are doing in Indian rupees, you will transfer it to P&L account. What about this FCTR account? It will continue till the date you dispose it. Dispose the investment in that foreign operation. Suppose if I sold part of the investment in that foreign operations, then you need to transfer part of the FCTR account to P&L account. Important. If investment in non-integral foreign operations is sold in part, then FCTR account is also proportionately transferred to P&L account. Proportionately, we need to transfer it to P&L account. This is, reclassification of foreign operations. Now, we have one more topic, sir, that is forward exchange contracts, which is very, very important. Now, let us discuss forward exchange contracts, which is very, very important. First of all, what is this forward exchange contract in the context of accounting standard 11? So, as I told you in the beginning, forward exchange contract is a agreement between two parties. Imagine, suppose I'm a businessman, so I'm running a business, and there is a bank. So, between me and bank, between the business enterprises and bank, so it's an agreement between me and my bank, two parties, whereby one party agrees to buy. Suppose I'm agreed to buy American dollars. That means bank has to sell me American dollars or sell to the other party. Suppose I agreed I entered an agreement with the bank to sell American dollars, an asset at future date for an agreed price. Suppose, for example, I entered an agreement with bank to purchase American dollars after 6 months at $1 100 rupees. Similarly, I entered an agreement with the bank to sell American dollars after 6 months at 100 rupees. And in case of foreign exchange currency, the asset is foreign currency. So forward contract is basically what? It's a contract between two parties where one party either agreed to buy or sell in future date at an agreed price. Here, the currency is involved. So in future, I am required or I entered an agreement to buy American dollars or I entered an agreement to sell American dollars, foreign currency. And that kind of a contract is called forward exchange contract. Now AS 11 says whenever you entered any foreign currency forward exchange contract, you have to divide it into two types. There are two ways. One is you are entering forward exchange contract to mitigate risk, to manage exchange fluctuation risk. One purpose. Another purpose is you entered a forward exchange contract for trading purpose, speculation purpose. Because the accounting treatment they have provided separately. First, they say the forward contract is entered for managing or minimizing the foreign exchange fluctuation risk. So, if you enter any forward exchange contract to minimize the risk, that is one category. Second one is trading or speculation purpose. That is another category. So, what is this? This is also known as hedging purpose. You entered any forward exchange contract. Wait. See here forward exchange contract is mainly entered for to reduce or mitigate foreign exchange fluctuation risk. This is called hedging purpose. Second one is non-hedging, trading or speculation purpose. Sir, what is this entering forward exchange contract for hedging purpose or to mitigate the risk? What is this meaning? Simple. I will tell you. For example, sir, you are an Indian enterprise. You sold goods to a customer in foreign country. Suppose A Limited. There is a customer outside India. You are A Limited and Mr. John is there. He is US resident and you sold goods to him. Sale of goods. And the value of the sales is $1 lakh and you made sales on January 1st 2024 and you have given him 6 months time. Now that means after 6 months you are going to receive 1 lakh rupees. This A Limited is going to receive 1 lakh rupees. Now suppose on 1/1/2024, $1 is equal to 100 rupees is there, exchange rate. That means if I convert this into Indian rupees, my expectation is I am going to receive 1 lakh into 100. So I am going to receive 1 crore. 100 lakhs I am going to receive. But I am little bit worried because after 6 months, this exchange rate may come down. Suppose for example, after 6 months, $1 become 90. That means I am end up in receiving only 90 lakh rupees. So there is a loss of 10 lakh rupees. So there is always an exchange risk that in future, if the exchange rate decreases, so whatever the amount I am going to receive in Indian rupees may decrease. As of now, $1 is equal to 100 rupees. But after 6 months, $1 may become 90 only. It is less than 100. Or sir, suppose it may increase also. If it increases, I am happy. So if it is increases, I am happy. But who knows if it is decreases? Like why we are taking insurance? Why we are taking insurance? So there may be a chance that an accident may happen and there will be a loss of property. So that's why in order to protect from that, we are taking insurance. Similarly, when we enter any foreign currency transaction and you know you are going to receive something in foreign currency in future, and if you are feeling that the exchange rate may come down so that I may end up in receiving less amount. Therefore, I want to reduce this risk. I want to mitigate this risk. So that's why I'm entering a forward contract with bank. Now I will approach the bank. A Limited will approach the bank and says, see, we have sold goods to a US customer. He is going to pay $1 lakh after 6 months. Now we are going to receive $1 lakh after 6 months. Now, are you willing to, purchase this $1 lakh from us for a agreed price? Suppose bank also accepted. Bank says after 6 months we are ready to buy $1 is equal to 95 rupees. Okay. So that means after 6 months, irrespective of the exchange rate, I can sell $1 lakh to bank at 95 rupees each dollar. So that I am protected. My risk is mitigated. My risk is reduced. How? For example, after 6 months, if $1 has become 90 rupees, $1 has become 90, but I already entered an agreement with bank to sell my foreign currency to bank at 95. So bank will pay me 95 rupees per dollar. But in the market, $1 is equal to only 90 rupees. So therefore, my loss is reduced. Suppose if there is no forward cover, what will be my loss? My loss will be $1 is equal to 10 rupees loss. Because on the date of transaction, $1 is equal to 100. Now after 6 months, it becomes 90. If there is no forward cover, if there is no forward contract, so my loss per dollar is equal to 10 rupees. Since I have entered a forward contract with the bank, so $1 is equal to 95 rupees I will get. Therefore, my loss is restricted only to 5 rupees. So that is the reason why companies will go for forward exchange contract. This is first category. Forward exchange contract entered for to mitigate or manage the risk, minimizing the risk or managing the risk, exchange fluctuation risk, or we call it as hedging purpose. Similarly, another example I will give, sir. Suppose you are an Indian company, A Limited. You have taken a loan from US bank, for example, Citibank of USA. This is an US bank. You have taken a loan. Loan is taken. Loan. And this loan is 1 lakh rupees, $1 lakh, sorry. And you are going to pay after 6 months. Now today, $1 is equal to 100 rupees. Now you tell me. So being an Indian company, you are a little bit worried. Why? Because as of now, $1 is equal to 100 rupees. What about after 6 months at the time of payment, if this $1 has become 110? So I am end up in paying 110 rupees per dollar. See, I need to pay $1 lakh to Citibank of USA. That means I need to purchase this $1 lakh from RBI, from Reserve Bank of India. Now, by using exchange rate on the date of purchase, now 110 rupees I need to pay. Suppose if the dollar rate after 6 months is 110. So therefore, what I will do is I will approach a bank. I will ask my bank, sir, I need to pay 1 lakh rupees to American bank after 6 months. Are you willing to sell me American dollars? I am ready to buy. See, I am buyer here. I am ready to buy American dollars from you after 6 months. Will you ready to sell? Suppose bank said, okay, we are ready to sell. $1 is equal to 102 rupees. We will sell $1 at 102 rupees after 6 months. So they entered a contract. So this is a contract. There is a forward contract entered between two parties where one party A Limited buys American dollars from another party bank after 6 months at a fixed price of 102 rupees. Now after 6 months, for example, $1 is equal to 110 rupees. Now I'm happy because if there is no forward cover, so I might end up in paying 110 rupees per dollar, but I am paid now only 102 rupees to the bank and I will get $1, so that I will use that amount to pay to my Citibank from where I have taken the loan. So therefore, this is the advantage of entering a forward contract. Irrespective of the future exchange fluctuations, my loss is minimized. Of course, there is other way also. For example, after 6 months, $1 has become 95 rupees. That means, so you are so sad, you are worried. Why? Because I entered a forward contract to buy $1 at 102 rupees. I have to buy it. But in market, it is available at 95 only. So therefore, exchange fluctuations forward contracts are generally entered to minimize the risk by Indian enterprises. So maybe in future I am going to receive foreign currency. So I am worried that exchange rate may come down. So therefore I will enter a forward contract so that the risk can be minimized. Similarly, suppose in future I am going to, I need to pay American dollars. I need to pay foreign currency. So my worry is in future, suppose exchange rate increases, I am end up in paying more amount. So to discharge that liability. So therefore I enter a forward contract. So the basic idea of the forward contract is to minimize the risk for an Indian company. This is called hedging. See, there are some people who entered this forward contract for trading or speculation purpose. Their main business is speculation. The speculation business. So trading business, speculation business, like how they will trade, speculate options, futures, like that. Forward contract is also like a trading and speculation purpose they will do. See, this one, first one is generally entered by Indian enterprises who are going to enter, who already entered a foreign currency transaction, and from that foreign currency transaction, if they are having any foreign currency to be received in future, any foreign currency to be paid in future, so to reduce that risk, they entered a forward exchange contract. Now the most important thing is, what is the accounting treatment? See here, first I will provide a brief idea, we'll discuss it. First, hedging purpose. Suppose sir, any forward exchange contract is entered for minimizing the risk. So standard says, first point, the premium or discount arising at the inception of the forward exchange contract to be amortized over the period of the contract. This is the first point you need to understand. Whenever we entered any forward exchange contract for minimizing the risk of foreign exchange fluctuations or simply hedging purpose, whatever the premium or discount arising at the inception of the forward exchange contract, we need to amortize it over the life of the forward contract. Premium, discount, loss or profit, loss or gain arising from forward exchange contract. See, you are entering a forward exchange contract. Because of that forward exchange contract, whatever the premium or whatever the discount arising, that you need to amortize it over the period of contract. For example, $1 is equal to 70 rupees. This is called spot rate, the rate available on the date of transaction. $1 is equal to, suppose for example, 75. This is forward rate. Suppose, what is forward rate? Forward rate means the rate at which you entered a contract, either to buy the currency or sell the currency. Suppose for example, you entered a contract for buying American dollars at $1 is equal to 75 after 6 months with the bank. So this is called forward rate. So you agreed to buy $1 at 75, but as of now $1 is equal to 70. That means how much extra you are ready to pay? $1 is equal to 5 rupees. This is called premium. This is your loss. Now standard says, when you entered a forward contract to minimize the when you entered any forward exchange contract to minimize the foreign exchange fluctuations, so any premium means loss, has to be amortized over the period of the contract. Suppose you entered a forward contract for 6 months. So therefore, this 5 rupees has to be amortized over a period of 6 months. That means 5 divided by 6, therefore 0.83. Every month you need to amortize. Similarly, there is a discount also. For example, $1 is equal to 70. You entered a forward contract at 68. That means as of now 70 rupees is there, but you are ready to buy $1 at 68. Bank has you entered a contract with bank to buy $1 is equal to 68. That means as of now 70, but you entered a contract at 68 to buy $1. So there is a gain, there is a discount of 2 rupees. This is also amortized over the life of the forward contract. So this is the first point. Second point, any exchange difference recognized in P&L account. So whatever the exchange difference arising from foreign currency transactions, this forward exchange contract, you charge it to P&L account. Suppose if for any reason, if you cancel this or renew this foreign currency forward exchange contract, any profit or loss, transfer it to P&L account. Suppose this forward contract you entered for 6 months and you cancelled it after 3 months. Whatever the profit or gain arises, transfer it to P&L account. So simple 3 points you have to remember. First point, what we are discussing, forward exchange contract. Forward exchange contract we entered for which purpose? Hedging purpose. Hedging means to minimize the risk. Why we need to minimize the risk? Because we know in future we are going to receive foreign currency, or in future we need to pay foreign currency. Now if you don't go for forward cover, there may be a chance that your loss will be huge. You may end up in paying more amount, you may end up in receiving less amount. So therefore, in order to avoid that situation, what we are going to do is we will enter a forward contract with the bank, saying bank that, sir, in future I am going to receive the dollars. Will you ready to purchase that dollars from me at a fixed price, so that I am little bit stable and irrespective of my exchange fluctuations in future. So bank is ready to purchase at a fixed price. So now this, what is the accounting treatment? 3 points you have to remember. First of all, whenever any forward exchange contract is entered, to minimize the risk, hedging purpose, any premium or discount is amortized at the inception of the forward contract or over the life. Second, any exchange difference will be transferred to P&L account. Third, any profit or loss on cancellation will also be transferred to P&L account. Now suppose if the forward exchange contract is entered for speculation purpose, not for this one, minimizing the risk, hedging purpose, but for non-hedging purpose, speculation purpose, then interesting, sir. First thing is, premium or discount at the inception of the forward contract should not be recognized, ignored. Here premium or discount arising at the inception of the forward exchange contract is to be amortized over the period of contract, na sir. Here the premium or discount on the forward exchange contract is ignored and not recognized separately. First thing. Second most important thing is, accounting standard 11 says, whenever you entered any forward exchange contract for non-hedging purpose, speculation or trading purpose, you need to mark the forward contract to its market value. At each balance sheet date, the value of the contract is marked to its current market value, and in the process of marking to its current market value, whatever the gain or loss, it should be recognized. And any gain or loss on reporting date, so I said you should mark it to market value. Na? In that process, whatever the gain or loss is there, that has to be recognized in the books and it will be transferred to P&L account. Sir, how to get the gain or loss? Simple. What is the forward rate at the reporting date for the remaining maturity period less what is the contracted forward rate? Original forward rate, and on the reporting date for the remaining period, what is the forward rate? You compare these two, then you will get exchange rate. I mean exchange difference, that difference into foreign currency units, you will get gain or loss on for reporting date. So I think this is theory. So once we read the theory, na said very confusing, sir. What I will do is I will give you the numbers. I have prepared a separate notes in my classroom at the time of explanation in the classroom. So I will provide that so that you will understand superbly. Because with the entries I have prepared, sir. With the entries I have done this. Now listen to me carefully. Once you understand this, this is very easy. See here. First example. On January 1st, 2005, the company entered a foreign currency transaction by taking a loan of 1 lakh US dollars. So there is an Indian company. On January 1st, 2005, they have entered a foreign currency transaction by taking a loan of $1 lakh. The amount of the loan is required to be paid on 30th June 2005. So when we have taken the loan, January 1st, 2005, when we need to repay? After 6 months, 30th June 2005. So we have taken a loan from foreign currency. So after 6 months, we need to pay $1 lakh. Okay. On January 1st, 2005 itself, the company entered into a forward exchange contract for the transaction to mitigate the risk associated with the changes in exchange rates. Now you tell me, you are an Indian company, you have taken a loan from foreign currency and you need to pay after 6 months. Are you worried or not? Definitely worried, because what is your worry? After 6 months the exchange rate increases. I may end up in paying more amount. I need to get $1 lakh by using my Indian rupees. So suppose now see $1 is equal to 70 rupees. Now suppose after 6 months $1 may become 90, 100. So I end up in paying more amount. So that's why I entered a forward contract on the same date to mitigate the risk associated with the changes in exchange rates. So that rates also I have given here. See here, spot rate on 1/1/2005. Spot rate means rate on that date. On the date we have taken a loan on January 1st, 2005, $1 is equal to 45. Forward rate for 6 months 48. See here, I have given data. Okay, first spot rate how much, sir? 45. Forward rate 48. Now you tell me, what is this forward rate? 48. Forward rate is a rate which we entered with the bank to purchase or to buy, to sell. Purchase, because we need to pay American dollars, right? So that means we need to purchase. We entered a purchase contract, buying contract with the bank to purchase $1 rate to 48 after 6 months. So this is forward rate 48. So 48 is what? Forward rate. We are ready to pay 48 rupees per dollar after 6 months to the bank. As of now, the rate is only 45, spot rate. Okay. Now 45 is the spot rate, 48 is the forward rate. Now how to do the accounting treatment? Simple. Tell me first of all, here forward contract is entered for which purpose? To mitigate the or to reduce the risk, right? So therefore, what standard says any premium or discount is amortized over the life of the contract. Correct? First of all, what is the premium here? Tell me. So what is the spot rate? 45. $1 is equal to 45. Sorry. $1 is equal to 45. What is the forward rate? 48. Now tell me, per dollar how much extra you are paying, sir? Per dollar. For $1 you are paying extra 3 rupees. You are ready to pay 3 rupees at least. Into how many dollars? Like this? $1 lakh. That means 3 lakhs will be what? Premium. This is what? Loss. Now standard says this loss has to be amortized over the life. This loss has to be amortized over the life of the contract. The life of the contract is 6 months. So 3 lakhs divided by 6. That means 50,000 per month. 50,000. Now we entered a transaction on January 1st. So January, February, March. That means for the year 2004 and 5, this year, 3 months. So 50,000 into 3 months. Next year 2005-6, 50,000 into 3 months. So this is 1.5 lakhs. This is 1.5 lakhs. This year 1.5 lakhs, next year 1.5 lakhs. We need to amortize. This loss is to be amortized over the life of the contract. Actually, this is what they said, but I have written entry for the entire transaction. I will explain. See, whenever you want to understand the accounting treatment for forward exchange contract, sir, see here, in this case, there are two things. One is you entered a foreign currency transaction. You have taken a loan. That is one thing, foreign currency transaction. Second thing is you entered a forward exchange contract. That is second thing. So that's why I have made a separation for your understanding. See, if it is a foreign currency transaction, we have seen whenever we entered any foreign currency transaction, initially, whatever the rate available on the date of transaction, at that rate we will recognize. Here we taken a loan. So therefore, what entry will write on January 1st, 2005, bank account at to loan. How much? $1 lakh into, on the date 45 rupees is there. So $1 lakh into 45, 45 lakhs, 45 lakhs. This is what we will write, right? Now, on 31st March 2005, whenever we entered any foreign currency transaction, subsequent measurement, because of that foreign currency transaction, there is a loan, right? That is, this is monetary item. Subsequent measurement. For the purpose of subsequent measurement, I told you monetary, non-monetary. What is monetary? Anything to be received or to be paid. Loan is to be paid in fixed or determinable terms of money. So it's a monetary item. Monetary items are valued at closing rate. Sir, what is the closing rate here? Given in the question. See here. Closing rate 47, they have given 47 closing rate on 31st March 2005. Subsequent measurement on the balance sheet. So 31st March 2005, we need to remeasure it at 47. Loan amount has to be increased from 45 to 47. So loan has to be increased to loan $1 lakh into 47 minus 45, that is 2 lakhs. That will be foreign exchange difference. This foreign exchange difference will go to P&L account. 45 is the initial recognition. Now it has become 47. Monetary item, closing rate. I brought loan from 45 to 47. So 2 rupees is my exchange difference, exchange loss. That loss I need to transfer it to P&L account. Similarly, at the time of settlement, final 30th June, I paid the loan, right? When I paid the loan, what is the rate on that date? See here. 52. So 52 is the rate. Now again, I need to value at 52. Now if I value this, see here. Loan amount I brought to 52. 52 minus 47. So how much difference are 5 rupees? So $1 lakh into 5 lakhs. That will be exchange difference. Foreign exchange difference. It will be loss. This will be transferred to P&L account. Now you see, look at this. First, when I take the loan, $1 is equal to 45. On balance sheet date, it becomes 47. On settlement date, it becomes 52. So my loan amount, $1 lakh, right? Initially 45 lakhs I recognized. Later, I recognized 47 lakhs. Later, it becomes 52 lakhs. That means first to 45 to 47, 2 lakhs exchange difference. 47 to 52, 5 lakhs exchange difference. So this 2 lakhs exchange difference I have recognized at the end of the year. This 5 lakhs exchange difference I recognized on the date of settlement. This is how you need to do the accounting for foreign currency transaction, normal way. Okay, initially rate on the date of transaction, subsequent measurement, monetary items, closing rate. Any difference, exchange difference will be transferred to P&L account. But what about forward exchange contract? You entered a forward exchange contract now. What entries you will pass for forward exchange contract? Simple. See here, come to forward exchange contract. Here forward exchange contract I entered. What contract I entered? I entered a contract to buy American dollars with the bank. How many dollars? $1 lakh. At what price? 48. So therefore I need to pay how much? 48 into 1 lakh, 48 lakhs to bank. So there is a liability. So to amount payable to bank, 48 lakhs liability I recognized. And at the end of 6 months, how much I am going to receive from the bank? $1 lakh I am buying now. 1 lakh into 45 rupees. As of now, this day I entered a forward contract. I know spot rate is 45. So if I receive this $1 lakh now from the bank, 1 lakh into 45, I am end up in receiving 45 lakhs. So therefore foreign currency receivable 45 lakhs to amount payable to bank 48 lakhs. See, this is forward rate. This is spot rate. Imagine, why forward rate? My liability is at forward rate because I agreed to pay 48 rupees per dollar. But I know if that $1 lakh, if I receive today and convert it into Indian rupees, I am going to receive only 45 lakhs. So therefore my asset 45 lakhs, my liability 48 lakhs. So there is a loss of 3 lakhs that I am treating it as deferred premium. And standard says this deferred premium is amortized over the life of the forward contract. That's why see, on 31st March 2015, what we have 2005, what we have done, this premium we transferred, we amortized. See here, premium account debtor to deferred premium. How much? Total 3 lakhs for 6 months into 3 this year, January, February, March. So premium to deferred premium. This premium will be transferred to P&L account. Next, similarly at the settlement 30th June 2015, remaining 1,50,000 will be amortized. So that is what our first point is. Any premium or loss. Here there is a premium. How there is a premium? See here, premium is loss. How there is a loss? Simple. At $1 you are ready to pay 48 rupees. But as of now you are going to receive only 45 because spot rate 45. So therefore there is a loss of 3 rupees. That loss you need to amortize. At the inception of the lease itself, at the inception of the forward contract itself, you need to anticipate the loss. That loss has to be amortized over the forward contract. Now see, one more important point, sir. See, you entered a forward contract, right? What is the entry? Foreign currency receivable account debtor, deferred premium account debtor to amount payable to bank. So your liability, see, this is your asset. This is your liability. And this is loss. This loss we need to amortize over the life. This is what standard says. Now, foreign currency receivable See here, at the end of the year, $1 45 has become 47. That means the amount what you are going to receive is increased. Your asset value increased. Na? That's why foreign currency receivable account debtor to foreign exchange difference. So because foreign currency receivable is a monetary item, you are going to receive this amount. You are purchasing American dollars from the bank. So therefore, monetary item has to be brought to closing rate. What is the closing rate? 47. 45 has become 47. So 2 rupees increase. So 2 lakhs, 2 lakhs. This foreign exchange difference will go to P&L account. Similarly, at the end, foreign currency receivable has become 52. So foreign currency receivable account debtor to foreign exchange difference 5 lakhs, 5 lakhs. Now you see that means your foreign currency receivable asset initially 45, later 47, later 52. How your loan amount initially 45 per dollar, next 47, 52. See, this is loan and this is foreign currency receivable. Both are contra entries, both are contra, because to pay this loan you entered a forward contract, and from the forward contract you are going to receive the foreign currency. So that's why this foreign currency receivable initially you recognized at 145 rupees, and at the end of the balance sheet it becomes 47. At the time of settlement it becomes 52. So there is a fluctuation. So as per AS 11, whenever a monetary items you are valuing subsequent measurement, value at closing rate. So that's why you see. Now finally, when it comes to final settlements, sir, on 30th June, what we do see, amount payable to bank, we pay 48 lakhs to the bank because that is fixed forward rate to bank. This entry, we pay 48 lakhs to bank. Bank will give us how much? 52 lakhs, because on the date the rate is 52. $1 is equal to 52. So 1 lakh into 52. So foreign currency received to foreign currency receivable. And by using this foreign currency, we pay the loan to foreign currency receivable. So these are the entries we are going to pass. Sir, these entries you will understand only when you observe 2 or 3 times carefully. So since this is a revision video, I am not making an effort to explain it 2 or 3 times. Please understand it. This is only a revision video. If you are not understanding, please go back and please listen to it in repetitive mode so that you will understand it. See, these entries, these are all I have written perfectly, and you sit for just 15 to 20 minutes, you understand the entire concept. So once again I am trying to give you an idea about, here we entered a forward contract to mitigate the exchange fluctuation risk in respect of a loan, foreign loan. So always see, there are 2 things here. One is foreign currency transaction, that is loan taken. Another one is forward contract. That's why I have made a classification here. See here. Now standard already prescribed accounting treatment for foreign currency transactions. So you are not bothered about this accounting treatment. Whenever there is a foreign currency transaction, what is the accounting treatment? Very simple. The main focus is on this forward exchange contract. Now since here the forward exchange contract is entered to mitigate the loss, mitigate the risk, what we need to do is, initially at the time when you entered a foreign currency transaction, you anticipate the premium or discount on the forward exchange contract, and that has to be amortized over the period. Here what is the loss? Loss is 3 lakhs. How? See, you are ready to pay $1 48 lakhs. Therefore, amount payable to bank $1 lakh into 48 lakhs is your liability. And you receive $1 lakh. As of now, if you receive, you are going to receive only 45 lakhs because spot rate is 45. So $1 lakh into 45 lakhs. So what is your loss? 3 lakhs. This loss has to be amortized over the period. So at the end of the year, 3 months already over. For 3 months loss, you need to amortize premium account debtor to deferred premium, and that premium will be transferred to P&L account. Similarly, this foreign currency receivable, you need to revalue it by using exchange rate on the subsequent date. Suppose on 31st March, it becomes 47. So 45 will become 47 lakhs. So foreign currency receivable will increase by 2 lakhs. That will be exchange difference that will be transferred to P&L account. Similarly, on 30th June, it becomes 52. So foreign currency receivable to foreign exchange difference. Now on 30th June, on the date of final date, you make the payment of 48 lakhs to bank, amount payable to bank, your liability is now gone. Now you received 52 lakhs. Foreign currency received to foreign currency receivable account is closed, asset is closed, and you received the foreign currency, and that amount you use it for loan. So this is the treatment, sir. And very, very simple, sir. See, compared to what explanation I have given, this much depth is not there. So I have written entire entries also. And please see it 2 or 3 times. Whatever the problems available in study material, these problems, those problems, when you compare with this explanation, they are nothing, sir. They just give this premium adjustment. They say premium adjustment. I think this premium adjustment is very, very easy. See here, I think this is the question. Forward rate 49.15 and the spot rate 48.85. That means 0.3 is the loss into $1 lakh. So total loss 30,000. 3 months contract. So 30,000 divided by 3, 10,000. That's it. 15, 16, 20,000. 2 months, 20,000. This is 10,000. This is what they will ask. Okay. And for that problem, I think which is there in the study material, I have given entries also. If you want, you can try the same entry with entries, but no need. But if at all any question they have asked in MCQs, so I think this explanation will help you to tackle any kind of adjustment. Now see, till now what we have discussed, if the forward contract is entered to mitigate the exchange fluctuation risk. Suppose if the forward contract is entered for trading or speculation purpose, then in such a situation, how to tackle that? If the forward contract is entered for speculation purpose or trading purpose, suppose see, on January, same example, on January 1st, 2005, company entered into a forward contract to buy $1 lakh after 6 months. See, because here there is no exchange transaction. So there is no cover. Already we entered a foreign currency transaction to, to mitigate the risk. We are entering forward contract. There is no such thing. Here we are entering for trading purpose. That's why all details are given. Rates also I have taken same. Forward rate 48, forward rate for 3 months 51. Now see, the only difference if you are entering forward contract for speculation, non-speculation purposes, premium or discount we should not amortize. That's why we should not recognize premium or discount. Premium or discount, you ignore it. Premium or discount, you ignore it. What we can do is, see here, foreign currency transaction, there is no foreign currency transaction here. Directly we are entering a forward contract because we are doing it for trading or speculation purpose, right? So what entries we can write here, see here. Foreign currency receivable to amount payable to bank. Here we entered a forward contract for what? 48 rupees. 48 rupees. We entered a forward contract to buy American dollars. 48 rupees. So foreign currency receivable to amount payable to bank. 48, 48. Now at the end of the year, this is important. Standard says when you entered a forward contract for trading purpose, this forward contract is marked to its market value. Actually, forward contract is for how many months? 6 months. You entered a forward contract on when? January 1st, 2005. January 1st, 2005. See, listen, important. See, when you entered a forward contract on January 1st, 2005, you entered at 48, right? Now you came on 31st March. Now standard says on 31st March, what you need to do is, you need to mark to its market value. That means, suppose if this forward contract you entered on 31st March, for the remaining period is 3 months. If you entered this forward contract for the remaining period, now at what rate you will enter? For example, see here given forward rate for 3 months 51 rupees in market. So if you entered this forward contract to buy American dollars, as of now $1 other party is ready to accept at 51. That means you entered a forward contract. You can enter a forward contract on 31st March to buy $1 at 51. See, you entered on January 1st, 2015 at 48. That rate you entered initially, but as of now, if you want to enter a forward contract to buy $1 for the remaining 3 months, for 3 months period, it will be 51. Now standard says this has to be marked to its market value. What is the value now? 45. Now market value 51. So it has to be marked to its market value. See here, that's why I have written. Being entry passed for marking to market value of the forward exchange contract. Initially you entered for 48. Now suppose if the same contract you entered, it is 51. That means there is a exchange gain. Why there is a gain, sir? You entered at 48. Suppose if the same contract you entered, now you have to pay 51 per dollar. Since you entered at 48, there is a gain of 3 rupees. So therefore they have written foreign currency receivable to foreign exchange gain. That is what they are doing. That is what this standard says. Whenever you entered a forward contract for trading purpose, mark it to its market value. You entered it at 48. Now on balance sheet date, it came 51. That means there is a 3 rupees gain. Sir, how can it be a gain, sir? Simple here. You accepted that you are going to pay $1. You are ready to buy at 48. Suppose if the same contract you entered today, you need to pay 51 per dollar. That means if I sell my contract today to any person, he is ready to pay 51 rupees. That means 3 rupees gain to me. I am doing it for speculation purpose. Simple here. Suppose I purchased one product saying that I will purchase after 6 months at 48 rupees. Okay. Now 3 months over. Now in market today, if you want to purchase that product in the next 3 months, because already 6 months, 3 months over. After 3 months, you need to pay 51 rupees. As of now, that is the demand. No, already I purchased at 48 now. That means I am in an advantageous position. If I sell my contract to somebody else, so they will pay me 51 rupees per dollar. So that's why standard says, since you are doing forward contract for speculation purpose, trading purpose, mark to its market value. That's why, see, 48 is the initial rate. Now it becomes 51. So mark to market value. That means 48 has become 51. So when you entered a forward contract, what is the entry? Foreign currency receivable to amount payable to bank. Because you know you are going to receive how much? So 48, forward rate 48, and foreign currency amount payable to bank 48. Because there is no premium or discount in case of trading purpose. So that's why foreign currency receivable 48, amount payable to bank also 48. Now you know this contract, if you enter today for the remaining period, it becomes 51. So mark it to market value. That means 3 rupees increased. So foreign currency receivable to foreign exchange gain 3. Similarly, when it comes to the last date, 30th June, again actual rate is 52. So that means you end up receiving foreign currency receivable to foreign exchange gain, another 1 rupee has to be increased. And finally, see here, what is the amount we need to pay to the bank? 48 lakhs. How much amount is the foreign currency receivable? 52. So there is from bank we are going to receive 4 lakhs, being forward exchange contract settled. So generally, these forward exchange contracts, speculation purpose, trading purpose, ultimately they are set off, net amount is settled. They are not settled by delivery of goods or items. They are ultimately settled by net amount. Here 4 lakhs we are going to receive. How, sir, 4 lakhs? You tell me. Initially, you entered an agreement with bank to pay how much? 48 rupees per dollar. That means how much you need to pay to the bank? 48 lakhs. Correct? $1 lakh. You ready to buy $1 lakh at 48. So you are paying. You end up in paying 48 lakhs. This is fixed because this is a forward contract. Now, see, 48 lakhs you are going to pay to the bank, and you will get how much? $1 lakh. And if this $1 lakh, if you exchange in the market on last date, how much you will get? 52 lakhs. So 50 to 48. So there is a difference of 4 lakhs. That is what my gain is. So being a trader, I am getting 4 lakhs extra. So initially it is 48. I thought 48. But the same contract, it becomes 51. Now finally it becomes 52. So 48, 51, 52. 48 is what I am ready to pay. And I will get $1 lakh. And I am expecting that the same thing I can recover from the market. See, I will purchase dollars and sell it in the market. So $1 lakh I am ready to purchase at 48 means I will get 48 lakhs. That's the confidence I have. So foreign currency receivable to amount payable to bank. That is the first entry here. And come to 31st March. 31st March, I came to know that if the same contract I entered to buy $1, now I can enter a contract at 51, but I entered at 48. So there is a gain of 3 rupees. I anticipated. Foreign currency receivable to gain. Now on 30th June, I know if I purchase this and sell it in the market, I am going to get 52 rupees, but I already written at 51. One more 1 rupee increase for an exchange gain. Sir, these exchange differences are all will be transferred to P&L account. And finally, settlement entry. How much amount I need to pay? 48 fixed. And how much amount I am going to get? I will receive $1 lakh, and right now the market value is 52. So 52 lakhs is my foreign currency receivable. Already I recognized. Now I cancelled. See, my liability is cancelled, my asset is cancelled. Net amount. So these are the things we need to pass. I think I explained it, sir. And now you see the problems. I think you can solve quite easily. Very easily you can solve all the simple problems we have. I think we have one problem like this. They will give on 1/3/2018 spot rate 47.02, forward rate 47.10, $1 lakh. On 31st March 2018, forward rate they will give. Same whatever I discussed now. This problem is there, very simple. So 5,000, 3,000 gain we need to recognize, total 8,000. Like that, one problem is there. You solve that sum. So I think this is what accounting standard 11 is all about. So no confusion. If you are a little bit confused, repeat, listen to it 2 or 3 times. I think it will get into your mind. Don't leave the standard. Definitely, I think in MCQs, 2 or 3 MCQs can be asked from forward exchange contract. One question is also possible, descriptive questions. So all the very best. Thank you.